Well, good morning, folks. The enemy is trying. He's trying to keep you from learning today. Almost choked to death before I got on here today. And then the audio was acting up. So give me 1 second here. It looks like it's a little too aggressive. Give me 1 second, please. This should be a little bit better. And it is a good morning, despite being a little tardy for reasons outside my reasons and circumstances outside my control. Yeah, I was trying to rush down some bone broth before I got in here and went down the wrong hole. And then the audio acted up a little bit. So I'm checking Twitter right now. If you all would help me out, if you can hear me, if the volume is good, everything is 5 by 5. Awesome. Yeah, it looks like the title I have. Looks like I put the title on for Friday. Sorry, I apologize. Today is Thursday. You're not time traveling with me just yet. Maybe after November this year, you'll be able to do some time travel. All right, so I got a little bit of a wild hair up my ass yesterday, or whenever it was. I sent a tweet out saying, let's do a workshop. So I usually go on these long-winded Twitter spaces, and I promise we're going to be doing a lot of teaching today. Okay, so if you're here to learn, I promise you, you will learn a lot today. You'll learn about fair value gaps. You'll learn about price delivery. You'll learn about time of day, bias, daily bias, session bias, stops. Where should you look for stops so you don't need a book map or any kind of gimmick out there that requires you to subscribe to something. I'm placing insight in your hands so that way you don't have to have any kind of service whatsoever. All you need is the open, high, low, and close, how to work within the time frames. I'm going to work from the higher time frames down to the lower time frames. I'm going to teach you how to backtest today. We're going to be here for a while, okay? I'm not going to be able to promise you a rant won't come in and out throughout this session. So I've allowed 8 o'clock to 11. It might go longer. I don't know. But everything will be recorded. So if you can't stay here for the duration, if you're at work and you're sneaking in here to listen in, shame on you. You're stealing from your boss. I'm not trying to encourage that. I told you to call out. So today we're going to cover a lot of stuff. I'm going to cover Forex. I'm going to cover index futures. I'm going to cover a lot of things that would otherwise be kind of like the first day when in the mid 90s I did one-on-one teachings. And every time I would have a schedule or an appointment with someone, I would tell them what would happen the previous week. So that way, when we would meet on our first session together, I would have everything already in the charts that I already told them the week prior. So everything that I do and have taught for years has always been on the premise of me telling you before it happens, explaining what it's going to do, then we wait for price to do it, and then I can go in and teach more amplified approaches to what it is I already taught you conceptually on this YouTube video or YouTube series, channel, whatever you want to call it, in my mentorship, all those lectures and lessons. If you are looking for that real quick watch, give me something to start studying. If you're new, you don't know where to begin. I kind of like want to place this in the beginning. So give me like 10 minutes of your time. And if you are seasoned and you've been around me for a while, the next 10 minutes is not necessary. So if you want to go grab something to drink, go to the bathroom real quick, use that time here. This part is for the very, very brand new. You've never been here. You never watched any of my stuff, or you've watched a couple of videos and you just feel like this is too much information. Where do I begin? I want to kind of like put this in here because it's also a video that I'm going to refer to in my first book. So there's a lot of things that I'm going to be placing in this channel throughout the duration of 2023 that will help amplify the things I'm going to teach in the book, because obviously books and charts that are static, they're not as dynamic and as good as a teaching tool. Whereas you'll hear and see me do it here, and you also knew on the 13th of this week what I said was going to happen in price action, and it happened. So that way it's not like I'm cherry picking like you hear people like to say. I tell you exactly what's going to happen, and then we go in and you see how the setups form. So I'm telling you with experience, when you watch my live streams, or if you're watching on Twitter, or if I say something in a Twitter space that leads to my opinion about where I think price is going to go, your task as a student here is to borrow that experience from me. Okay, it's not meant to be a signal service. A lot of you want it, Johnny on the spot, give it to me right now so I can copy you. That part I don't want to do. But I tell you what it's going to do beforehand. I do it on higher time frame charts so that it allows you enough time to study it. Okay. So where would you begin if you're brand new and you're a little lost in all this information? Go to the 2022 mentorship playlist. There's 41 videos in there. You could probably ignore the first video, if you're really in a rush, but don't skip anything. A lot of people like just to watch the first few and they think they understand it. You don't. So, and you're gonna see that you don't know that, because I'm going to talk about a lot of things with the 2022 model in today's discussion. I'm going to talk about silver bullets, those setups as well. So there's a lot of things here. I got like 2 pages of stuff we're going to cover, and my whole day's open. It depends on how much energy I got. Okay, so I rested well. But you can go right into finding setups and being convinced that there's enough information in that 2022 playlist on this YouTube channel to help you go in, start looking at things and watching right now. Go out there and start looking for setups to practice observing, not trading. Okay, don't think that you can watch it real quick and try to trade with real money. Okay, it's important that you understand you have to slow down your impulsiveness to want to make money. I know it's exciting seeing the things I'm sharing and my students sharing and all these people that are claiming that they found success with my stuff, and it's wonderful. I'm honored. I'm such in a position of privilege to be considered your mentor and having so many people around the world being profitable now. But it's not a rush to get to that point. Every single one of my failed students, and I have them, I don't have just winners, I don't have just success stories. Like anything in life, there's going to be folks that just simply can't do it, or can't do it yet, and eventually they get there. How much effort and time you put into this is going to decide how fast, not that that should be a factor, but how long is it going to take you to find your setup? What is your setup? How do you determine what that is? Because I teach a lot of ways to get into a market. We're going to teach that today too. So this meeting today, this come to Jesus meeting with the ICT content, is really focused on where you should be in your pursuit of learning, what you should be focusing on, and how to determine your path through all this content, because I teach a lot of things, a lot of ways to trade, different time frames to trade, different setups, different entry mechanisms, different ways to take profits, where to take partials, how to take partials. We're going to cover all that stuff today. I'm cramming everything in here as like a nuts and bolt kitchen sink approach to ICT. So that way you can go through today's presentation and determine where your area of study would be best served for your personal interest. So that way you'll hit the ground running, or it'll highlight where you're lacking in your personal study right now. You may be hit and miss, where you make some profits in your demo account and then you lose it and you go back down to break even, but you just don't blow out the account. That's a wonderful position to be in. You may not feel like that is, but it's a wonderful position to be in, because if you're in there impulsively just pushing the button, you're probably blowing your account. You have no idea, no model, no frame of reference to anticipate anything happening in price. And we're going to remove that today. So that way, at least you give yourself a framework to go forward and study, and then you can start measuring progress, which is really important. Because if you just simply watch my videos, and this is the part you need to listen to carefully, if you simply watch my videos or wait for my next video to come out and you're just a viewer and you don't go into your own charts looking for this information, not trying to demo real time, going back and look at old price moves, and we're going to do that today. I'm going to show you exactly what you're supposed to be doing. It's not hard. It's a little bit tedious in the beginning because it feels like it's counterproductive. You're looking at something that's already happened. But everything technical, everything worth doing is always based on studying something as a case study that's happened in the past. How else can you determine a foundation to something? You have to have a good foundation in observing repeating phenomenon at specific times of the day with repeating characteristics. That's what I teach. So those hallmark signatures in price action, that's the whole basis of what I do as a mentor. I'm teaching you how to observe and find that. I don't and I can't promise you profitability. That's something that you're going to determine based on how much time and effort and organization you bring into this. Last point, and then we get into it. If you are lazy, you will fail here. If you have an entitlement mindset where I owe you something, I have to do everything for you, or I can't learn this unless it's one-on-one, or it has to be done live, I'm not going to be a good help for you. I will call moves. I will outline things, watch my live streams. I call every smallest time frame candlestick one at a time, where it's going to go, how it's going to behave. There is no better performance measurement than that. If there is no way of doing that real time, then there's no need for you to ask for statements and give me a live trade and trade live in front of me, because I've already done that. That's in my live streams, and I have a live account with TD Ameritrade. You can actually see statements where I logged in and showed every single day win, loss, exercise of drawdown, came out of drawdown, just to teach students there's nothing to be afraid of. There's no fear of losing. You should respect risk. You will lose trades. Everybody that trades, every single method, every single teacher, educator, everybody, if you're going to put risk in the marketplace, invariably you're going to incur a loss. And you have to accept the fact that that's going to happen. How you handle yourself, how you handle your perception about your ability to work through that and stick to the model that you have trusted, that it doesn't have to be perfect. 100% strike rate is not possible. It's not realistic for you, okay? But you don't need a high rate of return or success rate in terms of trades to be profitable. And I'm not promising you get rich. I'm not promising you millions, but the things that I teach in money management and all those things factored together, can you become wealthy? Absolutely. Can you quit your job? Absolutely. Can you have a secondary income and still keep your job and just treat this as another side hustle? Sure. It's completely scalable to you. Do you want to win competitions? Yes, you can do that too. So it's a matter of what you're doing and why are you trying to trade. And if you're here to try to be the next social media superstar, that's probably not the best way of doing it, because you're going to be impulsive. Everything you're doing is trying to get ahead of somebody else, when it should be just about making sure you don't lose money and that you're working towards learning how to be consistently profitable. And consistently profitable doesn't equate to everyday trading. Day trading is not everyday trading. I promise you, if you try to do it every single day, especially in the first 2 years or so, you're going to have a whole lot more losses than is necessary, which is the reason why I teach with a lot of lectures, and in the dry parts of my discussions, they're the parts that you're going to come back to after you tried to do this, you made a little bit of money, or you found some success in it, you're hooked now, you want to keep doing it and have more of that experience, and then you have a losing trade, and then you want to hurry up and erase it and fix it. I got to close the day with fixing that loss. Then you make it bigger, and then you start that routine of chasing break even on the day, and all that does generally makes it a larger drawdown. So you want to avoid those periods and be content with, okay, you did something wrong. It doesn't mean everything's broken, but you can derail yourself in your learning Or if you're trying to trade with live funds before you're supposed to, you won't do well. And it makes it harder. So when I teach, I give you 30 years of experience. The things that I'm talking about, I went through it. I lost lots of money, lots of accounts. I did it to myself. Nobody else was to blame. I did every single time. I caused all that. And you have to be responsible with your own actions as well. So if you make money using what I teach you, well done. I am not responsible for that. If you lose money, well, you did that. Own it. So I'm giving you my experience. I'm proving that I can tell you what's going to happen in the marketplace with a great deal of precision. And you can learn that precision. You can grow into having a very clean understanding about price, what to anticipate, and more importantly, when not to try to trade. That is an important lesson. And not too many people are aware really that that's an important factor in trading. And that sometimes is the boring conversations. But I promise you, once you go into drawdown, you're going to want to listen to those parts in the videos again. And then you're going to wish that you listened and followed the advice I gave you. I want you to do well. I really, really want to see you succeed more so than you do. But there's got to be rules that you have to follow, and you have to give yourself time to grow into it. Okay? So with that mindset and that, I guess, goal in mind, let's begin. After this presentation today, over the weekend, I don't know how much time you have to devote to this today or the next couple of days, but I did a live stream on the 13th of June, and I talked about some of the things we'll talk about in the first hour of the presentation here. I'll do 1 hour, and then I'll break for like 5-10 minutes. I'll leave the recording going, so that way if you have to tend to something, relieve yourself or whatever, I'm going to want to stretch out as well. And then I'll come back. So we'll do that like every hour, like a 5-10 minute break, but the recording will still keep going. For those that are really helpful in their own recording and documentation where I talk about certain things, and I have very studious students that like to do this, if you would help me create a little timeline for if I transition from one topic to the next, or if I go from one market to the next, if you want to send me those minute markers on Twitter, that would be wonderful. And I'll use those in the comment section of the video, so that way it helps people go right to those moments. I am not going to go through this and do that myself, but I know I have a lot of students that do that for their own purposes in my other videos. So just let you know, I'll appreciate that help. But on the 13th, I covered my opinion about what I thought was going to happen this week. And when I was doing one-on-one mentorships back in the mid-90s, folks would learn about me by me advertising. And it was a high-end advertisement. So it was people that had a lot of money and wanted to come to me and learn how to do something with that money on their own, and had either already been in the marketplace or was looking to do something to get into it. So one of the greater selling points I had was I would tell them, much like I did on the 13th of June of 2023, it's on my YouTube. It was live streamed. It wasn't a pre-recorded thing. Everybody watched me outline it. And we talked about the CPI number, and I walked you through CPI real time, and I walked you through a 15-second candlestick chart. So every single candlestick represented a fluctuation of the highest high and the lowest low and open and close of every 15-second increment. Now, you don't see that in books. You don't see anybody teaching with that type of time frame, but everything that I teach is fractal because it's the same price. Whether you're looking at it from a weekly chart, monthly chart, 3-month chart, a yearly chart, it doesn't matter. Price is price. What I'm going to teach you today is a secret of breaking down price and looking for that price delivery continuum. So how to go in, like if you ever watch me do a presentation where I'm recording my trades, if the comment sections are open, or if I share it on Twitter, most of the time you'll see a handful of folks come and say, why did you pick that time frame? And why didn't you trade this time frame? And why didn't you trade that time frame? I'm going to answer that for you today. And that way you'll know what time frame you're going to be looking at, okay? Some of the lessons today won't be so impactful for you because of where you are in your learning. If you're brand new, a lot of this stuff is going to go right over your head. If you stick with this and you study it, I promise 3 months from now, if you come back to this presentation and you watch it, you're going to swear that I added something new. But it's just because your focus is on things that aren't important to you at the time that I believe are more paramount. And the most important thing is understanding where price is going to go. So the selling point I gave to my students that would come with me one-on-one, they would spend a whole entire week with me, Monday through Friday. And we would be at the charts live when the market opened up. I would show them bonds and S&P. That's it. That's all I would talk about. And I would give them the previous week. I would say, okay, here's what it's going to do. This is where it's going to go to. And we'll cover it next week. Think about that and treat it like what I gave you on the 13th of this week in a live stream. I talked about very specific points of reference in price for the dollar, euro dollar, pound dollar, gold, NASDAQ and ES, and the Dow futures. So I'm going to go through those individually and kind of like, it'll be somewhat of a review, but I'm going to teach also the main takeaways and what you're supposed to do with this information, because it's not like it's unfortunate I get new people all the time on Twitter, and because they don't know me, they don't know my personality, they don't know how I teach. When I show examples, and we'll cover the reasons why I took the NASDAQ trade in detail also for those that are asking from yesterday's trading post FOMC. I'm going to teach you how to trade CPI today. I'm going to teach you how to trade FOMC. I'm going to teach you how to trade non-farm payroll Friday. It's Mythbusters ICT edition today too. We're removing all the talking points that people like to use to detract you from trying to study with me. I teach you to avoid trying to trade ahead of CPI. I teach you try to teach you to stay away from trying to trade ahead of FOMC and ahead of non-farm payroll. I have done many examples of me trading post FOMC, post CPI, post non-farm payroll. I've done years of that. My students that were with me every single day in private mentorship for years saw me explain where I think it was going to go and watch it happen. So it's not that I'm trying to prevent you or teach you that no one can make money on those days. It's because I'm assuming when you're watching, you aren't you're a new trader, that your experience is very small and you don't know what you're doing. So I'm trying to protect you from yourself, because I was my worst enemy, and you're your worst enemy right now. You don't realize it, but you are. So if you listen to me, I'm trying my best to try to give you everything in the perfect, proper order, how you're going to develop, because I've done this for a long time, and I already know what the questions you're going to ask me. But many of the questions you're going to ask that's coming up in normal development is already in the videos that's on my YouTube video channel. It's layered across lots of time, because this can't be learned real quick. Because you're going to discover what you think you're going into this to try to do, because a lot of you think you want to trade the silver bullet. A lot of you came in think you're going to trade optimal trade entry, but you discovered the 2022 model, and that makes sense to you. So right now, your initial expectations, you're probably going to lose that maybe in this discussion today, and you may develop a better focus on what it is that you want to do, and that's a success for me and you. If you arrive at that today, that's a success. That's a good use of your time today. But I promise you, if you take good notes, not just simply watch me, take good notes. And here's what I want you to do. While you're listening to me today, don't try to write down every single point that I'm trying to cover. When I'm talking about FOMC and how to trade that, or trading CPI, or if I'm talking about silver bullets, fair value gaps, or whatever that topic is, write that topic or focus point and where I am in the minute marker or hour marker on the playback. All you gotta do is hover over top of the little time thing at the bottom of this video, and it'll tell you where you are when I'm talking about it. And it makes it easier for you to go back in and dig into that. That's good note taking, because then you can go back and go in and get the real nitty gritty to it. And I'm going to talk a lot about it in detail. So it's important you do that. Otherwise, watching it alone is not going to be enough. And I know, get to the point. I hear you. All right, so let's go over to the dollar index. All right, and this is a weekly chart. And I shared all this business on the 13th. I added this little area in here. This is a fair value gap. And I have to be careful when I'm talking, because I noticed in the 13th live stream, when I was referring to certain things, my cursor wasn't really where I wanted it to be when I was making points. So I'm trying to make a conscious note of making sure I have my cursor where I want to talk about it. So where I have my cursor now, that candle's high and the specific close is what I'm looking at for that range to that candle's low. Okay, the candle to the left of this one here, that body of that candle that is encapsulated between the range of this candle's low here, that makes the high of the fair value gap. This candle's high or close, and I just dropped it there. It's so close it doesn't make a difference. That candle's high and or closing point represents the low of the fair value gap. The shaded area is highlighting this particular candle's body, not the entire body of the candle, just the range that's being shaded here. Okay, between those two reference points, that is considered, by my definition, I call it a fair value gap. Its classification is a buy side imbalance, sell side inefficiency, meaning that the delivery of price was on the upside. So think about a paint roller. Okay, and I've used this analogy before. If you wanted to paint a wall in your home, and you apply the paint to the roller, and then you apply that roller to the wall, okay, you're getting that delivery up. If you keep doing that from the bottom of the wall to the top, eventually paint will run out, and you'll see these little pockets, these little pits on the wall where paint didn't make its way to the wall. So you already know, what do you have to do? You got to roll back down over top of that to fill in those little pockets of gaps where paint was not distributed. Think about price the same way. Between these two reference points, that being this candle's high and this candle's low, that one candle right here in that shaded area that's purple, there's going to be small inefficiencies in that range that's shaded in purple. The easiest way to simplify it is, we don't need to know yet where those small little pockets are on the lower time frame, because this is a weekly candlestick. So inside that range I'm highlighting here with my cursor, somewhere along the line in that very week of data, there are gaps, inefficiencies. We don't need to know exactly where they are, but we can identify that range right here. As soon as that candle closes and we begin a new week, that gap that's shaded in purple, we know that there's a likelihood that the market will want to, at some future time, want to reprice to that. That is not balanced. All it means is that shaded area that's purple, it's buy side imbalance. So the market's shown an imbalance, meaning it wants to go up. It did go up. So what is it inefficient? It's inefficient in the sense that it hasn't had a sell side delivery. Sell side is when price is being offered downward, a down close candle. My down close candles are black. My up close candles or bullish candles are green. For that purple shaded area here, for that to be repriced to and offset the inefficiency of sell side, because it's buy side imbalance, it's imbalanced. It has to be balanced later on, and I'll tell you how it becomes balanced. But right now, what is it lacking? It's lacking sell side delivery. That means a candle must trade down in between the high and low of that purple range. And it's defined by the two candles I mentioned here. This candle's high. That candle's low. So in my mind as an analyst, I'm looking at this and thinking, okay, well, we've seen a lot of back and forth price action all through here. Let me add a rectangle here to kind of like highlight, because I know I may or may not have my cursor exactly where I want it as I'm talking because of the live stream. Okay, so inside that darker shaded pink area, inside that rectangle, notice how there was a lot of back and forth, up and down price delivery. You see how it's created like a small little trading range in there? Where is there a break in all of that back and forth movement? It's in that shaded purple area here. So up and down, back and forth, think about that paint analogy, all inside this pink area. If price was paint and the canvas that is the background of my chart is the wall, in that shaded area, price has done a very good job of moving back and forth inside that pink shaded area. But it didn't do a very good job of efficiently offering sell side delivery in that little area right there. So what the algorithm does, it seeks those areas there because it's easily defined by arrays, old highs and lows that are separated across a spectrum of 3 24-hour periods. Any separation between this time frame or any other time frame. I'm going to teach you the price delivery continuum today, so that way you can see from one time frame down to the smaller time frame, how did you pick that fair value gap and not this fair value gap? You're going to know all that today, okay? But you won't retain it unless you're paying attention and probably watch this video a few times. So we know that there is a strong tendency for the market to want to come back and reprice into these areas. Now, let's take us into what I was mentioning on the 13th. For those that you want to go back and revisit, you already watched the 13th video. I think it's a little less than 2 hours long. For the people that want to get right to the point, I'm going to help you here, okay? You should watch the entire video. It's some wonderful information in it, but for those that want to just simply go right to the points, for the dollar index on the June 13th, 2023 price action lecture in market review, I was teaching on CPI, the minute marker 4 minutes. You'll hear me talk about a price level of 102.705. I want you to think about what I just covered here on the weekly chart, okay? I'm going to keep this just as it is here and drop down to a daily chart. So when I'm looking at price, I have all of this higher time frame weekly perspective in mind. So if I were asked, which time frame do I spend the most time on? It's the weekly chart. Now, why do I spend the most time on the weekly chart? Number one, as I taught my students one-on-one in the mid-90s, and the way I teach my students in mentorship, and the way I've taught and shared in those mentorship lectures on my YouTube. Don't buy people pirating my stuff and trying to sell it to you. It's been made available to you on this YouTube channel for free. Go and study it at your leisure. Go at your own pace. There's no rush. I'm not taking the videos down in November. They're staying up. That premise of how I go into the marketplace and what I'm looking for on the weekend, usually either on a late Friday evening once my whole family goes to bed and they've turned down for the night. I don't sleep like a normal person. So I do a lot of study really late in the night or early in the morning before they wake up. Or if I don't get that, I do it on a Saturday. I look at the weekly chart in reference to a monthly chart, a 3-month chart, a yearly chart, and I'm looking at it the same way I'm doing here, okay? And I'm trying not to steal too much thunder from future lessons, but just know that what I'm doing here, I'm done that with a monthly chart. I do it with a 3-month chart. And on TradingView, it's really nice because if you go in, if you type 1M, it takes you into a monthly chart just like that. And right away, you can see things that you may not have noticed before. So you have a 1-month chart here, and right away, my long-term students can see right away, they're thinking, wow, that thing used the volume imbalance right there. The separation between this body's close and this body's open. That monthly candle went right up into it there and then went lower all month. So I'm looking at those types of relationships. And you can look at 3M. It'll give you 3 months of data. You can see how we're drawing down into this buy side imbalance, sell side inefficiency, which is the same thing I just highlighted in purple on the weekly chart. That's this here. It's the same thing. So in my mind, I like to look for those first. And if there is no inefficiency, then I'm looking for liquidity. So in summary, let me rephrase everything I just said. When I sit down on the weekends, whatever time I'm going to be doing my analysis, the market is not trading. All of my analysis is done when the market is not trading. What I'm trying to predict, to anticipate, not react to, what I'm trying to predict and or anticipate is where is the present weekly candle reaching for higher or lower prices. If I see an inefficiency like this right here, that purple shaded area, I'm expecting price to try to draw down into that. If this inefficiency wasn't there, I would look for that low because that's where sell side would reside. Or consequent encroachment, which is the midpoint of this candle's tail. So it would be this. Let me make sure I have my cursor sitting here for a second before I start saying anything more. I would either look for that midpoint of that candle's tail, which is consequent encroachment, or I would use the low of that wick there. If, folks, listen, if there was no inefficiency that's shaded in purple, if that wasn't there, I would be expecting price to draw down. Now, why would I expect that? What makes me say that? Because we already hit our targets that I covered in the previous weeks. For those that weren't here, I was talking about how dollar was going to go higher, that we were going to use this shaded area here as an inversion fair value gap, and it would treat it as something bullish to trade up into the weekly order block, which is this opening price of this candle here. This candle's opening price, that's the weekly bearish order block. It was acting as a target. Then I said the mean threshold of that candle, which is the middle point of its body in here. That's the bearish order block mean threshold. That was also a target. So once it hit that, we wanted to see what's going to happen. Once a target's met, whether for the week or a day, you have to get comfortable, grow real comfortable with just simply sitting still and waiting. Move very slowly when you're trying to make money. And I learned this lesson from Larry Williams. It didn't make any sense when I first learned it or heard him say it, and it took dozens of times of blowing out accounts, not listening to that advice. Move slow when you're trying to make money. Move fast when you're trying to preserve it or protect it. If you watch something pan out that you have done analysis on and you've been successful with it, don't be in a rush to get another dopamine hit because that feels good. That's a neophyte, that's a brand new trader's trap. You see many times individuals that are open about what they've done wrong and they use social media like a confessional. Father, I've sinned. Look what I did, and I blew my account. Okay? You don't need to do that. Don't do that. Once you see something pan out, meditate on that. Let there be a period of time between where you've seen something pan out, you were successful, and then really record how that felt for you. Because in the future, you're going to have periods where you do something wrong. And it may be a week long of that, a series of doing things incorrectly. And if you don't journal the times that you've done it right, not just when you've done it wrong, but when you do it right, and you encourage yourself and you remind yourself that you followed the rules, the market panned out like you were hoping it would, and you anticipated that, you're conditioning your subconscious to hold on to that as a positive experience. But when you're journaling, you're not recording your negative results in a manner that is condemning. You don't use language or terms like, oh, I was stupid, or this stuff is never going to work for me. Never, ever, ever in your journal, ever record anything negative. You can still highlight the fact that you did something incorrect, but how you describe it, how you encapsulate that in your journal, your subconscious is going to remember that. Because if you write down that you were an idiot in that trade, I should have did this, I knew better, but I did this or that, you're actually creating scar tissue. And there's no elasticity in scar tissue. You can't grow without a whole lot of tearing and pain. So to remove that growth of scar tissue on your subconscious and the psyche that's required to do this as an industry, you have to make sure that you're conscious of what you're doing and you're guarding your mind. Social media is a very big factor in why people are not successful. See, you think social media is going to encourage you, and it might initially, but what you'll find is it's very toxic. And you don't want to bring that toxicity into your journal, because if you put it in your journal, what you're doing is you're making a ledger of every single time that you have an engagement with your expectations, your model, and price. And what price does ultimately is outside your control. But how you perceive what you are expecting and how you record that is paramount in how you will walk forward. By recording your negative experiences in a light that is devoid of any kind of judgment, no kind of condemnation, no kind of ridicule or criticism that is harsh. What you want to do is record in your journal if you've done something wrong. Say, I'm happy that I can see that this is where I can improve on. This is my area of study that I need to work on. Versus, I got stopped out here and I didn't listen to what the market was telling me, and I kept trading against it, and I went into serious drawdown, or I would have blew my account there. All that stuff that you're putting into your journal, they're memories, but they're happening in a level that's way deeper than just short-term memory. You're charging it with emotion and energy that you will tap into subconsciously. The effect happens when you're a child and you saw a scary movie. You think every time the lights go off, that event that what scared you in the movie, you think that's what's under your bed. It's in your closet. Okay? Your conditioning is called priming. So when you're journaling, you're priming yourself for future success. It's brainwashing yourself. It's really what it is. You are tricking your brain to only see the silver lining, which is critical. It's critical because it's easy to talk yourself out of this because it's highly technical. And nobody's going to cheerlead you. Nobody's going to coddle you. You have to be able to find your own cheerleader inside you to keep yourself going, because in the beginning stage of this stuff, it's very, very challenging because you don't know where you're going to go as a trader. And we're going to cover more about where you should go and how to determine that for yourself. But you take all this information from a higher time frame. I do this, and I look at where price is likely to go. It's only going to go up for one of two reasons. Okay, price delivery continuum is the movement from where price is right now to future delivery. So where it's going to be 5 minutes from now, a week from now, 2 days from now, 2 sessions from now. It's going up to take out buy stops or it's going up to trade into some kind of inefficiency, like a fair value gap. That is it. That's the only two reasons why price goes up, period. It's not buying pressure. I'm sorry, but that's the truth. It does not go up because of buying pressure. It doesn't matter how many people buy it. Perfect excuse is if you look at price and study volume. Okay, study volume. How many contracts does it take for a limit up move in wheat? Not that you probably trade wheat. You only need one contract traded. It opens up at a limit up move, boom. Who can trade there? Nobody. It's lock limit. What was the volume? Whatever that trade was that marked it. That wasn't buying pressure. That wasn't buying pressure. It was only one transaction. It opened it up here, boom. Nobody else can buy it. That's not buying pressure, right? So that was the biggest wake up call to me when I was a commodity trader in the 90s. That's how I started, by the way. I realized that volume is important. Yes, it does have a place in analysis, but too much emphasis is placed on that as the reason why price goes up or down, and it's not. Price goes up to seek liquidity. And if it's going up, what liquidity is that? Buy side liquidity, buy stops. Okay. If it doesn't run for liquidity on that particular time frame, it's going up for an inefficiency. That means a gap. A gap would be like that purple shaded area here, or this. I don't know what that color would be called. We'll call it a pale orange. That gap between this candle's low, that candle's low over here, and this candle's high. That's what's being shown here in that little pale orange shaded area that's noted as the weekly inversion fair value gap. That gap and this purple one here, they are called inefficiencies. Think about the paint analogy I gave you. When price is moving back and forth in a defined range, what's the defined range here? Where your eye looks at price, just like I have it shaded here in pink, price has moved rather efficiently inside that pink area, up and down. Okay. When price entered the low end of this pink shaded area, now we don't know that pink shaded area is the range yet. What I'm saying is when I'm looking at price, I'm looking at how price was delivered during a period of time in whatever time frame I'm looking at. So this is applicable to whatever time frame you're looking at, whether it be a weekly chart, a daily chart, 4-hour chart, 6-hour chart, 15-minute chart, a second chart. It doesn't matter. Okay, it does not matter. What matters is where are the inefficiencies and where are the stops? Above old highs is buy side or buy stops. Below old lows is sell stops or sell side liquidity. Those are the two things I'm looking for after my eye goes through the chart and I'm looking for the inefficiencies. So the first thing I'm looking for is inefficiencies. That's the first thing I'm looking for because that's the array that the algorithm reaches for first. It pans for any inefficiency. If there's no inefficiency and we're in a premium and we're likely to go lower, then it's going to be looking for sell side. Reverse that. If we are in a range and we're in a discount and there is no inefficiency above price, but there's a short-term high, it's going to run for the buy side. That's what I'm doing on the weekly chart. So for the folks that are hammering themselves and beating themselves up, please teach bias. I just did. But what you're wrestling with is you don't have time looking at charts like I'm showing you here. You see this pink shaded area? How the market entered it, went up to this candle's high. The next week we opened up here. Then we traded higher up to this point here. Then the next candle or next week we open, we trade down and overlap all the way and into the previous high. So there is no fair value gap formation whatsoever in the candle I'm highlighting right now. Notice that? The candle to the left of it's high and the candle to the right of it's low. There is no separation like you see in that purple shaded range. That's a fair value gap. There is no fair value gap between the candle I'm highlighting here with my cursor using the candle to the left and the candle to the right. So what is actually happening there? The price has gone up and down, up and down. That's like that wall being painted very efficiently. Is there any inefficiency there? No. So at that time, when we start on this week, we open, we rally up, make the high, and then we close after making a low here. So there's been a lot of delivery up and down in between the range high of this week and the close of this candle here. Now, why am I picking that close? It's because I'm showing you how prices reacted in here and why I was telling you on the 13th in a live stream that can't be cherry picked. It was told to everybody watching it that I want to see dollar reach lower. Okay. And we haven't even got off the weekly chart yet. I'm teaching what I'm looking at, and this is what I'm trying to tell you. I spend the majority of my time on the weekly chart. I'm looking at how price delivered. Think about what I'm showing you here and how that relates to this area right over here. Think about that right in here. That same idea, we can apply it to over here. I promise you, I'm taking you somewhere. Even though if you think you don't know what you're understanding and confusion is probably peaking right now, just keep staying with it. I promise it'll make sense as I'm going. Same thing here. Price opens up, trades higher, back and forth delivery, all the way up to the high, back and forth, and then we leave it. So before this broke down, is there any inefficiency over here? Below this pink shaded area, is there any inefficiency? Inefficiency would be like this candle here. How it has that separation between the candle's high to the left of it and the candle's low to the right of it. Does that occur or form anywhere underneath this pink shaded area in all this? Do you see that? Yes. Right here. I'm just going to use a short little trend line. I promise you folks, this is the stuff you're looking for. Even though you may not feel like it's important right now or it doesn't make any sense, I'm going to take you light years ahead. Most of everybody else out there today. So there's a gap there. So I would take like this rectangle here. I would highlight this, but I'm only showing it as a small little section with the rectangle not being here, but just simply using the trend line sections. So we have an inefficiency here. So when the market leaves this range, it's in a premium relative to the low and where it traded to. It's in this range consolidating, and then it leaves it. Where's it going to go? Well, there's several things. You can use the consequent encroachment of this wick, midpoint of that. Then you have the gap here that this traded down into, but left the majority of the gap still untouched, right? So when it drops here, price is going to want to trade into this area here. Does it do so? Yes. And again, that would be bias. That would be bias for that particular week for the dollar. What do you think that would mean for you Forex traders that want to trade pound dollar? What would you anticipate that week? This week I'm highlighting right here. How would you use that information? You would go into your charts and back test any long positions during the London Open between 2 o'clock and 5 o'clock in the morning, New York local time. You would look at your AM session kill zone, the New York kill zone, between 7 o'clock in the morning and 9 o'clock New York local time. You would look for the model of 2022. You would look for optimal trade entries. You could look for silver bullets because silver bullets form in the kill zones between 7 o'clock and 9 o'clock. Ooh, what'd I say? Yep, we're teaching that again today too. It's not limited to just index futures and 10 o'clock to 11 or 2 o'clock to 3 o'clock in the afternoon for index futures. If you're a Forex trader, everything that I teach is applicable. Even though you see me predominantly teaching it in E-mini S&P and futures contracts, it's applicable to Forex. There's subtle little rules that you have to worry about, and time is the factor that's got to be considered. Because yes, there are silver bullets between 10 o'clock and 11 o'clock in Forex, yes, but they are really good ones between the 7 o'clock and 9 o'clock New York Open kill zone, and between 3 o'clock and 5 o'clock London Open kill zone. They're there every day. Every single day, you have a reason for you to find a setup. Now, again, that is not an invitation for you to go in and try to trade every single day. Okay? So I want you to think about how the market moves in these ranges. This is a balanced price range. Why is that a balanced price range? Because the market has moved up and down within it, and then it left the range. So if it's going to leave the range, what is the algorithm? Let's make an argument for the sake of folks that don't want to believe there's an algorithm that controls price and there's no amount of buying and selling pressure that's going to change that. Market's going to go where the market's going to go. It's predetermined. Your daily high and low is predetermined. Whether you like it or not, it is what it is, okay? How can we determine where that likely higher low is going to form, or where would it likely reach to? Starting on these higher time frame weekly charts. And if we know that we can see prices likely to want to expand lower, think about it, because we're on what chart, what time frame up here? Weekly. So my analysis, everything that I'm doing on the weekend, when the markets are not trading, I'm trying to determine what's the strongest directional bias that can be derived by looking at the weekly chart. What is it likely to be reaching for on a weekly candlestick chart? It's going to either be reaching up for buy stops, or it's going to be reaching up for a fair value gap above where the market is right now. If it's likely to go lower, then I believe it's going down to a fair value gap below current market price, or it's going to go down to reach for sell side liquidity below some old low. That is not complicated, folks. These things on your chart, they're not hiding from you. They've been in plain sight. You just never been told to look at it this way because you're trying to apply indicators and all these things. And frankly, when you look at it like this, you should be able to see it really quick. See, when I'm looking at the chart like this, my eye jumps real quick to inefficiencies. My eye jumps to that. My eye jumped to that. That. I'm probably moving faster than the live stream can keep up. And then obviously the gap that I just showed. And every high, every weekly candlestick, high and low, is a factor as well. They're going to be used again. They don't just get used one time and they expire. Okay, so I teach there's a 60-day look back, and the highest form of precision or highest form of accuracy in terms of my key levels, I define it within that 60-day range, and it's 60 market days, not 60 calendar days, obviously, but it's looking back 60 days. So what I'm looking for is the highest high and the lowest low in the last 60 days. I'm looking for inefficiencies in the last 60 days, whether it be premium or discount. That means a fair value gap like that purple one here was. Before we traded down here, in the beginning of the week, the dollar index was up here. And on the 13th, I explained it. I felt like we would draw down. I'm teaching the part that was not made available to you on the 13th live stream. Okay, so I'm filling in that gap of insight that wasn't made available in that presentation, but this is the logic that went behind it. So let me take this off and we'll drop down finally into a daily chart. Okay, so here's the daily chart, and let me take all this business off because they're all distractions, and I want you to focus only on the things that I'm making a point about. All right, so this inversion fair value gap was an old gap. Notice that it does not look like a gap on the daily chart, where it did look like it on a weekly. Let me just, for completeness sake, drop back up to a weekly chart. That separation from this candle's low and that candle's high, the candle to the left of that, it's only sell side delivery. It's a sell side imbalance, buy side inefficiency, SIBI, S-I-B-I. It's a fair value gap, but the classification is a SIBI, meaning that some future time the market is going to trade up and deliver price on the upside. So it's offering buy side delivery. We see that happen here on this candle. But I said that we would treat that as an inversion fair value gap. Go back and look at all the presentations and commentary around that at the time. But on the 13th of this week, June 13th, 2023, I said that we would look for this old gap. Okay, this is what separates me from folks like Chris Laurie, where they look at inefficiency and then he'll tell you it's done. That's his terms. It's done. It's not meant to be disrespectful, but when I tell people you can learn how to read price action with Chris Laurie, if you don't like me, that's fine. But you won't learn what I'm teaching from Chris Laurie. But you can learn how to see inefficiency in price. I didn't learn inefficiency from Chris Laurie. Okay, I was trading before Chris Laurie. But long story short, this whole business of inefficiencies, we can use them as real dynamic support and resistance, because that's in fact really how the algorithm refers back to them. Meaning this, when I look at this range, this shaded area, it doesn't look like a fair value gap on the daily chart, whereas that is a fair value gap. You see that right there? Look where I have my cursor at, right here on this candle here. Go up. That candle I'm laying my cursor on top of, to the left of it, that candle's low here, and the next candle to the right of this one, that candle's high. That is a fair value gap. It is a SIBI, sell side imbalance, buy side inefficiency. Notice that that is not what you see inside of the shaded area here. That was the weekly inversion fair value gap. So the price delivery continuum is when you have these higher time frame inefficiencies, regardless of whatever time frame it is, when you drop down to a lower time frame, you cannot ignore or forget the impact that those higher time frame inefficiencies will have on the lower time frame. The lower time frames you can use for precision, like refining risk and making it much smaller so larger positions can be assumed. That's not to say that you should take on larger risk, but let's just say for the sake of argument that you want to use a 1% risk model. That means whatever your equity is in your account, times that by 1%. Whatever that amount is, you can look at a range from where you think you're going to get in at, the entry point, and where you want to define your stop loss. And whatever that amount is, you divide that by the 1% equity that you define as your maximum risk that you want to incur. Having that, the math will tell you how many contracts or lots that you can trade and still be within that 1%. Using lower time frame charts helps you define that risk rather small. I mean, you watched me do it this week where I was using less than one handle on index futures. You cannot do that consistently in Forex. I promise you, you cannot do that consistently in Forex. The reason why is because Forex brokers, many times you're trading inside their specific pool of liquidity. And they have the benefit of being able to open the spread on you. When you're trading index futures, you're seeing the same price everybody sees. Everybody's high is the same. Everybody's low is the same. That's why it's a gentleman's market. In deference to the ladies, that's not a snub against you. It's just a more refined professional market. It doesn't mean that you can't trade Forex and use small stop losses, but don't fall into the trap that you got to do these ultra less than 2 pip, 1 pip stop losses. Because I'm telling you, if I ran a brokerage firm and I was a Forex brokerage firm, I would open the spread all the time on all of you. And I'm teaching you. So wouldn't they want to do it to you? Of course they're going to do it to you, especially if you're trying to trade size and you get frustrated. And when everybody was trading Forex, in the early 2000s, there was bucket shops all the time, and I got burned by several of them, and FXCM was one of them. Okay, and it's just they did it. They did things that were not good, and it's better now, obviously. But I don't ever talk about brokers. So I know some of you are hoping that I'm going to talk about what broker would you recommend. I don't do that. I'm not an introducing broker. It's for you to determine that. Okay, so I'm not in an affiliation with anybody, no brokerage firm, no funding accounts, nothing. And that's the reason why I'm point blank and sometimes not always the best person to talk about your company, because if I don't like it, I'm going to tell you. But I'm not going to sugarcoat something and say, here, I have an affiliation with this company, I like them. No. Whatever I tell you is the truth. If it's good, I'll tell you. If it's bad, it is. But I'm not trying to tell you to go with any broker. They all suck and they're all great. It depends on what your personal experience is. So there you go. There's my opinion. But these inefficiencies, these gaps from the higher time frame, you have to have them annotated on your chart. Now, in the future, you'll probably graduate to a point where I have them just on a piece of paper. Like I have a pad. I have a small little yellow pad that I work with all the time. And whatever market I'm following, I have those levels noted. What levels am I talking about? The highest high and the lowest low and the midpoint of every inefficiency on a higher time frame for that particular market. So we're looking at the dollar index. So it obviously is taking me more time to tell you what you're doing with this chart and what you're supposed to focus on and what you're supposed to utilize. But once you understand, it's like riding a bike. You'll go through the motions and it won't take this long to go through it. But the majority of the time, your analysis will be done on the higher time frame weekly chart. You'll be doing these things, looking at where is it likely to gravitate to. Now, rewind back to the 13th of June 2023, earlier in the week. In the live stream, I talked about how I felt that this shaded area here, the weekly inversion fair value gap, would then now act as an inversion fair value gap for the downside. In other words, it would act as resistance. We would want to see signatures in price showing a willingness for the dollar index to go up to it, treat it like a ceiling, reject it, and send it lower. Now, I am not a support and resistance trader. I am not a supply and demand trader. Okay, even though that shaded area may quickly look like, if you're someone that's traded with Sam Seiden's online trading academy and all that stuff, I get accused of using supply and demand all the time. It's not that. Okay, I use very, very specific levels, and they would never consider that gap back there on the weekly chart ever again. They wouldn't consider it anyway, really. But this is what I refer to. That shaded area, that pale orange range, I'm looking at the highest point of it, the midpoint, and the low. There's 3 specific levels there. It's not ambiguous. It's not like here's it's a supply zone. Okay, that's wonderful. Where are you going to trade at? What level are you looking at? So from I guess a grade school perspective, supply and demand may help some of you. Maybe you have been profitable with it, but it doesn't give you a very specific level to trade on. You have to determine where you're going to trade at. So it's like, here, in this general area, let's try to find something that's a buy or sell. What I'm telling you is that the algorithm itself will refer to one of those 3 price levels. Which price level do I use? Which one is it hitting at the time of the day that I tell you to look at it? That's where time comes in. So when I'm teaching you how the algorithm works, how it delivers price. It operates on time delivery. That means every price run is scheduled. Sorry, I know you probably worked in the industry for a long time, and you're probably cussing and laughing, saying this guy's full of shit. I don't see you out here telling everybody where it's going to go before it's going to go there to the infinite degree of precision that I'm showing. So I'm proving you. I can't take you somewhere on a field trip and say, here's where the algorithm is ran from. I can't take you to a place and say, here is where it's operating from. Okay? The only thing I can do is tell you the truth. It is there. It's running. It's delivering price all the time. It's completely manipulated. It's absolutely controlled always. And you shouldn't be fearful of that. You shouldn't be upset about that. You should be thankful that that is an advantage, because once you understand how it operates, you can exploit that. They're not going to change it, because the way that price is offered and how markets are traded isn't going to change. That's never going to change. So there's no reason for you to worry about, oh, this is a fad. It's gonna stop working because everybody likes to use ICT concepts. Folks, this is the market. The markets are, until they do away with the markets entirely, this is going to continue to work. So put that aside. Don't be afraid of that stuff. You're wasting time worrying about things that aren't even a factor. So the 13th of June, I said that I want to look for, and I anticipate rather, the market's going to go up into that shaded area, that's the weekly inversion fair value gap, and treat that as a form of resistance, and then gravitate down to, I said, this very candle right there. That down close candle, I told you, was a bullish order block. It's a change in the state of delivery. That's what an order block is. It's not every down close candle or every up close candle. It's not the things you see people talking about on YouTube either. Many of the things that people are saying about my order block, they're trying to use supply and demand logic, and it's flawed. That's not the same thing. Okay, it's not. I promise you, it's not. What's occurring here is at that candle's open. Okay, that candle's opening price was the only marker where price can be measured in this time frame where price was offered down. Where was the next down close candle? Right there. So between those two down close candles, if we're looking for a sell model to begin, which is what I was outlining on the 13th of June, where could we expect that to form? The fair value gap that I shaded and I told you on the 13th. It's an old weekly imbalance. So if we leave an imbalance, what was I teaching you on the weekly chart? The market can be efficiently traded back and forth, up and down. Think about that paint analogy. When you paint your wall, are you going to paint up the wall, and when the paint runs out of supply of paint on that roller, you're just going to leave the areas where the paint didn't make it, you're just going to go to somewhere else on another part of the wall? No, you're going to roll right back over top of it. Why? Because you want your wall to be efficiently painted, right? Well, when I look at price, I'm looking at where price has been, where it went to recently, and is there any pockets of inefficiency in there? And because I start my analysis on the weekly chart, why am I starting on the weekly chart? Because the whole weekly range is going to be predicated by what we anticipate on that weekly candlestick. What's it going to do? Is it going to go higher or is it going to go lower? And you only need to determine one of two things. It's going to go up for buy stops above an old high, or it's going to go up to an inefficiency, which is a fair value gap above market price. If it's going to go lower, it's reaching for some inefficiency, which is a fair value gap below price, which is what was being shown here on the weekly chart, but I did not talk about on the 13th, but I told you this candle is the order block I felt it was going to reach down to. And I highlighted that range right there. And I mentioned that there was a likelihood that we would draw down into that after we treat this shaded area up here as resistance. So we can take this idea and dig into the lower time frames and see if there is any signatures that we can look at a lower time frame. We'll look at an hourly chart now. Oh, right away, look at that. So if you look at what we've done, here's the 13th. Okay, so the market was meandering around in here. I said, I want to see price show a willingness to treat this gap here. Let me go up one more time because I want to make sure you're following along. In this little area right here, okay, I'm going to just draw one more rectangle because that way you can see our frame of reference. This high down to present market right there. Okay, that shaded area here is this candle underneath my cursor. That day, which is the 12th, from the 12th, and then the 13th is when I gave you the analysis. Okay, I told you it's a live stream. It was not a pre-recorded video. I told you I want to see it. Treat that weekly inversion fair value gap, which is this one here, which is anchored on a weekly candlestick chart. Right now, we're looking at a daily chart. You can track that by looking up here. So the 1 day is a daily. So in this range here, in my mind, I was seeing this delivery of price. This is what I'm anticipating. This is what I'm predicting. I'm not reacting to price. Okay? I see this forming and I'm articulating that in the live stream of June 13th, 2023. So because I have this range now shaded, when we drop down to the 60-minute chart, inside this area here, and I want to scrub that little rectangle over to the 13th, and that would be the perspective. Okay, so what we're looking for is in this area here, did, true or false, folks, okay, you're judging me now. I put out my expectation. I anticipated in this time here, before we closed the week, I said later in the week, going into Thursday and Friday, I believe, and I say this in the 13th live stream for the dollar index, I believe that we will likely draw down into this order block, which is that level right there, 102.705, right there. So I'm going to take this box off here so now we can see that. So this is where we're looking at. Did it use, whether you believe there's an algorithm or not, okay, did price use this shaded area as a means to dig into, go up into, and then repel it lower? I mean, I think there's sufficient evidence to suggest that what I was outlining and anticipating, price is doing that, is it not? It did it here. What time of day is that? Look at the bottom of the chart. That's Wednesday, June 14th, 2 a.m. What time of day is that in terms of ICT kill zones? That is the London Open kill zone. That's 2 o'clock in the morning to 5 o'clock in the morning, New York local time. Every single time you look at your time references, it's always in New York local time. I don't care where you live. It's no disrespect to you or where you're at, but the algorithm runs on New York time. The day, the trading day, is not defined by Wellington, New Zealand. Okay, I don't know where this idea came from, but it's straight up New York local time. That's the way it is. Okay, so everything runs on that. And if you keep your time relative to New York, and when your trading view set up here, you can see it's always set to New York. If you do that, you'll know when to anticipate. When to anticipate. When do these moves form? When do they begin? Where do the highs and the lows of the sessions begin and end? Within those time windows I've given you. Now, by itself, just knowing that the high or low of a market in Forex forms in the London session between 2 o'clock and 5 o'clock in the morning, that in itself is a huge advantage. Because if you can have a weekly bias determining that, okay, if we suspect that the dollar index is going to be bearish for the week to come, and forget the economic calendar for a moment because we're going to get into that too. If we think that the price is likely to draw down into these levels here, now I'm going to take that purple shaded area off because that's the weekly fair value gap that I did not mention, but I didn't need to because I took your attention right to that level there, which is the daily bullish order block. A daily bullish order block doesn't always mean it's an entry to go long. It's a draw on liquidity. Okay, it's a PD array that the market will want to reach into. Obviously, you can see that that order block did in fact cause a nice little run up. Where to go up into? Look closely. Where to go into? That same shaded area, that old weekly fair value gap, the inversion fair value gap, dimensioning of it being used as what? Resistance. So in here, we're talking about it. It's likely to go up. We're going to see it treated as resistance. Does it? Yes. Does it go down to the level I talked about on the 13th as a draw on liquidity or target? Yes. Then what does it do? It repels price higher again and goes into what? Look at these three up close candles right in here. See all that? Listen close. ICT, why do you use the last candle on some examples and other times you use the consecutive candles? Well, all of these are inside of this fair value gap, that shaded area, which is an old weekly fair value gap. If they're consecutive like this and they're inside that range, I'm going to use the entirety of all of that because the beginning of this opening on this candle here and the next candle and the next candle, that's all one price delivery for buy side. It's delivering buy side delivery. So that means there's movement up. So I want to refer back to that opening price right there because that starts the order block. And the mean threshold would be the middle of the low of this candle to the high of that one. And that would look like this. So we have the low of this candle up to the high. Mean threshold is 103.324. Okay, so we allow, listen folks, we allow for price to trade to and through, but not close, listen, not close above mean threshold. So the wicks do the damage, the bodies tell you the story. Look what's going on over here. See all that? We'll get to that in a second. Opening price, let me drop this here. It hits differently when you know I've already talked about it beforehand, huh? Oh man, I can't use a cherry picking analogy on it now. So here's mean threshold, so that's what I'm identifying here. But this level, that opening price there, that is the change in the state of delivery. Meaning, on the 13th of June, I stated that I want to see, you want to study, if I have any validity behind these things, if it's not going to hold up, if it doesn't react the way I'm talking about in the future, then there is no algorithm. That means that I'm a fraud. That means that there's none of these things should be even studied because it's all hindsight. Okay. So what I do is I tell you in the analysis where I think price is going to gravitate to. And then you as the student, you go back through price action and you look for what PD array you like. What does that mean? What's that mean? What do you use for your setup? What's your multiplier? Is it the optimal trade entry? Is that what you use to get into a trade? Do you use a fair value gap now? Do you use the 2022 model as your trade? Do you use breakers? It depends on what you feel comfortable trading with. There is no better PD array than another one. Because not every single price run will have every single one of my PD arrays in it. Not every single price move that I'm trading has a breaker in it. Not every single one of the trades I'm entering is using a fair value gap. Not all of them are an order block entry. Not all of them. Well, when's the last time you see me talk about an optimal trade entry? But you probably still trade them, right? I'm teaching you a wide spectrum of opportunities for you as the trader to gravitate to whichever one makes the most sense to you. All of them are equally profitable. All of them are equally capable of blowing your account if you misuse them. So I'm a realist. I have 81 ways to get into a marketplace. You don't need but just one. You just need one. And whatever that one is, you stick with it until you get really, really good with it. And then once you find consistency with it, if you want to graduate into something else and dabble into trying to build another model in addition to the one you find consistency and profitability in, have at it. But don't try to apply all of them. That's what everybody does wrong when they come to my content. They try to apply everything to every single market condition, and that's not what I'm teaching you to do. Now, if you go to Tom, Dick, and Harry's Dollar Menu Mentorship, where they take my stuff, rebrand it, and try to condense it down to a 5-minute trainer video, that's the perspective you're going to get. You're going to get a watered down approach to what it is I'm teaching, and you're not going to come to the real understanding of what it is that's available to you. These consecutive up close candles is one order block, meaning that inside this shaded area, right before this market changed and went lower, my eye goes right to that opening price because I'm using all three of these candlesticks because it's inside of a range I've already told you on the 13th. We want to treat that range as a inversion fair value gap. In other words, it's an area where the algorithm will go up, spend some time in there, allowing smart money, traders that will see what I'm teaching you that isn't in books. They're using this frame of reference because they want to sell short here and buy at a lower price down where the order block is here. An order block is not orders. You can't see an order block the way I'm telling you. You can't see that on level 2. There's people that say, oh, level. It's not level 2. It has nothing to do with the orders. It has nothing to do with it. Nothing. Okay? So stop the bullshit. It's where the market changes its state of delivery, meaning that inside this shaded area, We want to see the price go up into it. Does it do it? Yes. And then once this candle's opening price, that is the beginning of these 3 consecutive candles, and I'm using all 3 because it's inside the area I told you to define as the reason to anticipate price going lower from the beginning, right? On the 13th of June, I said, we want to see signatures. That means evidence in price delivery, in price action itself. Does price show a willingness to treat this shaded area as resistance? Does it want to send price lower when it enters into it? Where? The low, midpoint, consequent encroachment, and the high. We don't want to see the high end of an old fair value gap if it's being treated as an inversion fair value gap. The better setups form if the high, if you're looking at it as a resistance or using it as the beginning point or inception of a sell side delivery or sell program, we don't want to see the high traded to. Treat that like the same thing I treat a breakaway gap, which is a fair value gap that won't completely fill in. If it gives you that signature, which is what we're seeing here, as soon as price breaks below the opening price here and leaves the shaded area that's in like a pale orange, once it does that, that qualifies that right there as a bearish order block. Why? Because the state of delivery changes from buy side delivery, then it crosses over the opening price there. Just because it crossed below an opening price of a series of up close candles doesn't make it an order block. The narrative behind where that order block resides, that is the imperative point that everybody is missing. That's why everybody has books and bullshit out there they want to call mentorships and courses talking about this is an order block. You have no idea. You're making shit up. You're making it up as you go. You're on the fly. You're looking at something in hindsight, trying to explain something. In this shaded area is what I told you to look at it on the 13th. And then we look for signatures inside that range. What does that mean? Well, you have an order block here. You also have a breaker. What? There's a breaker there. High, low, higher high. Consecutive down close candles. Same thing we're applying here. All these ranges here, push it forward in time. You're getting the same entry here. Stop above here. We're not trading the dollar index, but I'm trying to tell you that you can pick your own model, and every one of you can be trading differently using what I've taught, and you all can find profitability. You don't need the same entries. The entries are the least important thing. I'm going to say it again. Where you enter is the least important factor in consistency. It is the least important thing. You have to know this. Where is it going? Because if you can determine where it's likely to go to, and what is what I've outlined here in this beginning of this presentation today, you can find a myriad of entry points. When price returned back up into this low here, right there, you can be short. What would you anticipate? This rejection block, which is the lowest down close, that's your first draw. Below it, sell side. And then you can start doing projections on all this price run here, lower, to see if it wants to dig in lower. It's Friday. It's already hit the mark here that I outlined and called for on the 13th of June. You can use this as an entry going short. Well, look at it. Look what it did, Michael. It ran up here. Yeah, I know. But you're trading with a higher time premise, meaning you're entering here. Where's the model call for a stop loss? It's got to be above that high. If you're using the last up close candle, the same thing. You don't get short here, but you can be short here. The stop's got to be above here. We're not using the dollar index as a tradable vehicle. I'm just teaching the logic that you're applying to whatever market you're trading. Whether you're trading the breaker, which would have been a fill here or here, price alone, that's the instances where price returned to the PD array. Now here is where you separate the men from the boys and the lions from the sheep. Time. just because price went up to that level right there. At 2 o'clock in the afternoon, are you factoring a great deal of emphasis on a late afternoon dollar? No. You want to focus on the relationships of what the dollar's doing during key kill zones. Dollar is going to be highly sensitive to Forex. S&P, NASDAQ, Dow, it will use the longer term, higher time draw of risk on, risk off with the dollar. But sometimes, and this is where it makes it a little bit difficult for some of you, the index can flex against that. But you don't see that with euro and cable. Unless dollar's being manipulated, held in consolidation, which it's not being here. It's being allowed to move, gyrate, move around. That means that your Forex pairs can be free to move around and have a lot more volatility as well. So if there's a emphasis on dollar usage in your analysis, just know that there is a much more impactful driver of price when you're using dollar when it comes to currencies. Longer term, yes, dollar risk on, risk off will eventually weigh on stocks, but stocks are also highly manipulated right now. They shouldn't even be at these levels. None of these companies should be trading at these multiples. It's ridiculous. But we have to stick with what the market's showing us if we were trying to make money. We're not trying to be predicting the crash, okay? I mean, in my opinion, the market should have crashed dozens of times, in the last 3 years. It should have, but it hasn't. And even though I know, and everybody with a common sense knows that these markets in stocks rather, they're not justified at the levels they're trading at. But are we going to sit around and arm wrestle what should be taking place from a practical sense versus what can we take as an opportunity? Because we have to trade what the market's giving us as opportunity. And that's what I'm teaching you to do. Focus on what is available based on time. Now, we have the market run up into during Wednesday at 2 o'clock. What's going on there on Wednesday? We had another market event that day, big calendar event, medium impact, high impact news drivers. We can anticipate on that weekly chart where the inception of the majority of manipulation will begin based on the calendar. So when we look at an economic calendar, we're looking at a medium impact or a high impact news driver, something that's going to be many times used as a smokescreen. I'm not of the opinion, I've never really had this opinion anyway, but I'm not of the opinion that because it's a high impact news event, that the market's moving based on that information. That is sometimes, in the way you could study this is go back through history and look at the releases of the data. I'm not a fundamental trader. Okay, I don't consider the information that's being released at the time. I never even refer to it. I never look at what the numbers were. I've done it in the past when I was teaching mentorship, just to prove to them that sometimes the data will come out, and from a classical perspective, the data may be perceived as good or bad. And if it's suggested in historical terms that whatever data that came out, if it's beneficiary or a positive for that currency or that market, but then how many times has the market rejected that and traded down, and then they come back after the fact and say, well, the market already priced that in. You weren't telling us that they already factored in that and priced it in. It's just an excuse because these things are being used as a smokescreen. So I just use a high impact or a medium impact news driver on the economic calendar to time, just like a TV guide. You know when time the game's going to come on, right? You go on there and you look on your TV and say, okay, the Knicks are playing today at this time or tonight at that time. The Super Bowl begins at this time on this channel. The markets are delivering price the same way. I know it sounds crazy. I know, but that's how I'm accurate. I'm following the schedule of when price is likely to move. And you can time when these market moves are going to occur, just simply looking at the economic calendar and blending in the key times of the day I've told you to focus on. All New York local time. So 2 o'clock on Wednesday. Where are we at here on Thursday? What time of day is this? London Open. London Open typically forms what? What did I teach? If you've been with me for a long time, between 2 o'clock and 5 o'clock in the morning, New York local time, London, generally 70% of the time, and for the folks that like to do these little number crunchings, I have people in the past say, well, that's bullshit. I went through the number. You're looking at every single week. You have to look at when the bias is suggested that we're going to entering a sell-off. Okay, if we're in a position, and I've told you on the 13th this a week, I said that dollar's going to go here. We went there. Now your question is, you're like, well, how would you know that it wouldn't just reverse here and treat that as a long-term bullish order block? I know I just read your mind, right? You just dropped your potato chips, didn't you? Longer term perspective, we've already spent time reaching into premiums on that weekly chart for the dollar. We met multiple premium arrays as targets on the upside. And we've worked all of any inefficiencies out. And now we've worked into the discount arrays. So it's reasonable to anticipate that the dollar wants to go lower. We still have time. It's Friday. And everybody that sees this low here that went long, they're trying to catch the bottom. And that's why you're seeing what we're seeing here. We traded down into this low, deeper into the order block. What order block? Let's go back up to the daily for a second. This entire down close candle here, that range is the order block. If we're bearish, we want to see it trade initially into the open of it, because that's this change in the state of delivery. And then we want to see it try to reach for the mean threshold. How we know if it's going to continue going lower is how we close after hitting mean threshold. That's part of order block theory. If it closes below the mean threshold, chances are we're likely to see it want to continue going lower. If it were to go lower, we have a small little portion of this gap that's being shown from this candle's high and that candle's low. Looks like that. So that little gap right there, that's a small little area that's still exposed. So if we were to close below this middle of this candle that I'm highlighting here, that's the bullish order block. Wait a minute, you're calling it a bullish order block and you're calling it lower. Right. When it was up here earlier in the week, it was a discount array, but it's classified as a bullish order block. Again, bullish order blocks are not always buying opportunities. They're targets, and are also means of measuring order flow. If we close below the mean threshold, half of that candle's body, if it closes below that, it is indicating that it might want to still keep going lower into next week. And if it does, where would it reach for? Sell side below this candle's low. Let me move it out of the way, I'm sorry. Below that candle's low and into that small little inefficiency. And if it accelerates, we have another fair value gap right here. The candle I'm pointing to is a fair value gap in the form of a buy side imbalance, sell side inefficiency. Look at the candle to the left of the one I'm highlighting here. That candle's high to the left and the candle's low to the right. That makes this a fair value gap. I don't know what we're going to do over the weekend. This is why I don't trade on the weekend. I used to trade over the weekend. I used to hold positions over, but because of the gap risk, what does that mean? Where we close on Fridays and where we open up on Sunday can be dramatic now because of all the things that's been going on over the last 3 years, and we're not going to talk about all those topics. But the nonsense that's been going on all around the world, all the geopolitical things and health and welfare issues that everyone's having to deal with, they have caused a great deal of gap risk. So most of your trading, in my opinion, should be settled intraday. Unless you're really, comfortable with gap risk. Even the restart at 6 p.m. when there's a lull in trading, for 5 o'clock to 6 o'clock if you're trading stock indices. Sometimes those gaps can be a little bit jarring, and it can be a little bit more than you anticipated. Sometimes it's in positive, but sometimes it can be in negative. So I think if there's ever been a time in history where traders should be primarily focused on day trading, we're in it. This is the climate for that, to be sleeping soundly at night. So anyway, I covered a lot here, and I'm going to go lower time frame. We're going to go to a 15-minute candlestick chart. And we're going to take a 10-minute pause here. So right now at the time it's 9:53. I went a little bit longer than the hour. I apologize, but that's typical ICT and always over deliver. Let's come back exactly at 10 o'clock. It's not quite 10 minutes, but let's take a break. You can go relieve yourself, refresh your drinks, and go tell your wife and husband that you're learning something and you can't wait to get back to it. So I'll see you in a few minutes. All right, folks. I'm checking Twitter before I start talking. I want to make sure that you can hear me. We've taken a couple minutes break. If you guys can hear me, just give me a 5x5. That audio is back. Again, just checking to see if Twitter can confirm you can hear me. Thank you, Emmanuel. Thank you, folks. Appreciate that. All right, so usually I like to ask you all to give it a thumbs up and such, but if you like what you're learning here today, and we're not even close to being done, just give this a like. It doesn't cost you anything to do it. Just a little quick little thumb. You're going to want to use this as a marker to go into your liked videos to find this one. I promise there's a whole lot of stuff in here you're going to enjoy. All right, so back to the discussion. We have just made our way into the 15-minute candlestick chart for the dollar index. So obviously I'm taking you through a very detailed top-down analysis of what it is that you look for whenever I talk about where I think the market's going to draw to. That's my experience in 3 decades of knowing what I've seen over the years, what the algorithm is likely to be doing unless manual intervention steps in. These are the things that we expect to see. And that's what makes what I teach and what I share and what I call in advance so accurate. A lot of people that have odds against me because they're running a service, paying paid service, something they're selling or whatever, they'll say what I do is easy. Anybody can do it, but they're not anywhere near as accurate. They don't call the levels to the degree. They don't have the experience I'm sharing with you. And all I'm saying is if you listen to other people and you haven't spent time here seeing what it is that's being shared and taught, you really aren't making an informed decision. You're just using someone else's opinion, and that's the mistake, or I guess trap of social media. So with that said, let's get into the nitty gritty here. All right, so we have the dollar index on the 15-minute time frame. We've been talking about this weekly inefficiency that was a weekly inversion fair value gap. I stated on the 13th of June 2023 that we would look for signatures that this is being utilized by the algorithm for resistance. Now, when we look at the dollar for Forex traders, you're really going to be focusing on like the London Open Kill Zone, the New York Open Kill Zone. And again, for the London Open Kill Zone, it's all New York local time. It begins at 2 a.m. and ends at 5 a.m. Now, I personally, I use 1 a.m. as a buffer. And to me, that kind of like cancels out any tomfoolery that would occur because of daylight savings time, which I wish they would abolish it. I mean, it was the stupidest thing to implement anyway. In some parts of the world, they don't even use daylight savings time. But to remove all the uncertainty about time, I've always used, my personal is 1 a.m. to 5 a.m. Okay, that's the time. So that means any setup that I like to look for can occur that early, which is kind of like the European Open. And then you have at 2 o'clock, it's the London Open at 2, and it usually closes up shop and the volume peters off at 5 a.m. And in between 5 o'clock in the morning to 7 o'clock in the morning, I refer to that as dead time. Don't try to do too much anything in here. But I have taken trades as early as 6 o'clock in the morning, trading the New York session or the New York Open Kill Zone, which is classically defined by 7 o'clock in the morning to 10 o'clock in the morning. And you can look at 7 o'clock to 9 o'clock as that little sweet spot where the majority of your trades are going to form buy or sell for Forex trading between 7 o'clock in the morning and 9 o'clock in the morning. The London Open, I talked about this moments before we took our first break. At 7 o'clock, I'm sorry, at London Open at 2 o'clock in the morning and 5 o'clock in the morning, New York local time, that is the ICT London Open Kill Zone that if you know where the weekly candlestick is likely to draw to, everything I've been talking about up to this point, is how I do it. There is no shortcut version of it. It's just the market's going to go up to a gap, or it's going to go up to an old high. If it's going to go up, if it's going to go down, it's going to go down to a gap below price or go below an old low. That's it. How you define which one it is what has it done recently? How has it traded? Is it leaving a range that we've worked multiple times back and forth and it's been efficiently delivered, and we left that range? Chances are it's probably going to expand lower, reaching for an old low or inefficiency in the form of a fair value gap below price, or reverse it. I mean, it's that simple. And what you're wrestling with is you're trying to bring other things that you either know you learned from somebody else, some kind of other indicator-based idea or retail perspective, maybe supply and demand, maybe Elliott wave, maybe harmonic stuff. You're trying to bring that into this and see where you can help your understanding by bringing that in. And that's the mistake. Leave all that stuff at the door. Like, what I'm teaching is not complicated. It's either going up or it's going down for one of two reasons. And if you spend the time on the weekly chart to define that, you can come away with what I've shared many times for years in the witness of hundreds of thousands of people. And they're watching it pan out. And if you're new, you're now just discovering it. And I envy you, because I know what it was like when I first discovered it. It's crazy. It literally is mind-boggling to see how much precision, and everything is scheduled. Like, every price run that you see in price action is not a surprise, unless it's a wartime event or some kind of event that would be destructive. We'll say it like that, or a manual intervention coming in like a surprise rate announcement. It's happened. Those things I'm not prepared for, and that because of that, it incurs risk, and that's why you have to always understand that as good as my stuff is, and as good as anybody else's stuff might be, and people can show profitability and show statements and show live streams, and they can do this and do that, it does not change the fact that any one of us, me, somebody else that's teaching, selling courses or whatever, any one of us can be a victim of some unexpected event that can completely take everybody by surprise. And I use the analogy many times with the depegging of euro and the Swiss franc, where brokerage firms immediately were made insolvent, and people lost their money. They lost money. Billions and billions of dollars were lost that day because of that depegging between the euro and the Swissy. So did anybody see that coming? Did anybody warn you in advance about that stuff? Chances are probably not. So that's real risk. And all of these markets have that kind of risk. So is it something to be mindful of? Yes. Is it something that paralyzed you and never, allow you to go in and trade? Well, that's up for you to decide. Okay. I don't tell people to trade with live money. You'll determine when you're comfortable doing that. I don't ever sit down and say, you're ready to do it now. But I know the ones that aren't. So if you look at the range here, we're going to measure the high. I'm trying to find a point where I can lay it on the low. Okay. So we can see that the highest point here, and it might not be the very pipette, I could care less about that, but the low and the high, I've dropped the Fibonacci on that. And the only thing I'm using the Fibonacci for is to show you the relationship of the three specific price levels that I teach my students to look at. So if we're looking at the high, okay, I'm trying to see what that number is here. Okay, 103.445. The low, 103.226. Okay, they may or may not be the actual high and low of the weekly candles that are used to define that range, but I think this is close enough for government work. So the midpoint is 103.336. The midpoint of any gap, that being a fair value gap or a real liquidity void. A liquidity void would be like this little area right there. See, there's no overlapping of any wick or candle body. It opened here and it closed here. There's no price data here at all. That's a real liquidity void. That's a real gap. We refer to things like this here as a fair value gap, and this would be in the form of a buy side imbalance, sell side inefficiency. This is a real liquidity void. Any gap, whether it be liquidity void or inefficiency, or like I have it shaded here up here, they're measured from the highest high and the lowest low of that respective inefficiency or gap. And the midpoint is always referred to as consequent encroachment, meaning that as it starts to fill in and reprice to the high or low of these levels, as it encroaches, it's most likely to refer to the midpoint of the gap or inefficiency than the extreme high or the low. And that's the basis of why we like to see, if we're bearish, we want to see the upper end of the inefficiency or gap respected and treated as a premium and not be dug into. Meaning, as I mentioned before we took our break, we don't want to see the high end of any inefficiency be retraded to if we're bearish. If the market is really, in fact, in a sell model, the best ones, the strongest delivering obvious runners, will always have this signature hallmark part to it where the upper portion of it doesn't get traded to. Look at the bodies of the candles. We have just a little bit of movement above it here, but look at these right there, right on that midpoint of that. You think that's random? When I talked about it on the 13th of June in that live stream, I said, I want to see, does this show signatures in price action that confirms, it suggests that my assumptions, by anticipating this level that's shaded in a pale orange, that would be treated as resistance or a means of beginning short trades for smart money. And in targeting this level down here, which is the bullish order block on the daily chart. So in your mind, as a trader going forward, whenever I say things like that, or I say, I'm looking at this as a premium array, I want to see it be treated as a resistance and enter a sell program, and I point to where I think it's going to go. Right away, in your mind, you start thinking, okay, he just told me where he believes with 30 years of experience, where it's likely to go. So I just told you bias. I cut through all the bullshit. I got right to the point. If I sat down with you and taught you every single week what I'm doing, you like, first of all, I would never get that. We're still in dollar. We just finally made our way into the 15-minute chart. It does not take you this long to do the analysis, but it does take me this long, and as long as it's going to take today, for me to teach you what it is that's going on in my mind to make the decisions to tell you before it happens, and it happens in your chart later on perfectly. You want to know. You show up. You want to ask me these questions, and I'm giving you the answers. Don't bitch at how long it takes me to give it to you, because it's not an easy, and you get the information. Like, you have to weigh out a lot of things, which it's not an easy 1, 2, 3 program. There is no easy 1, 2, 3 precision out there outside of this. There's things you can make money with, but you're never going to come to the conclusion that I'm showing you as consistent as I am with anything else. This is the market. So when you hear me talk about in a tweet, a Twitter space, or if I share the analysis on a presentation, whether it be live streamed or a recorded review, and I give you an opinion about what I think it's going to do next, that's the time when you start paying attention the most. Okay? You want to say, all right, he anticipates me, ICT's, telling you that we're expecting to see this area that's shaded be treated as an inception of a down move. And terminus, the end of the move, the low-hanging fruit, that's all I'm stating when I say that. It doesn't mean it's the end of the line. It can't go any further than that. No, I'm telling you how to frame a setup. Every element that makes up a trade has to have several factors. It's the inception of a move, where it begins, but by itself, there has to be some narrative, reason why that trade should even form, which is what I've spent all this time thus far explaining why we're seeing what we're seeing in the chart right now, which is what I outlined and told you was going to happen on the 13th of June. You look for, in time periods of the day where I teach you as kill zones, London, 2 o'clock to 5 o'clock in the morning, New York local time. If we have a bias, okay, for the number crunchers out there, If we have a bias that is indicating that the market is likely to expand lower on the weekly chart, that means the candle is going to expand down. Right away, 80% of your bias problem has already been solved by itself with that alone. But you have to wait for all the calendar events to either support or negate the idea. So we had a series of what? Big news events, big news drivers this week. FOMC, CPI, all those things you watched me and showed you how to navigate them. Not to trade ahead of them, but after you see that information come into the marketplace and all the sentiment shift that they create. We're not looking at the data. We're not seeing what the raw number suggests. I could care less. I never look at that stuff, folks. It's never a factor. But I'm anticipating the medium or high impact news driver to create and present volatility. And in that volatility, we're looking for where does the stops rest after that first initial move? Where do stop losses reside? Above old highs or below old lows? Where are those highs and lows? We don't know where they're going to form before CPI. We don't know where they're going to form before FOMC does its first move. We don't know where non-farm payroll is going to use the high and low that it creates after the initial run at 8:30 when that news driver comes out, which is the reason why I tell you as my students, don't trade those. You don't know what you're doing. I don't know what they're going to do. They could manually intervene and send these things wherever. That's gambling. I'm not gambling. I'm not trying to inspire any of you to try to throw darts and see if you can get a bullseye where there's no skill involved. It's happenstance if you make money, but mostly you're going to lose. So what we do is we wait for that initial manipulation to come into the marketplace that you can schedule and set your watch to, and it's all on the economic calendar. The economic calendar is going to tell you the time of these reports that are coming out. The market is not moving because of the report, period. Okay? That data, it's in an envelope somewhere, okay? Weeks in advance. You think that the people, the powers that be that really are greedy, you think that they're waiting around for that same amount of information that everybody else is getting? No. No. So all of this is a lie. It's a myth to believe that fundamentals can be timed on a report release. That report being released is a smokescreen. And they're always going to use these as a justification for, okay, the market reacted to this data when it works in the favor they try to say it is. But when it doesn't, they always say, well, the market priced it in. And I was mentioning that before we went into our break. So when I tell you where I think the market's going to react, okay, that's a key point of reference in either the market I'm talking about or a specific time frame. So we were working with the daily chart, which is where most of your decision making for either a day trade, a short-term trade, or whatever, the bias is derived from the weekly chart and where it's likely to draw to. That's it. Then you're moving on to the daily chart. And the daily chart is you're watching and monitoring how each individual daily candle forms. If you're bearish, as we've been expecting since the 13th of this week, we want to see how does price gravitate to this level down here, which is that bullish order block. So each individual day, we have to weigh out, does it run into that shaded area up here, which is what I outlined this. We want to see, does the algorithm offer price there? And if it does, once it enters it, at what time of day? Well, what market are we looking at? Dollar. So primary interest is nailing down the high of the day. Where is the high of the day going to form in a market that is trading at a level we expect the price to react to? So we're expecting the inception of a down move between one of three levels in here, right? No. Midpoint or the low of that shaded area. Remember what I said. If we're bearish, every inefficiency, if we're going to use it as a basis or a framework for a trade, we want to see in a premium array that's going to be used to sell off and send price lower, we don't want the upper portion to be respected. Because if it doesn't get up there, like we're seeing right here, that's really indicating that this is going to be a strong probability. For what? The trade down to and through that order block. Time of day now, okay? Got this fancy kill zone indicator right here. I draw off my annotations out, folks, by hand. I know that you like to have these little gizmos that do it, but nothing beats high touch over high tech. It makes it more meaningful to you. It's like meditation for me, and it's a little tedious sometimes when I have to do a whole lot of annotations, but when my heart's in it like this, I don't mind doing it. So here's London Open, and we're dealing with the dollar index. And I mentioned on the 13th that we would want to see the price of dollar go up into this shaded area, which is the old inversion fair value gap on the weekly chart. So we've taken that weekly chart fair value gap and transposed it to all time frames lower than it. So that way, whatever annotations you put on your weekly chart, you want to make sure that you show that annotation on all time frames. And how do you do that? You highlight the array that you're annotating on your weekly chart, and then current interval and below, or all intervals is basically the same thing. Then you'll see it on every time frame when you go through your higher time frame weekly, daily, 4-hour, 8-hour, 15-minute chart, 30-second chart. It'll always be there. Okay. Inside this window of time that begins at the left side of that London Open Kill Zone annotation box to the right side, in this area is when the trade begins, when the shift in market structure will occur, when the high of the day forms. 70% you have a probability that the high of the day will form between 2 o'clock in the morning and 5 o'clock in the morning, New York local time. But you have to have the other ingredients. You can't just simply say, okay, highs and lows, let's run some numbers and calculate, does the high of the day form on 2 o'clock to 5 o'clock on this day, this day, this day? No, you have to have the narrative in mind. And I gave it to you on the 13th. I told you what to use, this shaded area. My longer term students to know that if we're bearish, we don't want to see all of the inefficiency respected, which is a breakaway gap if it's a fair value gap. But we've already worked inside this range already. But now we're treating it as a resistance. That means it can trade up to the low and reject and go lower, or we permit our analysis to see price trade up into the midpoint, which is consequent encroachment right here. So I'm going to take that level off. Here we go. So when we're trading at consequent encroachment here, and it's in London Open, we bump the high. We want to see price do what? Showing willingness to want to go lower. Does it sharply leave once it trades up in here, hits the buy side here, and then all of this back and forth movement that I'm showing you right here, all this here, price is spending time in that range. Is it efficiently delivered? Yes. Why? Because it's moved up, down, up, but it's only keying off of the levels I told you to focus on inside that shaded area. Consequent encroachment. We want to see, does it reject after bumping the high here? Yes. Once it leaves that shaded area, how did it leave it? Energetically? Yes. So now, enter model 2022. Buy side taken here. Shift in market structure there. Fair value gap there. I know. Corners of your mouth is hurting now. It's funny, ain't it? how this stuff just keeps randomly happening. All right, so we have our shift in market structure. We have our fair value gap. And then over here, what is this? What time of day is that? 8 a.m. So you're in the heart of what? New York open kill zone. 7 o'clock to 9 o'clock. That's your little sweet spot. Your setup is going to form for continuation. You hold down control and drag. By the way, in case you want to know, I learned that from my students. All right, 7 o'clock. It can be left at 10 o'clock, but I'm going to show you the, oops, don't want to do that. A.m. And this is New York. Okay, so inside this little window of opportunity here, you're focusing on what? We've already worked up inside that consequent encroachment here. We've already seen the evidence that it wants to reject that. We have a shift in market structure. We have a fair value gap. And the market rallies up into what? Time of day. That's when the move is going to happen. New York local time, 7 o'clock in the morning to 9 o'clock in the morning. That's your New York open ICT kill zone. This is the London open kill zone. This is your premium array. The range is from this high down to that low. That's the lowest low. Here's 50%. A premium is at or higher than that. Does that fair value gap qualify as a premium array relative to that high and that low? Yes. Is price returning back up to that shaded area? Yes. Where specifically? The low end of it. It doesn't need to go back up to consequent encroachment. Oh. Consequent encroachment. It showed the signature that we would look for. It left the upper portion untraded too, again. Worked off the low of that gap. If you don't have these levels on your chart, or have them at least annotated in your notes that you're referring to throughout the day, now in the beginning, you want to definitely have them in your chart because it's going to take you some time to get used to seeing the market like this. But over years and years of time doing it, you'll be able to work off of a notepad and you won't have anything on your chart at all. It'll be a naked chart and it's okay. But it takes experience to do that. Okay, and obviously you can see how quickly, if you're not organized, you can get really, really lost working from one higher time frame down to the lower time frame. But by having the higher time frame logic and all these reference points in mind, suddenly these mystifying moves that come out of nowhere for you, and you don't know where it came from, and everybody's on social media saying, what the hell just happened? Where'd that come from? We don't have that here. You know, in this community, we come across as arrogant and many times as narcissistic because we know what the fuck we're doing. We know exactly what we're looking for. We know exactly how it's going to form, when it's going to form. And when we take it down and we share it with our tribe, the people on the outside, they get pissed off. They think, oh, they think their shit doesn't stink around here. Well, it doesn't, baby. It smells like roses and chocolate chip fucking cookies fresh from the oven. Whether you like it or not, I don't care. You don't have to stay here. But this stuff repeats every single week. Every single week it happens. Every single week. Now, every single day is not the same in terms of opportunity. Sometimes you'll see setups that are much more favorable than like we're seeing in lesser volatile days. But when we anticipate a direction in the marketplace and it's derived from a higher time frame weekly chart using the logic that I teach my students, that I've been teaching now publicly on the YouTube channel, it gives you the framework for one shot, one kill setups where you can get in and take a lion's portion of the weekly range out. It doesn't mean you're trying to get the entire weekly range. It just means that you need a small piece of it that will satisfy you. And if you consider like a chicken bone, I use this analogy a lot. Do you eat the small little scraps on the ends of a chicken bone? I mean, if you're really a fan of chicken, I guess you do. But when I ate it, I just took the meat on the one thicker end of it, and then sometimes there'd be something left on the bone. But I'm taking the majority of it off. I'm not worrying about starting the eating process at the end of the bone, regardless of what end it is. So I'm looking for where the meat of the move is. And my concepts have been aimed at trying to get you to where the meat is. But you don't need the highest high and the lowest low, but I teach you how to find that too. So if you want to nitpick and get in like you're eating crabs and dig into all the little crevices and nooks and crannies to get every little morsel out, that's what my mentorship does. It's for freaks that want to be like that. I'm a freak. I like to know everything. I like to be in everything. I'm a control freak. I want to know everything. I want to know why it's going to happen, when it's going to happen, when is it going to fail, how will it fail. And because I know those things, I know when not to tread in the marketplace. I know when not to touch the marketplace. That's what makes me consistent. That's what makes me better than everybody else out there, because nobody else has spent any sufficient time trying to define where they're likely to fail, because they're so focused on trying to find how they can be better and right and profitable all the time, and think that it's limited to whatever their stop loss is and that's all they need. No, I want to know when the market can trick me. Even with my content, there are times that if I don't know by experience, and I had to learn this, with decades, there are times that even though I believe that my analysis concepts are superior to everything and everything that ever will exist, because it is the market, it's tied into the algorithm. I can, as the operator, you as the operator, you as the user, you will read into price like a Rorschach, an ink blot. You'll see something that you want to see. And many times social media will cultivate that atmosphere where you get mad, you get jealous, you can get competitive, you can get offended by somebody, or I'm going to show him, I'm going to show her, or I didn't do as good as that person, let me just try to outdo them. And you go in and you try to find something as a reason to get into a trade. We don't do that here. We do not do that here. You have to stick to the rules, time and price. Where are you at in that weekly outline that you spent time on when the market wasn't trading, after Friday's close and before Sunday's opening? Wherever that is for you. If you're a churchgoer, whatever, find some time in the weekend. If you want to have a day of rest and you want to observe the Sabbath, I don't tell you what day to use. You have to have one day of rest, period. Don't let anybody tell you what day it has to be. Just one day. Don't do anything on the market that day. But between Friday's close and Sunday's opening, you have to find time to sit down and meditate on that weekly chart. What is it likely to do? What momentum is presently in play? And what is it gravitating to? And by framing those ideas on that weekly chart and transposing them to the lower time frames, suddenly everything jumps off. And it means so much more, and it's much more clearer to see what it is that you've missed all this time. All right, so the idea of how far price runs can go, I'm going to use that here. Just for a frame of reference, I'm going to go back up to the daily chart. I'm going to encapsulate that entire down close candle here. We'll use a yellow. I don't really like yellow, but all right. So that's the entirety of the bullish order block, and the expectation is we want to see, does it want to gravitate lower and get into this area down here? Okay, and I'll hold off. I'll reserve doing that. You just have that on your chart as well. I'm gonna drop down into a 15-minute chart again. I know it's ugly, but this range is the entirety of the order block, and the expectation is we want to see it trade down to consequent encroachment and go below it. We want to see that weakness, that heaviness, because we want to see the move protract further lower, which would give momentum to being a long holder to stock index futures and foreign currency. This move right here, this move right there, that is your trigger swing. That's the measuring point for what you want to see for protractions or Fibonacci extensions. You take your fib, you anchor it, draw it down to the low of that price swing. Okay, I'm going to show you where my settings are again. I've done this in the past. I don't need them. And we'll put standard deviation 3 and 2.5. So here's where we're at. Close it. So we have a high to low, and the entirety of that daily order block is shaded in yellow. Notice that that Fibonacci extension negative 2.5, which is 2.5 times the range of the low to the high here. This is all I use a Fibonacci for, folks. That's it. Okay, I'm not in here looking for bat patterns and crab patterns and butterflies and all that stuff. I'm looking at math. Okay, that's it. This is the range that matters, and there has to be a confluence of time being London close. London close begins at 10 o'clock in the morning New York local time and ends at noon. There is a buffer I add to it. When there's a big runoff day, it can extend into 1 o'clock. It's far and few between. If you use just the 10 o'clock in the morning to 12 noon New York local time as your London close kill zone, it will serve you well. Okay? Huge step forward, Eddie. Watch. At 10 o'clock in the morning to noon, I hope you're having fun with this. I'm loving this. Should have charged admission. London close. Okay, so there's your London close kill zone. This thing's in my way. Kind of pisses me off now, actually. So now here's what I want you to look at. All right. These mysterious markets. Okay, we want to know where price can begin a move and where it can gravitate to. Where is it drawing to? It's drawing liquidity. And we want to frame it in the form of a low-hanging fruit terminus. The inception of a move can be timed. The inception of the move can be determined within a specific price level or within a range like an inefficiency. And in that range, there's 3 specific price levels. 3. That 3 levels is used on a basis of whether we're bullish or bearish. So as I was mentioning earlier, we were expecting this shaded area up here on the weekly chart, that old inversion fair value gap, to be treated as resistance. The algorithm would trade up into it during time. Notice that it reacted here. This is the essentially the midpoint or consequent approaching of the entire range. But look at the time of the day. It's 1 o'clock in the morning. That's European open, yes. But the heart of the move, and what I teach by rules, is the high and the low of the day is formed between 2 o'clock and 5 o'clock in the morning. When we get here at 2:45, we're doing 2 things. Number one, we're bumping the high. So anyone that went short up here on dollar-based ideas in long foreign currency, I'm tempted to put the euro up here real quick, but I don't want to mess up the chart before I finish what I'm deciding. But we'll come back to this here, okay, in a second. But during the London open kill zone, then it creates the high. You have a 70% probability of the high forming when you're bearish, when you're expecting the market to deliver, as I outlined on the 13th of June, 2023, going to a level I've outlined on the 13th. This level right here is your low-hanging fruit objective. That's not the end of the road. It means that you frame that idea of taking a trade with this as your draw on liquidity. But every single trade I enter, I always look for some kind of a best case scenario, something more than I expected. Okay. Many times I don't ever get that. Sometimes I'll get stopped out. Sometimes it just simply doesn't give it to me, and I change my opinion or mind about where I'm at, and I collapse the trade, or I take too many partials off to justify holding on. And it's an evolving thing, and that's one of the weaknesses I've been very candid about. My exits are always a work in progress, and I've been doing this for 3 decades, so I'm not satisfied. My entries, if I never develop another entry strategy, I'll be fine. I got 81 of them, but you only need one. You only need one of them. So if you were to look at a breaker here, you have a high, low, higher high. Extend the breaker over, you'd be entering short there. If you're using optimal trade entry, okay, I had the fib up earlier. Let me do it again. If you're just using the old flagship pattern of my YouTube channel. And this one's going to come off. All right, so these two blue lines here, that is the classic ICT optimal trade entry, which is a standard 3/4 pullback. That high to low, it trades up into, I'm quite certain that's probably 70.5, which is the sweet spot that I teach on optimal trade entry. If you want to watch anything about optimal trade entry, if it's piquing your interest, I have many videos in this YouTube channel. Just do a search on my channel for OTE, optimal trade entry. That trade up into that right there is perfect. And it's just a beautiful run from there down. So you could use that as your entry pattern. Okay, entering on the fair value gap here, which is the 2022 model. So right away, there's 3 ways of getting in it. There's 3 different models to get in that same price move. Which one do you like? It's a matter of preference. But we have this run here to here, and we have a standard deviation of negative 2.5, which is just outside the scope of the entirety of that daily bullish order block, which is that shaded area in yellow. And you take it back up so that way you know what I'm referring to. This down close candle here on the daily chart, right there, that I mentioned on the 13th, that full entire range. As soon as we start moving past midpoint, which is mean threshold, an order block's midpoint is mean threshold. Any inefficiency or gaps midpoint is consequent encroachment. The mean threshold here, if we trade through that when we're looking for lower prices and such, that really bodes well for leaving something on like a partial. But it's Friday, so I've already told you I don't want to hold anything over Friday into the weekend starting up on Sunday because of the gap risk that is available now because of everything that's been going on in the world. So anything can happen, and cause a major sentiment shift where we start trading from where we ended trading on Friday. So that gap risk is not something I'm comfortable with. And you may not have that concern. You may be trading with such an insignificant amount of money and don't want to incur a great deal of risk. And you are willing to take those larger risks based on points or pips, but they won't be so impactful because of the money management you're using. But if I'm taking a trade, I'm not taking a trade with a micro lot. You know what I mean? I'm trying to take something that has real risk behind it, and it will be much more impactful if I'm wrong and I absorb a gap that is adverse to my position that I held over the weekend. So that's why I'm saying it's better to be a day trader right now than there ever has been. So we have a confluence of a negative 2.5 level on the fib based on this price swing. And again, why am I using this price swing here? Because this is a trigger. It's occurring up to a level where we want to see it being respected as resistance, which is the low end of that old weekly gap. It's during the time of day, New York Open, where continuations would form, because the logic is we've already formed a high today. We're trusting, okay? How do you know, ICT? How do you know it's not going to keep going? That's what you use a stop loss for. Remember, I said it's a 70% likelihood if you have the narrative on side. That means you pick the right direction on the weekly chart. Sometimes I get it wrong. I get stopped out, folks. I mean, I've shared where I've gotten stopped out. You've seen where my winning trades stop me out and I don't get the full run. Like, I don't know why you're acting like I don't show it. I show it. And most of you are ignoring the fact that I'm telling you what's going to happen beforehand, and you're not using it to study it real time. When I'm pointing to it in advance, are you going through your charts and looking at it like this? Are you marking up your charts like this? This is a perfect example of what I'm showing. You should be doing these things. This is what you do. When I say back test, I'm not talking about go back in there and using a Forex tester and testing what it feels like to be in there. I'm not saying that that's not useful, but that's a mock up forward walk test. I'm not suggesting that. I'm saying you go back and look at old moves and you annotate your chart like this. And you save these. And in these little areas over here, you talk about and you annotate how the high was formed here at this time and the continuation in the high in the New York session formed here. And it delivered to a confluence of standard deviation negative 2.5 and breached the low of the order block. This level right here is the daily order block. First threshold, where that's where you start the trade as a not start the trade, but you think of it as your low-hanging fruit objective. You don't need it to do all this. You just needed to get here, right there. And that's not even your first partial. Your first partial would be something like below here, or at the mean, the consequent encroachment of this wick right there. So midpoint of that wick, that low or that low, which one do you choose as your first partial? Neither one of them are incorrect. But you're framing it with this is where you think that the low-hanging fruit objective is. So that's your initial draw. And then you watch and see once it gets there, you leave a partial on. How much? Whatever you're willing to hold on to. You have to allow, and I'm allowing for you as your teacher and mentor, I'm allowing for you to bring in your personality to this. You're bringing your own personal touch to this. That means you decide how much you're going to take off at your first partial. In the beginning, when you're first learning, take the most off. Because you're going to see many times you're doing it incorrectly while you're learning, and that's fine. But you can be happy about being profitable, quote unquote, with your results and still be incorrect about what you thought was going to happen. Meaning that if you thought this was going to happen, as I was co-signing on the 13th of June, I said that I think it was going to go down here. If it would have failed to go below there, and I was talking to you today, I would be saying, well, if it would have done that, gone below this low or that low here, you would have taken partials, and it wouldn't have mattered if it went down here. So that's how your analysis needs to make room for you to be wrong, but not unprofitable. You're always looking for a way to take something out, but that has to be predetermined. So if you are anticipating the move from up here and going down to this level here, in that range from here to here, looking left, where is the pools of liquidity or inefficiencies? You can't use this one because we're acting on that as a term, meaning this is what I'm talking about by that. All of this movement here is just this buy side imbalance, sell side inefficiency now has been what? Its sell side's been offered to it now. Look at the bodies of these candles. Look at that candle stopping right there after this buy side has been repriced with sell side. So the down close candle now has provided a repricing to this inefficiency. That starts the framework of this Judas swing for the New York Open. This little run from here to here is power 3. Power 3 is not limited to the daily candlestick. Power 3 can be utilized in any time frame. But this market protraction, this false move up to a level which is the low of that old weekly fair value gap, which is what I told you to watch for that. Does this give you the signature that it's likely to go lower? You had confirmation in London. I teach you in this YouTube channel, in my lectures, that if you're bearish, if you see the London high form when you're bearish and it's breaking down and you retrace in New York, chances are you're retracing to have a continuation lower. And here you have it. So you can't use this as a target from up here. You want to see it go at minimum below that low here. And would you be incorrect by taking the largest portion off of your first partial if you're brand new doing that? No, you're not wrong by doing that. You're not getting a lot of movement, but you're not trading the dollar either. You're trading euro dollar, pound dollar, Aussie dollar, New Zealand dollar, something to that effect. But we're looking for how prices want to go down to this level minimum. So you want to take a partial here. You might want to take a partial below that low here. And the wick. Whenever there's a wick, okay, if your position affords it, always, every single trade, I don't care who told you it's going to go where, and if it includes me, if the price trades to a consequent encroachment of a wick, you must take partials if you're short just above it, because that means it might trade right to that midpoint of that, stop on a dime and retrace and spend some time consolidating, or all right, just reverse. So consequent encroachment of wicks and tails are imperative partial places to take partials at. So if you're short, you have to factor in that price level and the spread. So you want to see the midpoint of that and a little bit above it. If it trades down to that level here, you want to take that as a partial. Always, 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 always cast in stone. It's never going to be a deviation from that rule. If you are trading inside of a range, meaning this high to that target down here, which is that old daily order block, that line is where you think that the low-hanging fruit objective is. You're not saying that it can't go lower. You're saying that that's where you're expecting it to draw to on the downside. It is trying to get there, in your opinion. Between that level and this high, you're looking through all of this for inefficiencies. And I already disqualified this one. You have this gap here. Okay, that's a real liquidity void. If you extend it forward, you can use that as an objective, as a partial. Below this low here. But these wicks, these tails, okay, when you have two of them back to back like that, you're taking the longest one. Take the longest one, divide it in half, which you're measuring is the close to the low, half of that, plus a little bit for spread. When it gets there, you'll take a partial. We just happen to have a low here. If that low wasn't here and it was just a wick, it would be even further reason for you to want to take a partial there. I have learned many times when I held on to trades that didn't go to my objectives, these tails or wicks were always the culprit that I didn't notice in my first few years of trading. And it's the consequent encroaching the midpoint of that, where the algorithm comes back down to it and doesn't need to go back down here. It just goes enough into that wick to upset any liquidity. And then ultimately it would reverse if I'm wrong. So that's the reason why I'm teaching you that whenever you have a wick or a tail inside of the range that you're trading in, and you're expecting that range to be, broken out, you're anticipating that breakout, but you can't ignore any of these wicks, because many times they can completely reverse you and run your stop out if you've trailed it, or completely reverse on your initial stop loss. So entry at New York open at a time between 7 o'clock and 9 o'clock at a level, at a price that's been determined and told to you on the 13th of June. What level? The low of the inefficiency and the middle or consequent encroachment of the inefficiency. Time, London open, New York open. Price, consequent encroachment of the gap, low of the gap. All other factors being there, the market starts, breaks. Once this low is broken, we don't know if it's going to go down here. We don't even know if it's going to go here. We're trusting that it's going to go there, which is why you have a stop loss. If we knew with absolute assertion that we're going to see it and it's not going to fail, we would never need to use a stop loss. So you have to trade with managing risk, and the stop loss is essential for you to be able to do that. So we measure how we trade once we take that low out. Does it do it energetically? I would say that's the energetic. The next candle, we open here. That's opening. Open here. The market trades up into the range of this high and this low. Essentially about half of it. When we see that, the next candle, we want to see it break lower and treat this as an order block. We open, rally up, trade down. We trade through it. It does not need to close below it. Mean threshold is important when we're trading down to an order block for targeting purposes and or continuation. If it closes below mean threshold, that's an indication that it's likely, not a promise, it's an indication that it's likely to continue moving lower. But if we're seeing a brand new up close candle in a sell program, this target here is our objective. Remember, that's the daily bullish order block. The full range of that order block is shaded in yellow. So consequent encroachment, the mean threshold of that order block, I'm just going to eyeball it here. Is 102.565. So we went through that easily and then traded outside of the range of that order block. So now, since we've done this, this level here, mean threshold, now becomes critical. And we would rather see it not trade up into, oops, we don't want to see this range like this. Didn't do that right. Let's do it like this. We don't want to see this portion of the range be revisited. If I can get it right where I wanted that. And that was the high end of that. Right here. This was the high order block. This is the low. This is the mean threshold. This section of price action, if it's going to continue, it's best for it not to trade back up into this area here. And because of that, I would treat this as an area of a fair value gap that I want to see stay open. So say this was like the euro dollar, or it was the ES, or an NQ, or something I'm trading. I don't trade the dollar index. I use it as a barometer. Everything I'm showing you here should be a mirror image on euro, and it should be a mirror image on pound dollar. But because of this idea of the order block, and now because we went below the mean threshold of it, I don't want to see the upper portion of that order block now retraded to. It can. It's just best if it doesn't. Now, because I've encapsulated that relative to the mean threshold or midpoint up to the highest point of that daily order block, this section of price action, when I'm looking at price, now you can see right away, while I'm trading on a 1 minute and 5 minute chart, imagine me trying to do all of this annotation and justify why I'm doing it and still watching price, managing the position. It's impossible. But these are all the things that it's in my mind that I'm referring to and weighing out when I'm moving a stop, when I'm not moving a stop, when I'm taking a partial, when I say I want to see a certain range stay open, like this would be a gap. You will all would see that and clearly see that as a fair value gap right there. This low and this high, that one candle here, that's a SIBI. I wouldn't want to see it trade up any. Now it can trade up to the midpoint, which is mean threshold, go just above this candle's high, and then resume going lower. That would be institutional order flow entry drill. Trusting that this is not needed to be traded to or up into this area here, as I had indicated. Oops, from this high down to the midpoint. So again, you don't know order blocks, so stop trying to teach them. But the point is we trade down, okay? We trade down into targets until we get to time. The high that they formed in London Open, exactly how I teach it, 70% of the time. If you're bearish, the high is going to form between 2 o'clock and 5 o'clock in the morning, New York local time. If that is true, New York session will have a high probability of continuation of the same direction that London already establishes. That means the highs formed in London. We have a price area that we want to see respected. We've already worked the midpoint of that old gap. The low is now the sensitive price point. That's the level of price. But it has to be traded to at the time of day that the algorithm will refer to for new delivery. New delivery is a lower low in the day. This protraction higher up in the New York Open, and the time and price is meeting right here. Then we have this acceleration to the downside. Until we get to when London close starts at 10 a.m. Now at 10 a.m., you're watching. Does price hit your target or multiple targets? If it does, now you're in a position where you could potentially see a market reversal profile. London close generally makes the extreme end of the day. So if we see the high of the day form in London, the low of the day forms generally in this little time window here between 10 o'clock and noon. Don't take my word for it. Go back and look at your data. Look at your old moves. Your charts every single day, with the exception of those right here. Get that off there. You should have the minimum of just that. Just that. That in itself, and all the annotation areas over here that you could fill in with all your observations, and you cheerlead yourself. And you say, it was amazing to see how the level I expected on the 13th of June to be respected as resistance, which is that old weekly inversion fair value gap being respected here. And then it started its framework in the London Open, creating the high of the day. And it traded all the way down to, just like I teach on YouTube. Listen, this is all in videos. all in videos, years and years and years and years of it. And the rules have never changed. It's always the same stuff. The algorithm is not changing. It's not. It's not. It hasn't. It won't. Period. What will happen that causes it to stop working? We are not trading anymore. We won't be permitted to trade anymore. There you go. That's how it ends. So you got a bigger problem, than worrying about whether it's going to work or stop working if that happens. So as long as there's markets being offered to trade, this logic is always going to be used. Period. End of story. Rest. All right, so now I'm going to take all this information here, and I want you to keep that in mind, and we're going to go back up into a daily chart, and we're going to segue over to, isn't that beautiful? Look at that, how it looks on a daily chart now. Completely random. Euro dollar. We'll take our next break at 11:30. It'll just be a 5-minute break, in case you're wondering. I got a ICT. When can I take a break? So here is euro dollar. And you remember I was talking to you about how on the 13th I said that there's a small little gap in here. And then we have this order block right there. Okay, so I encapsulate that entire range of the order block in that area right here. Yesterday, we traded up into it there. And then today we had this gargantuan move outside of it, which is supported by the weakness that we've seen in the dollar index. So I'm not going to spend a great deal of time going through this one because everything I just showed you in dollar will be a mirror image, or should be a mirror image, of everything you see here in euro. So we're just going to drop down into an hourly chart because there's a lot of things I want to cover. And if I'm not careful, we could be into this thing till 8 o'clock tonight. And while I make allowances for that because of energy, I could do it, my wife probably won't permit that. So I want to stay married, folks, okay? All right. Here's your hourly chart. And we were looking for a price wanting to eventually gravitate from the 13th. We want to see it gravitate up into that gap. Let me scroll it over here. So it's this high and that low, okay? One of the things that I would counsel you to do if you're going to be doing a lot of annotations and journaling, which is what I'm trying to cultivate in you as a student, whenever you anchor your annotations and lines on from the higher time frame charts, when they drop down to the lower time frame, like I'm showing you here, the highs, you want to make sure they toggle on to the very specific levels. So that way it makes your charts neater. I'm saying that because I'm obsessively compulsive. It probably may not be a big deal to you, but if you don't have that in the beginning stages, it would be easy for you to gloss over key levels and where they were referencing from respective times of the day. If you're going to learn, you're going to do it right. Otherwise, you just waste an opportunity. So we have on the 13th, which is here, market drops down, takes out sell side. What is this high right here? Last up close candle, what is that? It's not a breaker. What is the purpose or function of a breaker? Mitigation. So a breaker, if it was a bullish breaker, we would see a low, a high, and a lower low than that low here. But we're not seeing that. We see low, high, a higher low. So it didn't go lower here. So that makes this high here a mitigation block. Similar in scope, but the definition of what makes it a mitigation block is that distinctive feature. So if you take that range here, extend it out in time, perfect. What's the low of this candle here? Look right here, okay, upper left-hand corner. What is the low of that candle? 1.07746. That's the low of this candle here. What's the low of this candle right there? 1.07741. So it respects it, colors outside the line just a little bit, rallies. But look at the bodies. What did I tell you about the wicks versus the bodies? The wicks do the damage. That means you have to allow for these little mohawks. Okay, I got a lot of questions about. Folks saw that video where I was trading the index futures, and I annotated where it was trading down outside of the fair value gap. And anytime it does that, my mindset is it's allowing for spread. So I don't lose my mind if it just makes a little small little wick outside of a level, or if it's outside of a fair value gap. If it's like one tick or two ticks and it immediately comes back inside the range, I'm comfortable with that. You might be freaking out if you're trying to trade before you're supposed to be, and you're ill prepared to do it. You'll get scared out of the trade or not trust the level. Where if you watch when I'm doing executions, I'm allowing for these things, and many times I'm annotating it right then, real time, saying, this is a mohawk. If you ever see a mohawk or hear me talk about a mohawk, it's just when the price action has a little tiny little movement with a wick that's just outside the lines that I would see as if it was everything perfect, like no deviations from the actual high or low or the range that's defining an imbalance. It can color outside the lines, and it's completely permissible. It does not upset my expectation. It doesn't unsettle me. And you get used to seeing that when you do these annotations. You trust yourself and your observation and reading price when you see these things repeating over and over and over again. So anyway, that's a mitigation block. And the market accelerates during the the London open kill zone on the 14th at 2 a.m. So we had sell side in here. We drop down into it. That's your Judah swing. The market then rallies quickly up into the levels I told you on the 13th it would do, all the way up to the high here today and through it, just like we saw happen on the dollar index. So if you are a euro dollar trader, okay, you want to have a reference between that and we're looking at the dollar index with it. So you want to constantly be referring to what you're seeing on the market that you're trading versus the dollar index. So everything you're looking at in price for your market of study or trading, you're constantly getting feedback in relationship to the dollar index. So if you're looking for the dollar index to go lower and you feel like you just can't hold on to a trade that's running for you and you have a partial on and if you're traded with real money, you know exactly what I'm talking about. It's stressful to be in a winning trade like that. We just don't know when to close it. You don't want to close it too soon because if it runs, it's just going to keep reminding you that you just got out on emotion. You should have just held on to it or put a stop loss at a point where you can be comfortable with it. You move up half of the open profit and just leave it there. If it stops you out, who cares? Because you've taken a larger portion off already in partials. But the way you beat that uncertainty or that nagging feeling of, I don't know when to get out, you're constantly referring to the dollar index in relationship to your market of choice. So if you're trading euro dollar and it trades to the high end of the order block here and it trades to the low of the order block over here, you're already looking for signatures to support it, complete runoff and keep on going lower. But when we get time of day like we have here, as soon as we enter in London close, you have to have the majority of your trade off. You have to. Number one, it's Friday. Two, London close is generally the time when it makes the opposite end of the daily range. So we have the London high forming here, the high of the day. We had all this sell side delivery and over delivering in terms of what we were expecting, which is wonderful. But when we enter the time of 10 o'clock to noon, New York local time, generally a lot of the volume for for Forex and currency trading starts to dry up between 10 and noon. And later in the afternoon, yes, you might see these little fluctuations, but I'm not a fan of afternoon trading in currencies. Like I'm not a fan of it. The bulk of the volume is going to be encapsulated between 2 o'clock in the morning and noon local time in New York. So the way I just ignore any potential blow off moves is I have rules, and I have to have closed up shop sometime between 10 o'clock in the morning and noon New York local time, especially if we've had targets hit, and these multiple targets have been hit. If you need to leave a very small portion on, then it's okay to do that, but just know that it's probably going to stop you out, and it's okay because you're holding a small portion on. But if it runs, it will satisfy that I need to be in there in case it runs. But you're still going to regret not having the full position on. So you're always going to be wrong in that regard. And that's why I'm telling you my exits. I'm never satisfied with that. I don't have a strategy that satisfies me every single time I take a trade. But I can find profitability in every trade I'm getting into because there's partials always available. And that part is a personal aspect of trading that I teach and make allowance for. You might not understand that allowance as being a factor coming into this, but that's what you're doing when you take my information and concepts and it makes your model. It's uniquely yours. How you engage with price action, what you're comfortable with, what you're never going to trade outside these parameters that you defined for yourself. How do you start there? What parameters and what framework do you apply? These right here, which is time and price theory. This is not form fitted today. This is exactly how I teach it. My students have seen these things for years. You're going to see these things for the rest of your life. If you study price action and you trade, you'll see these things repeat every week. It happens every single week, which is why my slogan is every week, every day, and it won't stop, because this is the marketplace. All right, so let's go into a 5-minute chart. And take a look at how we traded up into. On the 15th, we had sell side here. Then we dropped down. Classic signature of London Open is a stop run. London Open classically seeks sell side or buy side liquidity. You don't have to have the confidence to go in and buy the sell stops. I can. My students have learned how to do that, but it's a very, very hard thing to learn because you have to see years of this type of stuff to desensitize you. It's easier for you to wait for this run here and then judge, does it have displacement higher? Swing high, after it takes stops, fair value gap, it drops down into it here, rally. We want to see energetic run once it clears this high. Does it do it? Yes. In itself, at this time of day, is 3:55. What time of day is that? London Open Kill Zone. Between 2 o'clock in the morning and 5 o'clock in the morning. This fair value gap right here is the silver bullet for Euro for today. You only need this low right here to trade to. There. What time is that? 4:20. Sorry, just a joke. Some of you probably won't get that. No, I don't smoke weed. But there's your silver bullet for London Open. And it rallies up to what? The low of that fair value gap I told you on the 13th of June. That is what? What is that? That is your low-hanging fruit objective. You don't need it to go all the way up to mean threshold, which is half of that shaded area in purple, which is the order block on the daily chart. You don't need it to go there. It can, but you are framing on the basis of getting into that fair value gap. Now, why am I not using the low of the order block? Because that gap is there. The inefficiency takes precedence over the order block. Yes, the inefficiency takes precedence over the order block. This is where you would see it reach for minimum. Does it react there? Sure it does. Trades back down into what? What's it trading into? A low, high, lower low. What does that make this? a bullish breaker. Extended in time. What time of day is that? New York open kill zone. 7 o'clock in the morning to 9 o'clock in the morning. There's your little sweet spot. What does it do? Rallies. How high can it go? Well, we have to determine a fulcrum point. Fulcrum point is here. Why is that important? If it runs through this high, we can start doing measurements in form of standard deviation. So we can take that low, project it up this high here. Standard deviation, -2, -1.5, 1. This is a measured move. Okay, so from this low to that high, a classic ABCD type thing or measured move. And that's it right here. You want to absolutely have the lines portion of your trade off there, because what else is that in close proximity to? The high of the order block. Remember this shaded area here. This shaded area is, let me drop up into, or not drop up, but go up into this up close candle right here, right there, right above my cursor. That's what I'm highlighting here, the low to the high of that. That's what I'm showing. So back down in, measuring that low to high, and this is the fulcrum point, meaning that when price trades to it and through it, it has to go through it before you can get any of these measurements. That's the measured move. Lines portion of the trade should be taken off there because it's in close proximity to the high of that order block. It could very easily stop there and consolidate into the rest of the day and then continue on Sunday into Monday. But allowing for continuation, when it gets to the high of the order block, you need to consider taking a partial there. -1.5 and 2. That's 2 times this move here. Whenever you get that type of move, that's very, very extended. So 2 standard deviations. I teach in mentorship that 2 standard deviations of like the Asian range or flout or central bank dealers range, central bank digital currency, hear that? Central bank dealers range, those ranges that I use for measuring protraction and how far a high or low can move before it makes it. That same principle applies here with all price swings. -2 standard deviation is one of those levels where there's a lot of reason for you to be wanting to be either out of the trade or have such a small little piece on. If you're going to leave a runner on, it's about, at that time, we usually peter out, especially if we do so when time is met, and that being 10 o'clock in the morning, New York local time, to noon. That's London close. So for your notes, especially with the folks that are brand new, when markets are going down, or we're expecting the daily candle to be a down close candle, between 2 o'clock and 5 o'clock in the morning, generally you're going to see the high form. And generally, the New York session between 7 o'clock in the morning and 9 o'clock in the morning, New York local time, will create a continuation pattern. Now, sometimes there's a reversal of that, where London creates a high, sells off, and then New York runs out the London high, but then reverses and makes the lower close in the day. Those are always on the heels of a high or medium impact news driver. That's the only time that occurs. So how do you know when the low is not going to be taken out or the high is going to be taken out in London and you can trust the New York session? I just told you. Man, I should have charged money for this one. So we can see there's a lot of consolidation in here. We had a high. It ride above it. If I was long on euro, this is running down equity. This is the principle. You see me do it all the time in trades. If I'm long, and admittedly, I was sleeping last night preparing for all this, so I didn't trade euro, and I've been trading Forex for a while now. As soon as it trades above this high, you want to be taking partial and exiting your position. It's offset distribution, and the principle is running down equity. That means you're selling to buy stops. You're selling at new highs. You're buying low and selling high. Where do you define high? Every time it takes out a swing high. When you're long, if it's long in the tooth or it's been going for a long time like we did here since 8 o'clock this morning, it's good money practice for you to be selling every time it makes a new high if you have position available to do so. In my personal opinion, if you look at what we're seeing here, do you see how the euro has made higher high and the dollar didn't make that lower low at the same time? Market symmetry suggests that in a perfect world, the US dollar should have made a lower low there in concert with the higher high in euro. This is a USDX SMT divergence. That means dollar, which is USDX, and euro are not in agreement with what they've done at a time of day that is critical, London close. So this would make me very, very cautious to expect higher prices, and I'd be real content with closing all of my position in longs on euro dollar and going into the weekend happy that I've destroyed it. So anyway, that's the business there. For your study, you want to go into the June 13th live stream on my YouTube channel, June 13th, 2023, for the folks that are watching this in the future. And go to the 7-minute and 20-second time on that video, and you'll hear me outline these two levels here and this entire range here, and that would be the draw on liquidity that was mentioned on the 13th. That means we were over here. Here. Yeah, we're somewhere in here. I don't know what time of day we were talking, but we were using this idea that we would expand up into that on the 13th, and today we're up here and through it. Okay. So when I'm looking for SMT divergence is, I've never really settled on the real name for it. It's a smart money technique or smart money tool. I use it interchangeably. It's just a matter of looking at the relationship between closely correlated assets or inversely correlated assets, meaning that euro dollar usually goes higher when dollar goes lower. But if you look at times when they don't agree, so if dollar makes a lower low, a symmetrical market is a euro dollar going higher high. A euro dollar making a lower low and a dollar index making a lower high, that is not symmetrical. They have to agree. So euro, higher high, lower low in dollar. Euro, lower low, higher high in dollar. If ever at any time that it's doing that during key times of the day, which key times is the day for Forex and currency pairs? London open, New York open, London close. Yes, you can trade Asia. Yes, there's opportunities in Asia, but the scope of this workshop today, I don't want to focus on the lowest volatility. I want to take you to where the meat of these daily range moves, and for the weekly opportunities that are available, I'm telling you how to go in and see where these algorithmic price swings are going to occur. Okay, so every institutional price swing that forms in price action in Forex and in the dollar are going to be primarily inside the time windows I'm telling you. Now, by itself, when I first started teaching this, skeptics and skeptics alike would come out and say, this is nonsense, all hindsight. But it was for you to learn how to trust where these things will occur. And by pattern of recognition, seeing it repeat over and over again, you learn to trust that these are the times when things really happen. Now, the problem is, everything that I've done so far in this live stream today, that's all foundational for you to determine how price is going to react and how it trades to where. But you can quickly see how many of the opportunities that you think are a surprise sometimes, after they happen, because you're really not that versed in trading. The idea of knowing how they form and why they form, what they're reaching for, helps remove all that uncertainty. Now here's an interesting thing here. You can see how I told you that I would be done. I would not hold on anything longer for euro dollar. It's 11:24. I would have already closed the trade on this. If the euro dollar goes higher and the dollar makes a lower low, I would miss whatever that move is on the upside on euro. I would admittedly, because I'm obsessively compulsive, I would go back into there and try to justify I'm not suggesting that you do this, but I want you to know that as your mentor, this is a struggling point for me. So I had to have rules that stated that once I come to the conclusion that time is now at a period of time in a day where the opposite end of the range is formed, where we've been seeing it go lower, that means that the low is probably forming sometime between 10 o'clock and noon, New York local time, for dollar. That means that the high is forming sometime between 10 o'clock and noon on euro dollar. There can be, like I mentioned earlier, in Forex and in currency pairs, there can be a bleed over into the afternoon in the New York session. I am not worrying about the dollar or futures contracts or even the Forex currencies during that time of day. My focus would transition from Forex to stock index futures. So that would be my trading day would move from Forex overnight and then go into bond trading in the morning session. And then I would either do an overlap with index futures or finish my day in Forex. And then at London close, all my focus goes to New York lunch hour trading the run on stops that was taking place on the holders of longs or shorts in stock index futures. And then I would prepare for the afternoon session. And then I would do some kind of a bond trade in the last 30 minutes or whatever on market on close, and that would be my trading day. That was how I did things. And when I stopped trading Forex and went back to my roots of which is index futures trading, um, because that's where my focus is, I'm teaching price action with that medium. But you can clearly see all the things I'm teaching you here that are already in my YouTube videos. I'm taking my opinion of how I would teach the folks one-on-one. This is exactly what we'll be doing every day, all week long. We'll be going through every single thing that I told the person the previous week what would happen, and it would give them a foundation. And then come the middle of the week, I would say, okay, based on what we're showing you, where would you focus on your trading? Where do you feel compelled to trade? Do you want to trade on an hourly time frame and try to get like short-term intraday trades, or do you want to scalp where you're using a 15-minute or less? Or do you want to be a short-term trader using primarily just the daily chart and using the open, high, low, and close for power 3 to get your setups to trade for 1 to 3 days of short-term trading? And depending upon what the student would tell me, then I would spend the latter portions of the week framing that out in a model for them so they can go home and start working with that. That's what I did in the mid 90s. So I want to kind of get through the other markets and then teach you how to trade the FOMC, non-farm payroll, and CPI stuff. So let's go back up to a daily and go over to the pound, and then as soon as I load the chart up and get it set up, we'll take a 5-minute break. So you want to be a trader. All right, folks. One more time, if you could just give me a 5x5 on Twitter. Let me know before I start talking again that you can hear me fine. Can you hear me? I'm not sure you can hear me or not. I'm checking Twitter, by the way. Thank you, Mo. Professor Chummy, thank you. Appreciate it. All right, so we're looking at the cable market. So on the 13th of June, 2023, the live stream, for your notes, if you go to the 14 minute and 25 second through the 16 minute and 10 second, you'll hear me talk about what I'm going to refer to here. So it's not cherry picked, it's not hindsight, it's foresight being shown to you in your face. Okay, so I mentioned that pound would likely move higher. Now, why would pound move higher? Because we were expecting the dollar index to go lower. So we measure, again, the same way we were doing with the euro dollar moments ago. You're constantly looking at the relationship between the dollar index and the market you're trading. So if it's in Forex that you're trading, you're constantly referring back. You don't just simply look at the market you're looking at as a trade and that's it. I don't know if this splitting the screen into two requires a specific membership or whatever. I don't know. I can't recall. I know I have the highest one that is available, but it is what it is. I mean, you're going to have some kind of way of having two charts up. And while you don't need 12 monitors like I do, I don't need it, I'm saying, but I have 12 monitors available to me. I'm constantly referring to all the markets I'm looking at to keep a good measure of. I don't have them open now. I'm in my trading office, but I'm literally just talking to you on a laptop, the one I used when I'm making my presentations all the time. So I'm only limited to see what I'm showing you here. But at a minimum, you have to look at, if you're trading Forex, you want to have the dollar index and whatever market you're trading. You have to cycle through the time frames. Okay. So on the 13th of June, 2023, I did a live stream. I talked about how the British pound would need to go into this fair value gap, go above it, and treat it as support before we would see a meaningful move up. And I said I wanted to see it trade up into this shaded area here, which I'll take you over to. That's the weekly gap. Okay, it's a fair value gap right there. So this inefficiency right here that has that big down close candle, it's defined by the candle to the right. That candle's high. And this candle's low. So the candle that's right there, that's what I'm encapsulating in the analysis. And that was in the June 13th, 2023 live stream. I said that we would expect it to trade up into that because it has unfinished business up here. They were the terms I used. If we drop into a 60-minute chart, okay, you can see on the 13th is here. We were talking and doing our business on the 13th all through here. And I said I want to see how we try to trade up into that gap that doesn't appear on this chart. Now let me go back into the weekly. Visibility on all intervals. So now when I drop into the 60-minute chart, it should appear. There we go. But this gap here is on the daily chart. As I mentioned, I wanted to see it act as support. We have a down close candle here, which is an order block, which is at the near top end of that range. We expand outside of it. We come back down into the order block, which is a down close candle right there. And then look what we're doing. We're working this level here, here, and then that time right there on that candle. What time is that? I mean, that candle right there touching the top end of that daily fair value gap that I told you on the 13th between 14-minute and 25-second and the 16-minute and 10-second, that minute marker for the June 13th, 2023 live stream for pound dollar. I stated that I want to see it trade using that fair value gap as support, permitting it to trade as much as consequent encroachment, which is the midpoint. Okay. Because we have this down close candle and because we have the breaker, low, high, lower low, extended in future, order, not order block, bullish breaker. We have an order block here, trades down into it, and it's also working and respecting that old daily fair value gap, which we're treating as a inversion fair value gap. Remember, on a daily chart, it looked like this. It's this inefficiency on the downside here. And if you think you understand what I'm teaching because you watch one or two videos and you think, oh, this is one of those optimal trade entries, it's got a fair value gap, let's go short there. That's not what you heard me say on the 13th of June. I said we want to see it trade outside of it, come back down, and you can see it happening here on the daily candlestick right there. So before I drop down again, think about Power 3. Power 3 is my accumulation, manipulation, and distribution theory. And it was the major transition from relying on everything that I had learned from Larry Williams and capitalizing on something that he admitted, much like I admit my weaknesses are my exits. I'm never satisfied, no matter how good they are at the time. Afterwards, I'm never satisfied with it. So I'm highly critical of myself in that regard when I shouldn't be. And that's why I try to teach you all, try not to do those things, because it's plagued me my entire career. I don't find any satisfaction in any of it. But it's not about being perfect, and I'm pursuing perfection, and I already know I'm not going to obtain it. But one of the things I heard Larry talk about in 1995, he said that his struggling point was understanding how to be a buyer below the opening price, because most of what I was learning from him at the time and what he was teaching, I haven't kept up with him. I don't know what he's doing now and what he's done and evolved from what I was learning from in the 90s. But at the time, I bought everything he had, everything. So either it was given to me by friends in the industry, sorry, Larry, but or I paid for it outright. And at the time, I loved everything, and I wanted to use everything that he was teaching, and that was a problem. And that's what many of you do with my concepts. Don't do that. Find your model. Look for what it is you're trying to trade, what type of trade you're trying to be. Is it swing trading, short-term trading, day trading, intraday scalping? And then what asset are you going to focus on? Futures, index futures, currencies and Forex, crypto. I don't trade crypto, but I have students that have made lots of money trading crypto, and I can't co-sign for it, but they swear by it working in there. So I have to be very careful because I do nothing with crypto, nothing. And I have no affinity for it. So that's why we won't talk about it, and we don't talk about it. But I do think Bitcoin's going to zero. Anyway, the low of this candle right there, after the opening, it trades down. Now, I'm not using this opening price. I'm using levels that I taught in the core content for the day trading. I'll refer you back to that. For the life of me, I wanted to make a note of this in my notes so I could tell you what month it is. But if you follow me on Twitter right now, if you can recall what month it was that I did all the day trading stuff, where I focused on day trading, I taught a lot about opening prices in there. And for the life of me, I can't remember which module month it was, but it's already on my YouTube channel, so I promise you it's there. It's free. You can go look at it. But You can still use the trading view settings. I don't trust them entirely with this setting, but the principle is this. If you're bullish, if we are bullish, if I am bullish, I'm looking for the market to create these up close candles and draw into a level that I've already predetermined. So right away we had buy side here, resting above here. We want to see get up into here because this is an unfinished business. This is all this range up here. This is the 14th, so this would have been the actionable day because we were talking about it live on the 13th. But the day that you would be using the information would be the very next day on the 14th. So we have the open. It trades down from the opening into the high of this gap. That's not supply and demand. That's not. It's not even trading back to this down close candle, which you would see as an order block, right? This was the level I told you to watch, but permissible to the extent that it could trade down to half of, which is essentially about right there, which would be meaning what? It can trade to the opening price of that down close candle, which would be in what? A bullish order block, which is the reason why I said that. Focusing primarily on using the fair value gap as a form of support before we would see any meaningful run higher, this signature has to make itself present. We happen to open here and trade down. That little movement down is what I refer to as a Judas swing. It's a fake move. And all that's occurring on the 14th or Wednesday, yesterday. I know I have the title of this live stream noted as Friday. The reason why I did that is because my notes, right here, I have at the top Friday workshop. So that's why I keep saying Friday every time I look at my notes to keep myself on track. My subconscious is saying it's Friday. I know it's not Friday, but because I wrote it incorrectly this morning, I keep running with that. So the live stream's title will change to a Thursday, obviously, but that's not me editing anything except for the title. All the content and everything's here live. You're all watching it. I don't know how many people are watching, and if I looked, I'd probably be nervous about how many people are doing that. But to stay on track, just know that I mentioned that this occurrence here would be what we would be favoring, and then we would want to trade up into this range. Now, I taught recently, and I don't recall what video it was, and this is where I'm weak as a mentor. I don't do a lot of indexing or table of content stuff because if I start that, I'll want to go nuts with it, and I just don't have the time to do it. And this is more than enough. You're getting this for free, and it's worth more than any other thing out there that you would buy as a course because it's been proven to you before it happened. I told you what to look for, and I'm telling you now what I used to get to that understanding, and it will repeat. It doesn't change. It doesn't fall away. These are the same things that I've been using for 30 years that work continuously over and over and over again to be able to call these moves in the marketplace, which is the only thing I promise. I can promise you that you will read price action very, very precisely. Whether you find profitability with it or not, that's the hard question because you will bring in your own character flaws. Just like I have a character flaw with my acceptance of whatever I do as an exit on my positions, whether they're profitable or not, I'm not satisfied with that. So I want you to understand that I'm not AI. I'm a human being that frustrates me, and it's plagued me for 30 years. Don't do those things with your development or create those things for your trading because if you do that early on, they will derail you. And I actually learned majority of what I know in my first 3 years. But I messed up by trying to change things, improve things that were already perfect. And one of the things that I had set in my mind that I would have a perfect exit. And I'm never going to have that. I'm convinced I'm never going to have it, but because I'm wired to be obsessively compulsive, I wrestle with that. So I teach you how to overcome that by not trying to go into it in the early stages of your training. Because if you create character flaws in your trading early on, you wrestle with them for the rest of your life. And there is no magic eraser to get rid of them. You wrestle with them the rest of your life. Every time I look at a market move, if it's something I wasn't watching and it happened, even though I know I didn't need that move, it pisses me off that I didn't have it recorded and executed so I can show it to the community, because I know I would be in that trade. I'm sometimes thinking about a trade that I got hurt in, and because I see something that my subconscious, I've looked at things for 30 years, and if I see something and I got hurt in it in the past, I remember that, and it's a distraction, and I wrestle with that. You don't have that yet. You're brand new. You don't have those war stories and scars that you have to, oh yeah, I remember that happened, but that's not this trade. So that's the reality of this. You're going to pick up a lot of painful scars and wrestle through that the rest of your career. Nobody ever gets to a point of mastery where they don't have any kind of emotional tug of war that takes place, because if they have real experience, invariably your mind's going to go back to a time when you were in a trade that looks similar to this one, and then you got to push through it and stick to the rules. The rules say stay with the trade. I don't care if it hurt me this many times years and years ago. It looks like the way it does. You see all these guys that make, I'm getting somewhere, by the way, with this. The folks that draw out these charts and says, look at this. The last time in 1929, the chart looked like this, and it's going to crash. And everybody's been calling for the crash, through the summer. And I said, I don't think we're going to crash. I don't think we're going to consolidate. We could consolidate, but I think we're going to go up higher. And we've been going higher. So my rules stated that I should have looked for and expected, as you know, I wanted to see the seasonal influence that I'd like to see that takes us into a low on June and have that little bit of a drop. But that seasonal tendency didn't materialize. And throughout that seasonal tendency, you heard me calling it higher. That was only learned by experience. But I also stated that when a seasonal tendency is likely to occur, a seasonal tendency, by the way, if you're new, is simply a certain time of the year, certain month of the year, certain asset classes or a particular market performs a certain way more times than not. So it's like it's like a seasonal tendency for snow. It's not likely to snow in New York in July, and it's not likely to go to 90 degrees in February in New York. When that stuff happens, we probably need to be paying attention. But generally, seasonal tendencies state that those are the normalcy. Well, there's a factor in the marketplace that we refer to as a seasonal tendency that I was expecting, and I've used many times over the years, that the low forms in June, and there's a decline the last week of April going down into midweek of the second week of June. Now, it doesn't form all the time, but as I indicated in my lessons about seasonal tendency on my YouTube channel, and also as I mentioned recently in the last few months, that if a seasonal tendency does not form or continue like it does in the past, the fact that it's not there many times is a very strong indication. Like, for instance, I'll give you an example. I would have liked rather to see the stock index futures to trade lower throughout May into the first or second week of June. That's what I wanted to see. Now, wanting to see something and then taking that want and then trying to impose your will in the marketplace and try to force a trade into it, that's what I did when I was 20 years old. And that's how I blew my accounts. When I did those things, I was forcing my will and what I wanted to see happen versus sticking to what the market's telling me. Now, as a more refined analyst, when I look at price action now, I defer all the I want versus what is this algorithm telling me? What's price action showing me in the chart? And a lot of people were trying to look for shorts. The older timer guys were saying the market's going to consolidate, and I said, okay, well, if the older crowd saying we're going to consolidate and the retail saying we're going to crash, I'm going to trust everything that's saying it's going to go higher. So if it's going to go higher, what's it going to reach for? Buy stops and inefficiencies. And that's why I took you to the weekly chart and the daily chart to also answer the folks that don't want to day trade. They want to see longer, higher time frame perspective. They don't like the 1 minute chart stuff, okay, because they think that that's useless to them. But that same thing that I'm using on a 1 minute chart, I'm using on a 15, an hourly, 4 hour, daily, weekly, monthly. It's the same thing. The same idea that I'm using inefficiencies and liquidity in market structure There's a plethora of setups that are happening all day long, and you're never going to run out of setups. But the problem is you're not giving yourself a chance to trust what you're learning is going to give you more than you ever need. Like I could be here all day long, every single day, all night long, finding setups here, there, all over the place. If I pushed like that, I will take losing trades more than you see me showing you. But I've learned where I want to take initiative and say, I want to only work here. I have insight that, allows me to be more accurate in that regard. But I teach you how to find that, and I'm doing it today, how to find the choicest cream of the crop setups for the week and live there. Once you nail down a win like that, stop. Don't trade again. If you're a YouTuber, stop. Let your audience see that you're controlling yourself and you have discipline. It doesn't matter that you come back the next day and you trade and you're live and you say, "Oh, I think I should be done." If you're asking your audience whether you should stop trading or not, you're not in control. You're being driven by your audience. So that's another thing that you have to ask yourself. Why are you learning how to trade? Are you wanting to be a YouTuber where you're allowing the influence of your viewers while you're trying to act like the influencer? If you act in a manner that you're trying to teach or showcase what you're doing and you're allowing this audience to influence whether you take a trade or not, you're not in control. You're letting outward things create impulsive decisions about you taking on risk. So it's important not to get wrapped up in that. I don't listen to people that say, "Dance for me, monkey." I'm not doing it. I know what I make mistakes in. And when I get impulsive, my emotions, and I'm bipolar, I can't trade when I'm in a manic episode. I can't trade when I'm in a euphoric episode. So it takes a great deal of focus for me to even have these kinds of discussions with you. Sometimes it's next to impossible. And if you listen to, you know, episodes in the past where, I get either emotional or I go off the rails and get a little bit more belligerent than I should. It's not because I plan to do it. It's because I have a chemical imbalance. So I have very rigid rules that I've had to place on myself, much more rigid than the average person, because I battle a mental illness that is very hard for me to wrestle sometimes. And trying to trade and be in an industry that's highly technical like this, it's not easy. It's really not easy. So anyway, talking about the Power 3 concept is the accumulation, accumulation, manipulation, and distribution concept of using it on a interval, any time frame. But I introduced it with the daily chart because, like I mentioned in the beginning of all that rant, I warned you they could probably come up. I learned that Larry Williams I never found out if he ever figured it out because he mentioned at the time in 1995 that he had a weakness or an uncertainty as to how to determine when to be a buyer below the opening price before you see these big ranges. And at the time, I was learning under his tutelage of his books and his VHS tapes and courses. That's how I was learning. He was my first real mentor, and I still have a great deal of respect for him. But I did move away from most of what he taught and what I learned from him. But there is a hallmark to a lot of the things that stayed with me because they're just market truisms. Um, a market day that has a big range, he taught that usually the open is near the low or the high of the day. So how do you use that information? If it's expected to be a bullish day, and remember, go back into the 13th live stream. If you haven't watched that live stream, I promise you, don't watch it after this one because we're going a long time today. Tomorrow or over the weekend sometime, watch the 13th of June 2023's live stream. And all those things I'm talking about, you'll be able to see this forming here. But when you're looking at a day, when you're anticipating bullishness, you're expecting not just one day of movement up, which is why I take you into the weekly chart. That weekly chart might have only a one-day event that creates the run to what we would expect as a draw on liquidity. A draw on liquidity is where price is likely to reach to, whether it's reaching down for sell stops below an old low or it's reaching down to a fair value gap. That's the only reason my price goes down. That's it. In the reverse, when it's likely to go higher. But we look at the weekly chart with the expectation that there's an expansion move. We don't need to predict the close of the weekly candle. We're just looking for this price movement with magnitude reaching into an objective that we've identified on the weekly chart. So because of that, we're taking that insight and we're transposing it to our lower time frame charts, daily, 4 hour, 1 hour, and anything less, all the way down to 5-second charts. I said that correctly, 5-second charts. So if we're bullish and we've arrived at the dollar going lower, cable or pound dollar, as we see here, is likely to go higher and move up into this shaded area, which is what I referred to as the unfinished business. If it's going to go higher, where's it going to go? Well, you have this high to this low. And what has already happened? We went to this high here. So what's resting above that high? Buy side. So the minimum threshold would be to what? Reach up to where? This is a trick question, by the way. If you're buying here at the top of this fair value gap as I outlined, then we would be expecting something like that to form when we did our live stream on the 13th of June. We would expect the market to open, trade down. Any down movement into this gap will be treated as a Judas swing or a fake decline. Retail will chase this every day. They get caught up in it. They want to get short on a breakout. They're using some 5-minute, 15-minute breakout rule in London or New York or whatever, and that is a fake move. It's designed to do that very thing. Why would it be interested to do that? Because those sell stops being triggered to get traders short, chasing it, they think it's going lower, is the perfect counterparty to smart money going in and buying it because they're the sell side to their buy. Every long has to have a sell side. Every short has to have a long side. So the dance between liquidity and how it's utilized in price delivery, you have to take a step back away from thinking about things in terms of overbought, oversold, and indicator settings and things like that, and look at who's available right now to take the other side of my trade and utilize that as like a bus stop, okay, or a mile marker between where you are and where it's ultimately going. Terminus is your low-hanging fruit objective. That is not the end of the move. Terminus is just where you define where the low-hanging fruit objective is. If it just gets that far, you've made money. If it reverses there, great, you've already made money. If it continues, you have something there that could potentially pay more. But you don't need it to. Notice what that would do for you. If you haven't considered what that would impact you in terms of your psychology as a trader, you're not putting so much unrealistic expectation on yourself. You're literally just placing a realistic objective. And what would that be? If you're going long here and it runs up and hits the low end of that imbalance, that's profit, partial one. Now, if it doesn't go to consequent encroachment of that wick, what are you thinking of that? That's a partial. Why? What I said earlier. Whenever there's a high or a low that you're expecting to be breached, traded to and through, if there is a wick or a tail, consequent encroachment, that midpoint, you must always, every single time, without deviation, must take a partial. Always. It's in stone. Have it in your journal. Have it in your psyche. Expect it. Do it always. Then you have the buy side. Now, we're expanding, and I mentioned that cable could trade up into this area here because it's unfinished business. What levels above this buy side can we utilize? Well, I taught this, and I don't remember if it was in Twitter Spaces or if I think I did a live stream. I'm almost certain I did a live stream. At least I might be having a senior moment here. I believe I did it. I don't know. I'm second guessing myself now. But here is the gradient levels. I'm almost certain I did a live stream and mentioned this. But the low end of the gap, which is all the shaded area here, okay? Above this high we have the low quarter percent, the lower quarter gradient level of this entire range. Then we have consequent pressure, which is midpoint. We steam through that. So the next objective would be 127,754. That's a finite number. It's a static number. So if you were targeting that for another partial, you would factor in spread. So you would deduct whatever your typical spread is for your pound dollar Forex pair, and then you would have a limit order sitting there. And if it were to expand up into that, you'd have a partial. And then there it is. If you're inclined to hold over the weekend and you feel like this is going to open up higher, which it could do, open up above it and trade down and fill in the gap. I'm playing devil's advocate for a moment, saying, and I don't know this because I'm talking to you as I'm watching it, but let's just say it meets the high of the day already here and it's done. We could gap open higher on Sunday and then trade down to this and fill the gap. And that would be a scenario if you're willing to hold over the weekend. I'm not trying to entice you if you're in it to do that. I'm just giving you scenarios how I would think about it. And when I was using over the weekend holds, when I would trade and hold positions from Friday's close into Sunday's opening, this idea I would use in this context here, because this is still exposed. This is the other portion of that inefficiency on the weekly chart. Remember, all this movement from high to low, that shaded area, was one weekly candle where it only was going down. So to reprice efficiently, we're seeing price deliver on the upside. So until it gets up to this point here, there's an inefficiency in the form of a sell side imbalance, buy side inefficiency on that weekly chart. These are the parts where you get lost, and this is why it's important that you make sure that you rewind the video and scrub back to the parts where I actually show the weekly chart so you can remember what I'm showing you here. But it's important by having these higher time frame annotations on your weekly chart and then showing them on every time frame, you won't be surprised. You know, the things that generally have happened to you in the past probably won't be a issue for you when you start doing this. I'm trying to hit the delete button, but I was touching the page down. 50-year-old eyes. All right, so anyway, we're going to take a look at the 14th, how we traded in here, and then we'll drop into a 60-minute chart. All right, so here is the 14th at 2 o'clock. That's the beginning of what? London open kill zone. So the low, actually, prior to that, at 1 o'clock, that's the European Open. London open kill zone, 2 o'clock to 5 o'clock in the morning, New York local time. Then we gap up in here, rip off into, and then look at the bodies here. That's the low of that weekly imbalance, the fair value gap. That's a signature I like to see. When you start seeing moves form and they respect these higher time frame inefficiencies or areas where a real gap would be, or we're not talking about new week opening gaps today. We're not talking about new day opening gaps, by the way, in case you're wondering. But we're working with higher time frame weekly and daily inefficiencies. And this is the real support and resistance that you're looking for. Like, one of the things that I tried to do was determine a way of picking what retail support resistance should be. And always, this is the one you use. I would always get them wrong. Sometimes I'd be right, but most of the time I'd get them wrong. So what I wanted to do was determine how I could bridge the gap between the expectancy of traders to see what is a support and what is a resistance and what qualifies and quantifies a support or resistance. And I found out that the largest degree of precision is around these inefficiencies. And anybody can say, oh, everybody's known about gaps. Everyone's known about, inefficiencies. But once they close in, they're done with them. I'm not. They're treasures to me. I'm holding on to them for months. And the algorithm will refer back to it, which is why I keep a 60-day look back on my charts. I'll go back 60 days. And any old PD array, whether it be a fair value gap, a breaker, anything like that, I will refer to it. If it's in the proper context of what I'm looking for, what does that mean? I stated on the 13th of June that I was bearish on dollar, and we would want to see the British pound trade up into all of this area here. That's the inefficiency from the weekly chart. It has unfinished business. Well, we're seeing it expand up, and it's done it energetically. But where did it start on the 14th? Right here at London. And then rallied up. We have a wick. What is the wick doing here? Damage. Damage. It trades down outside of that gap. Does it go to some random level? See where it stops in the middle of that fair value gap? That's consequent encroachment. That's a signature. When I see this, when I see that right there and it pulls back up into it, I'm still staying with the narrative that this is going to go higher. This does not change my mind. It does not freak me out. Even this going down outside of the shaded area. Again, this is what I refer to as a mohawk. The little tiny little, and the reason why I mentioned it's a mohawk is when you cut your grass, okay, gentlemen, you're out there cutting the lawn, and you're listening to the radio, you're looking at your next door neighbor, she's wearing a bikini, and your wife ain't looking, and you just move the mower too far over, and you leave that little tiny little mohawk. You got to come back and get it. Well, that's kind of like what this is. It's a little tiny little mohawk outside the range of where you had your mower. We allow for that. Okay, maybe your wife doesn't allow you looking at your neighbor in her bikini, but we allow this in price action. This is, permissible for price delivery. But notice what's occurring. The bodies here and the bodies here, they're real close proximity to that shaded area. So we treat this as, okay, it's no problem. Even though it got real close to that low, the damage was done on that wick. It returned then to this fair value gap. It was consequent encroachment. All of this in here, I would be watching it. I was not trading it. I would be watching it and seeing, okay, in my mind, if we were looking at it live, you would have seen me type out retail sees a bear flag, drop, bear flag, and they would expect it to drop down like this. That's where I would be drawing in or typing in, excuse me, the fake bear flag. So whenever you see me doing examples where I talk about what retail sees, it's in relationship to what I'm showing you here. Like this is real order flow, and notice I haven't done anything with a ladder, depth of market, level 2 data, no profile stuff. It's just simply reading inefficiencies and liquidity across the higher time frame transposed to lower time frame. Staying with that premise that dollar goes lower, it's risk on, all assets get to go higher. Stock indices, the Forex pairs, all that business, they get to go, they're free to move up. So here's Thursday, 2 o'clock in the morning. It's trading where? At the low of that weekly inefficiency or gap. And then we have the market take off, rally, and let's go into a 15-minute time frame. Okay, so we have more information in here. This wick now has been refined to on a 15-minute time frame. Consequent encroachment is right about there, so it's trading right at that point, consolidating just outside that range. And then we have a short-term high, broke. So now we have a shift in market structure at the low of that weekly inefficiency, that fair value gap. So we have a shift in market structure. Is there a gap? Look in here. Is there a gap? Lowest down close candle. Now, ICT, you said you used all the candles. Why aren't you using both of those candles? That candle's outside of that gap. Isn't it outside that shaded area? So what do? You use the down close last one. You thought you knew under order blocks. You don't know anything yet. Bullish order block, down close candle, trades into it. You want to see it repel price. Does it repel price? Yes. So at this point, you can take this entire range now. For entry, you're going to use the down close. For support, whether the information is going to continue offering institutional sponsorship, the price is going to continuously work off that level, then you can take this range and then apply it here. But the entry would be on that lowest down close candle. I already hear the people hissing. This is all hindsight. It supports it here, supports it here. Look where the bodies are stopping. See that? Why am I not using this down close candle and this down close candle ICT? It's inside the shaded area, right, of the gap. We have to use the outside of the range. Okay, so we're inside of all this external range liquidity. We have to use the PD array that's made available inside of that, and it's separated by this this up close candle. So that breaks the continuity of down close, up close. That's a change in the state of delivery. Then we go back into down close, down close. So the change in the state of delivery is the open on this price there. But for entry purposes, we use that last down close candle. But for supporting, for a reclaimed order block, go back into month 4 of the mentorship. These two down close candles, it's being reclaimed here and here. And we can see that the opens and closes here, that's supportive. And then we have one more little wick through it. Because why? The wicks do the damage. You don't rush your stop loss. Don't rush it up. Market breaks above here, then takes off, clears the buy side, and then we've been expanding since. Let's see if I can scrunch this up a little bit. So we have a little bit of range still here, but ultimately we're aiming for this. That's a perfect delivery if we can get up to that point. Will it do so before the close of today? I don't know. I don't need to do it because I'm not trading it. But you knew about it on the 13th of June. All right, so where are we at here? All right, let's go to NASDAQ. 1, 2, 3, 4. We only have 4 more markets to cover. I'll be blending in the FOMC setups and how to trade that stuff as we talk about each. So go back to daily, NASDAQ. All right, so there is the setup that you saw me trade yesterday on my cell phone. So I apologize. I know some of you are like, well, why didn't you record the whole thing? Because I had a guy here trying to teach me how to use my pool and use the setups and such, and it's something I'm not used to worrying with. And as he's talking to me, I told my wife to pay attention to this part because I'm looking at something. And I was trading in the NASDAQ, and I was able to capture a little bit of it. But anyway, the NASDAQ. Let's go back. I'll put these executions back on in a minute. Give me a second. So on the 13th of June, ahead of CPI, I mentioned, as I was meaning to mention earlier, that I didn't do so, but I'm going to do it here. CPI number, I am generally not accurate ahead of it, meaning that there's only been a few times publicly that I've expected certain things to unfold in CPI, and then it happened. Most of the time I'm wrong. So does it surprise you when I tell you as my students not to try to trade ahead of CPI? It shouldn't surprise you. So because I'm telling you not to trade in advance of something, I'm trying to illustrate to you in no uncertain terms that there's a great deal of risk in doing so. So if I'm not able to do it, and I'm supposed to be teaching you, why would you want to trade it? You're gambling. I am gambling if I try to determine in advance what it's likely to do. So I set parameters up like I did on the 13th. I told you where the buy side and sell side was, and I gave you the fair value gap. And then as each was traded to, I told you what would be delivered to next. So it went up to the fair value gap, which we'll look at in a minute. It went down to the sell side real quick, all in 1 minute, and then went for the buy side. And I told you it's going to pull back into the middle, consequent encroachment of that range that defines both the buy side and sell side. And I'm probably talking too much for not having the chart in front of me. But the main takeaway was because of it being ahead of a CPI number, I was making allowance for the sell side below here, which is right there on this day. I was expecting it to be potentially a wipeout where they could come down, spike into this, and still resume going higher. I was expecting that because it would be a classic CPI. It's a classic FOMC type thing. It's a classic non-farm payroll event where they use the smokescreen of that high impact news driver, upset daily liquidity, which would clearly you can see these are relatively equal. So there's a lot of sell stops resting and it's been trailed up through here. So that's why I mentioned that CPI could potentially use that smokescreen, or the market rather could use that as a smokescreen, and drop down there and clear up all the sell side here just on a wick, and then we'd still be where we're at here, maybe even higher. It's a scenario I offered up as a reason to be cautious. If you stick to that as what I expected for NASDAQ ahead of CPI, I was wrong. And that completely solidifies why I tell you don't try to trade ahead of it. Because there's so many variables that could take place, so many things can happen. Nobody really knows what it's going to do when it happens. And when it does happen, I showed you and you watched it live, those that were in there. And if you didn't see it live, it's in the recording. It's moving and traversing so fast that there's no way you're getting filled, and all brokers pull liquidity. You're not allowed to trade that because, like I mentioned at the time in that live stream, it opens them up to unnecessary risk. So they claim that there's an absence of liquidity, like traders aren't willing to trade it. There's a lot of people out there trying to gamble on it, but they don't want the likelihood of some Yahoo getting lucky with an over-leveraged trade that they're B-booking. And B-booking is when a broker trades against you. And yes, it does go on. But if you learn how to trade well, you don't need to worry about that. So here we have Thursday today. Here's Wednesday, Tuesday, the 13th. As I was mentioning, I was expecting some wild whipsaw, and CPI can do those types of things. But it was kind of muted to the downside and offered still continuation, up. So we're going to drop into a 60-minute chart. Okay, and you can see how this type of move right here, FOMC, CPI, non-farm payroll, all those things tend to be a characteristic of those types of news drivers. So a high impact news driver, for your notes, it can occur on a medium impact news driver, but most of the time, a high impact news driver is when I expect the worst case scenario in terms of where the safest retail spot of anyone that's in open profit, meaning the market's been going higher. This is a general rule of thumb. So we're not really talking about this market per se. It's every market. If the market has been going up for a while and it's been classically seen as an uptrend, everybody that's long should be in profit. A high impact news driver, my mindset is always it's going to run against that, either to reverse on them or to offset any trailed stop losses, so that way they can be utilized to be a counterparty and then resume that existing primary uptrend. So I'm always looking at these high impact news drivers to go after for the purposes of unseating profitable positions, and then it resumes. But if it reverses, I'll know if it's a reversal at the time of delivery. So that's why I have to wait. I have to wait for CPI. I have to wait for FOMC. I have to wait for non-farm payroll if I'm going to trade them. Mythbusters, ICT edition. You see people say, ICT says never trade on Mondays. No, I tell you as a new student learning, don't trade on Mondays. Let Monday trade. Use the information that you get. Once you know how to trade, you can trade Mondays all day long. Okay, that's the proper context of what I said. I teach my students don't try to trade non-farm payroll, but you can trade after non-farm payroll. About 30 minutes after non-farm payroll, you can trade the gas, the inefficiencies, and the liquidity. It's easy to trade it after, but it's next to impossible for you as a new student or a new trader to feel confident or consistent trading non-farm payroll when you don't have experience. Doesn't that sound like a responsible person? If I'm trying to teach you, if you're learning something from someone, especially if you paid to learn this, wouldn't you want that person to guide you away from where you're probably going to hurt yourself? That's what I'm trying to be as a mentor. That's what I've always maintained. Same way with CPI. CPI can rip your head off and shove it straight up your ass if you're wrong. That's the reality of that. It's so violent, so quick. If you're wrong, It's unforgiving. The broker's not going to say, well, I'm sorry. No, they're going to give you the worst case fill. Your stop is not going to protect you. It's going to be the worst case scenario. And it's probably going to be an instance where you wish the stop would have worked and it's running even past your stop. And by the time they remove all the self-imposed lack of liquidity, you'll get filled at the most ill position or price. That's the way it works. So because I've seen this for so many years and I've had my own experiences where I'm getting smashed around, my face ripped off or my head shoved up my own ass, that type of experience doesn't need to be repeated. Not in my students. So I'm trying to teach you how to avoid all that stuff. And it should be received with gratitude because I wish I would have had someone tell me this stuff and save me all this pain, because it was very painful and troubling to wreck myself constantly, not knowing that at the time I felt like it was going to be right. And you're going to have those instances, even learning with my concepts, you're going to get overconfident. It's going to happen. It happens all the time. My students, they get this sense of invincibility. They're invulnerable. They can't do it wrong. Now they figured it out. They cracked the algorithm. And then all of a sudden you get that one simple, stupid little losing trade. And it's always going to be on a high impact or a medium impact news driver where you thought you were going to do better than the rules. And I make that same mistake. When I lose, it's me. Most of the time, always me trying to outperform my own algorithm. Because I've been here before. This looks like a time. It's the human element that creeps in. So the more rigid you are about following rules that are not infinite in a list, simple little rules, the things that I outline when I tell you, look for this level to act as a means for a premium to then distribute price lower to this discount. Okay, that's pretty simple. It's giving you a framework. Then you gotta simply wait for time. I've told you the times that we're waiting for it, but now we're in stock indices. So it changes a little bit. Okay, it starts at 8:30 and goes to 11. There's your morning session. Then you have to worry about trading the lunch. Are you a lunchtime trader? Yes, you can trade lunch. You've watched me whip the shit out of these markets trading that lunch hour. But as a new trader, you shouldn't try to do that yet. Stick to the morning session, then trade the afternoon session, or one or the other. If you make money in the morning, don't trade the afternoon as a new student. That doesn't mean everybody stops trading and don't trade the afternoon session because they made money. ICT's giving you bullshit, whatever, because they want to cherry pick things out of context. I'm telling the new students, don't try to do a lot. Try to find one good setup per week and then build on that over time. You can see clearly there's a lot of opportunity, lots of opportunity to find setups after setup after setup. But if you feel like a kid in a candy store, you're gonna try to do everything, and that's not a good thing. You want to just pick your shots, know what you're trying to do, and focus on that only. And that's what these discussions help you be reminded of, because it's very easy once you start making money, whether it be in a demo, a funded account, or live, you get drunk. Like you get drunk on winning, and you think that I can go in there again right now. It's still running. Let me get in there again. Oh, it's still got some more juice in it. Let me get in there. And then that's it. You give it all back and more. And then you're mad at yourself. You're mad at me because you think I caused this bullshit. You brought on yourself. If you didn't listen to the dry points and the boring parts, that's why you're wrecking yourself. And if you've wrecked yourself, go back and listen to those boring parts of the lectures, because that's the shit that keeps you on the straight and narrow. So anyway, here's NASDAQ hourly chart. And where are we at here? 8 a.m. So we have this big wick here on the hourly chart. Trying to figure out what this is here. I'll bring it back up in a second. Body to low, and I have the gradients in here. Okay, so we can see to midpoint, which is consequent encroachment of a wick or tail. For your notes, I failed to mention this earlier. I apologize for the folks that don't know. I treat every one of these tails and wicks, I treat them the same way as I do with a gap. Okay, the algorithm refers to that area as a inefficiency or a gap, so it's treated the same way. Midpoint is consequent encroachment, and if we are looking at this wick here or tail, the low for maintaining bullishness would be consequent encroachment, which was 15,054.5. So as long as price does not close below that, everything stays bullish. The best scenario for continuation on the upside would be from the high of the wicks, or the tail here, down to consequent encroachment. Look at the bodies respecting the upper quadrant of this entirety of this tail. There's the upper percentage of it, or quarter of it. Look where the bodies are stopping. The wicks do the damage. So when I'm watching price, I don't have a fib on the wicks. I'm looking at it, okay? And I'm just eyeballing it, roughing it like this. When you're watching me do executions, when I'm reading price action live, candle by candle by candle, and I may not go into the details like this, I'm looking at that and saying, okay, roughly that's about half. And then what's half of that to the upside? We're about here. And I'm watching these candles as it happens. In this instance, or anything similar to it, are the bodies stopping at or real close to the upper quarter or half? If we start seeing a body going down into the 50% or consequent encroachment and starts going lower, or a close rate on the consequent encroachment, that's a warning sign to me. I'm thinking, okay, this is probably going to give up the ghost and go lower. But simply because these two lows here are in close proximity, that's not enough to warrant that this drop here is going to keep on going. I'm looking at all these tails and I'm measuring the willingness of the bodies to close and or open at their respective, either the quarter percent or half. It's consequent encroachment or the upper quadrant. Not wanting to see the lower quadrant even ever being revisited. And we're not seeing that here. And the market does, in fact, tear up higher. So it's one of those things I'm using and utilizing while I'm reading price, tape reading with you all, or if I'm watching price on Twitter and I'm calling things out. I'm looking at all these things and weighing it all out. Okay, so we have a balanced price range in here. A balanced price range. Okay, what is a balanced price range? It comes in many forms. I shouldn't say many. It comes in a couple forms. But as I was mentioning earlier in the workshop video today, we have talked about how markets stay in a range. And when they leave that range, because upside and downside has been delivered on price, it makes it a balanced price range. What happens when it's done over the course of a couple candles and not a multitude of candles? Think about it like this. If I was in a live setting, say if I was on a stadium, or not a stage, listen to me, a stadium. If I was on a stage, okay, and I was in a room full of a lot of you, okay, I would right now ask by a show of hands, by raising your hand up, and you don't need to do it, I can't see you. I know some of you are going to do it. Raise your hand if you have been in trading long enough to remember what a key reversal is. Okay, a key reversal would be a day where it's like this, and this right here, all of this movement here would be absent from the chart, and you would just see the market would be here one day, and then the next day it would be gapped down here, and then the next day it would be gapped up here. And all of this movement would be invisible. All of this movement would be invisible. It would just be looking just like that, okay? That is a key reversal or a island reversal. Very, very classic, old school dinosaur type of trading. And that is essentially what I'm trying to take your attention to, because that element of separation, that once price goes to an extreme, which is what it's doing here, because see what we have here? We have a low. We run through that low, and we do it on a very large candle. And then we come back all the way back over top of that again. So these two candles right here, this represents a balanced price range, because it's reached down to a level, and it's offered on one single pass all this move, and the next candle over here, one single pass. So the way I do this and I define it is this. Which is higher? this candle's low that moves back inside of this up move of this candle, excuse me, this down close, this down movement on this candle eats into this up close candle, but only to this point. This low or this low, which one's higher? Clearly this one. This is the only candle that is defined in the range that this candle goes lower and this candle goes lower. So what I'm saying is the range is from here to here, extended out. Okay, so this makes a balanced price range. All of this in here, I don't care about. I could care less about that. What I'm looking at is this relationship. I'm not sure. It must be the outline. Yeah, it is. So it's the bottom one. Bottom one, right? There we are. So that's the balanced price range here. And what I'm trying to convey to you is that because we had single pass down, single pass up, this is balanced now. Once we leave it here, what that means is this range, you define it by what I just showed you here, the highest and the lowest extreme between both of these up close and down close candles, this entirety of that range, low to high. Where are the bodies of the candles over here stopping? I know, it's some serious shit there, ain't it? That's algorithmic. All the bodies of these candles here are respecting the midpoint of this balanced price range. How the fuck can you go back through any retail stuff and see this being taught anywhere else? It's not. It's not anywhere. These are things that you wouldn't learn by any book. None of that shit exists anywhere. This is stuff that's authorship. So when I'm watching a balanced price range, or if I make mention of a balanced price range, what I'm suggesting to you is that there is a definitive boundary that at which I don't want to see breached on a candle's body. Okay, I don't want to see it move beyond this. In this case, we were looking for what? For dollar, move lower. So a lower move in dollar is what in other asset classes? Risk on. Risk on is dollar lower. So dollar lower, all foreign currency higher, and it gives the freedom for stock indices to go higher. Knowing that the dollar index and index futures are not lockstep. Every point higher is a lower move in this or that. It doesn't move like that. Okay, much like when I taught bonds and the yields, how the yields will move and they'll cause a long-term effect on foreign currency because they're going to chase that yield. But the yields can change, and the delay between all of that shifting in the currency, it's not an immediate thing. Just like commitment of traders, net trader position. Just because the commercials are net long doesn't necessarily mean it's time for you to go long. So there's rules to all these things, and that's why it's important not just to simply watch one video or one lecture and think you come away with understanding it. It doesn't work that way. But when I give a boundary to a marketplace and I code in a limitation of how far the market's going to go, it's limited to a degree of this is how far you're allowed to go. But then the wicks are permitted to do a certain measure of damage, which is what we're seeing right here. The halfway point of that range, nobody's going to look at this stuff here, okay, and define it like that. It isn't anywhere else, okay? I codified this, so I want you to understand that. These candlesticks are supporting the idea of the principle I'm teaching to you. It's not limited to just this. It's happening every time I tell you there's a balanced price range. This is what's occurring. The market's returning back to equilibrium. That's what this is here. Okay, it's not consequent encroachment. It's not mean threshold. It's equilibrium. A balanced price range is going to go back to equilibrium. The bodies in here are supporting that. As long as we don't get any close lower, there is no manual intervention. If it does, there's manual intervention and you abort it. This is just supporting the idea that it's going to go higher. So what you want to see is you want to see the market want to move up, and then create more power 3. Power 3 is open, down, close, rally, close on the high. Open, drop, rally, close on the high. Do we see it here? Drop small, rally, up, close. Open, drop down, rally, come back, still an up, close. So much of a small little movement you can't even barely see it, but up, close. We open, we drop down, rally, up, close. What is order flow? What is the order flow at that time? Is it bullish or is it bearish? Bullish. At this time right here, okay, on this candle's close, on the very next candle, on a 15-minute basis, you can use power 3 on that one 15-minute candle right there. As it opens, it drops down. You can be buying anywhere in the upper 50% of this candle here and expect this range here to stay open. Why? Why would this be expected to stay open? You see this candle right here? This is the same thing occurring here with more candles in between. This is all time distortion. I know, this is too complicated. Fuck this, give me a moving average. I know some of you were getting frustrated because but you want to learn, and I'm willing to teach it to you. But you don't need everything. But I'm teaching you how I do these things. How do I determine when I'm doing live executions? I say this is going to stay open. It's optimal for this fair value gap to stay open. You're asking me to teach you, so I'm teaching you. The same element of delivery here and here, that one single candle right here, imagine this one candle. If all these candles from this candle here to here were compressed into one interval, it would be the same thing happening right there, just more candles. That's all it's happening. So my eye is going to this, to this. So now let's use the same criteria, okay? Which is higher, this low or this low? This low. So there's your, we don't want to anchor it to that, okay? Draw that down. Come on in. I use it's not a mouse, it's a touchpad thing. Which is lower, the high of this candle or the high of this candle? Let me take this off so you can see. Get off. This high or this high? Which is higher, this one or this one? This one. So this high and this, this low and this high is the two reference points. But you want to expand it down. You want a full encapsulation like we did over here for a balanced price range. So this is a lower fair value gap than this one. To what degree? What measures the distinction between this being lower than that one? It's this candle here. In other words, think of it like this. I know what I want to say, I just can't find the words to, they're escaping me. All right, if we were looking at both fair value gaps like this, which one's higher? This one, right? So to identify and map this out, we use this one as the high, and we drag it down to here. Okay, so all of this is a balanced price range. It should never come back down and through the midpoint of that, meaning there would be a small portion of this gap left open. So let's play devil's advocate for a moment. Say it went down into this range. I would not be concerned about it doing a complete closure here because we have this fair value gap and this fair value gap that basically overlap in this range right there. So we have this portion over here and over here. So this creates what? An island reversal. multiple candles that are segregated from all the movement here and here. So how I internalize it is all of this right here was manipulation, just like all of this is manipulation. So the purpose is to offset existing liquidity for the purposes of anyone that would be profitable once we get above this high. It's all spending time down there to allow offset longs to be taken out. And who would assume that position if they're getting knocked out? Smart money in the market rallies. Admittedly, balanced price ranges are going to be requiring a lot of education, a lot of teaching. Okay, and I promise you that you don't need it, but you asked me to tell you how I know certain fair value gaps are going to stay open, and I'm not hiding it from you. I'm telling you, this is it. This is what I'm doing to do that. Okay, they're all principles and concepts that I'm using to implement to determine when fair value gaps are going to stay open. And I know I'm talking to you right now over this chart that's after the fact, but I don't know how many of the examples you've watched me trade where I'm doing live examples, I'm entering and I'm managing the stop and I'm taking partials and hitting targets. I don't know how many of those examples I've shown or that you've seen, but they predominantly have been shared on Twitter because I usually put music behind them because I like to do that. But I still show them on my YouTube channel too, but most of the time they're being shared on Twitter because it allows you to see a very small 2 minute, sometimes less than 2 minute and 20-second compression of me executing. And every annotation I'm talking about and showing, if I'm talking about how a fair value gap should be, it would be optimal for it to stay open and not close. I'm using that either as a breakaway gap. These are the two primary functions, okay? Either I'm treating it as a breakaway gap and it should not close fully, meaning like this gap here. Let me draw it in. Man, I should have charged admission today. This is too good for the books. This gap here, it should stay open to be optimal. That means it's the best case scenario to see this stay open. I would say that about this one regardless because it would be treated as a breakaway gap. Why? Because this over here is a balanced price range and it's in equilibrium. And the body supporting that idea is seen here. Then we see price moving here, and then we have this big extrapolation, but yet to take out this high. So this is the draw. This is where price would want to reach up to because there's real liquidity above here. What kind of liquidity? Buy side. This gap is moving quickly away from all this consolidation around equilibrium based on that balanced price range. And I know some of your heads are swirling right now, like, what the hell is he talking about? Example after example, spend time with me. Every time there's a balanced price range, I will bring your attention to it, okay? I do it in live executions. I talk about it in advance. I talk about it in tweets. I talk about it in reviews, okay? The more time you see it, the more exposure you'll have to it. But for a breakaway gap, and some of you thought I'd never get to this topic, huh? A breakaway gap is expected to form when, for instance, say we're bullish on a market and you have identified a key level that would support as or be presented as support and that is acting as a discount array. Balanced price range at equilibrium. That's one of the PD arrays that is not taught in the mentorship core content where I show you the PD array matrix and I give you a spectrum of where they are. A balanced price range can exist in any place in a discount or a premium. So there's no real definitive place where they work in an hierarchy, whereas the hierarchy I show you in the PD array matrix, the ones that are there, that is a static, that is very finite. They nest in that order. But there are other PD arrays, like this one I'm showing you here, and like event horizon. Those things can exist in any range of that spectrum, which we define as a discount or a premium. Okay, so and if you're brand new, that just completely went over your head. But I promise you, dig into the content, and it's there. Don't try to think you're going to learn how to do all this stuff right away. And you don't need to know everything. You don't need to know a fair value gap that stays open. You don't need that to be profitable. But I'm making it available to folks that want to know everything that I'm willing to share. So you asked, I'm teaching you how to do it. So even if this didn't have this gap over here that creates a balanced price range between these two fair value gaps, the fact that it does this move here and creates the fair value gap, notice there is no gap here. All through here until this candle forms, no gap is there. Everything is efficiently delivered. Every previous high is touched. Every previous high is touched. This one goes outside the range of it and even goes deeper. But then you have this big extrapolation to the upside. So this gap here, even if this wasn't here as a fair value gap, this gap that's shaded here, I'm being conscious of whether or not this live stream's keeping up with, because I noticed the one on the 13th when I was moving my cursor around, what I was talking about wasn't showing on my cursor. So I'm hoping that's not the case here. But the one that's shaded, let's put it that way, I would treat that regardless of the gap on the other side here. Whether that's there or not, this is classified to me as a breakaway gap. Meaning that a breakaway gap, I don't want to see it completely close in. It can come back down to half of it, but because there's a balanced price range here, I wouldn't want to see even half of it traded to. So then you would see me say, I want to see this trade, remain open. It would be optimal for this to remain open. But the very next candle here, the same thing. You would expect it to do what? You can see it open, and then the previous candle's high over here, overlapping this one, that would be otherwise a fair value gap if this wouldn't make the low as it did here. This low completely returns back to that candle's high. So any movement from here down into that, you could be a long entry. Or if you're already long, you can pyramid. So when you see me showing you a 1 minute chart or a 3 minute chart, whatever time frame I'm utilizing, I'm showing you, I'm not trying to hide anything from you, but I've been very open and candid about that I'm looking at other time frames. So this is a 15-minute candlestick chart. If you were watching all of this movement from the open of this candle down to the low of it, and then we're watching it on a 1 minute chart, it would be not so clear probably to what it is it would be the factor for me to trust that drop down, where some of you might be freaking out thinking, it's hitting this area or this area and in that resistance or whatever. I don't feel those problems or fear because I'm trusting that the order flow is being supported by every candlestick. That's real order flow. All the candles are supporting each other. There's no trend line required. There's no moving average required. There's no VWAP required. Nothing. It's pure price. Just pure price. And then we get one down close candle, and that happens after the high's taken out here. Where does it trade back down into? Relative equal highs. All of this overlapping in between this area here, that is creating a very strong balanced price range in and itself. All of this movement in here, it's back and forth, back and forth. So it's showing that it's not willing to go below 15,216. So what is it more likely to explore? Buy side that's existing. Where would that be? Above here, and keep pressing higher. So it's a matter of reading a lot of things that if you're really not interested in becoming, versed in what it is I teach, this is where we depart, where you're like, okay, this is too much. I'm not interested. Okay, it's just too much. It's contrived. It's conjecture. It's hindsight. It's that. But I'm telling you, everything that I'm doing when I'm doing the executions and the things I'm leaning on when I give you the analysis, like I did on the 13th, it's based on all these things at the time when I'm looking at the chart. And when I'm watching a 5-second chart, a 15-second chart, 30-second chart, a 5-minute chart, or an hourly chart, all of these things I'm looking at. Notice the same things that I'm looking at are continuous. Discount or premium, inefficiency or liquidity. The only separation from those things for analysis purposes is the relationship to the balanced price range or the lack of a balanced price range. Did you pick that up? There's no necessity for you to understand the balanced price range. Just know that you will see things that will not present an opportunity for you because you don't understand it. Notice that you would not need this to take any trades. It just gives you more clarity about how to read price action and know where you are in that price delivery continuum. Where are we at in relationship to where price has been and where is it heading? What reference points is it using for a new point of buying, where you can then break that down into smaller fractals, which is what I've shown you here with each individual candle. Power 3 is essentially the open. If you're bullish, it's an open down move that you want to go long in. And that's the part that Larry Williams was saying he didn't understand how to do that. And he made a facetious comment saying that, I don't know, maybe if he knew their zip code, it would help, which was silly, obviously. But um, it to me was like a personal challenge. Like, well, shit, if he can't do that, I'm going to spend my time trying to figure that out. So that's where I got the idea of stripping down the market and looking for discount the premium, the opening price. When it's bullish, I want to be looking at the open or less to buy. Whereas at the time when I was learning from his material, he was teaching and trading with real money, buying on strength. So he would buy some measure of the previous day's range, usually 20% of the previous day's range, added to tomorrow's opening. And if it moved like that, he would buy that and consider that buying strength. I tried that and got my ass handed to me. I could never make that work for myself. I'm not saying that it doesn't work or that he didn't make money with it, because he clearly did. I couldn't make that work. So I understand when I teach a specific concept, and it might be the balanced price range, that you're probably looking at this is too complicated. Don't worry about it. Stick to the things that make sense. I did the same thing. I had a love and an adoration for Mr. Williams when I was learning all this stuff. I trusted him with everything. Okay, I was literally throwing money in brokers' accounts just to test a new thing I learned that day. Okay, so I mean, it was. I understand what it's like, the fanfare that comes around somebody that you have a lot of affinity for, but don't do that with my concepts. And really spend time with measuring what it is that makes sense to you, that you've done the due diligence and back testing and seeing what one of these PD arrays that makes sense to you. And the obvious ones, the easiest ones that you see, that's the one you spend the most time with. And most of you are going to determine your model is linked to that. And bloom where you're planted. Don't try to tinker with it too much. All you're trying to do is find something that separates from where the market is right now, where it's likely to go, and measure risk that you can afford to take as a loss. And then you repeat that over and over again. And that's profitability. That's consistency. That's continuity, which brings longevity. You don't want to be a one-hit wonder, get a 5-figure withdrawal from a funded account and say, hell yeah, I'm balling. That's not success. That's what everybody's treating it like right now. They want to get funded and get a lottery win. Okay, I'm not teaching you how to be a lottery trader. I'm teaching you how to be a long-term, consistently profitable trader. But that doesn't happen overnight. Some of you think you can make it happen like that. It doesn't work like that. It doesn't, because you're going to bring in all kinds of things that you have to wrestle with, and you're going to swear up and down that something I'm going to teach or taught or will teach is the replacement for what you think is the best thing for you. Every time I bring something new, you're going to question the thing that may be showing you evidence that this is your model right now. Don't let me sway you with something new. It'll always be on the YouTube channel. Whatever I'm teaching is going to stay up. But wherever you start seeing success, even in the early stages, don't abandon that. You have to give yourself time, and you have to stick with something long enough to know that you have a foundation in it. And you're going to see that all these PD arrays lean on one another. It's like a web that it's a whole entire structure. When I look at price, I'm seeing all of it at one time. Some of the things I want to see, I have to wait to see if they're going to manifest. And that's usually on the heel end or backside of a high impact or a medium impact news driver. All right, so let's go into a 5-minute chart. Excuse me. All right, so we have all the balanced price range equilibrium. We have the breakaway gap. We traded above. We have a down close candle. So what is this? What's this down close candle? Bullish order block. Does it have a fair value gap? Right there. What time of day is that? 10:05. What time is that? That's your AM session silver bullet. So ICT silver bullet. You can trade this gap right here, which would be encapsulated here. What time do you start looking for an ICT silver bullet trade? If you're trading in the 1 hour spectrum of 10 a.m. to 11 a.m., you start with your 15-minute down to 5, 4, 3, 2, 1. If you don't see it in the 1 minute or higher, drop down into the seconds charts. If you're adamant about finding one, it will be there. It will absolutely be there. Let me tell you why. Okay, here's the why behind a silver bullet. Okay, there is always, folks, just like a partial profit pays every fucking time. It's 100% profitable. When you take a partial profit, it never fails to pay you. That's why I teach you to do it. You're always winning taking a partial. It never, ever, ever fails to put more money in your account. Think about that. And there's dumbasses out there that'll tell you taking partials is the stupidest shit they've ever heard, because you incur the initial risk and you take less than you tried to make when you first put the trade on. You don't fucking know if that market's going to go there, Yahoo. And you, as a new developing student, you have no idea it's going to do that either. So when it gives you the opportunity to take money out, you do it. And over time doing that, you learn more about yourself. You learn more to trust. Okay, I've seen this before. Let me expand outside my comfort zone. This is where I normally take the majority of my trade off. Let me just take a small portion and move my stop to break even and graduate in my experience and seeing what it feels like to go into these scary moments, but still taking profits. Nobody, no fucking Buck Rogers jumped out there and said, I know how to trade. This is the model I'm going to do. And it's full bore, full pull, no partials, and I'm doing it all the time. That's an asshole. Okay, that's an asshole that tells you that, and it's an asshole that's telling you to trade like that. You don't know when these markets are going to have manual intervention. You have no idea when it's going to turn on you. Nobody knows that. If I didn't have the respect of the risk that's available in these markets, I wouldn't use a stop loss. And I'm the guy teaching you. I'm telling you, I get pissed off when I see students sending me their screenshots of their trades that are open. The first thing I'm looking for is where their stop loss is. And I usually bite my tongue because I don't want to embarrass them. But if you're sending me tweets and you're sending me your open profit trades, whether it be live or demo or funded account, if you don't have a stop loss on there, just know that I'm cringing. I'm cringing because you're not using a stop loss. That means you're fucking gambling. You assume that you're absolutely right. There's no way you can be wrong. And I don't even think that. I authored all this shit and I still have to use a stop loss. Because you don't know when chaos is going to show up. You don't know when uncertainty enters the chat. Some unexpected event, some bomb drops somewhere. Someone declares, WA, are you paying attention? So, why do silver bullets work? Why will they form? Because there's always going to be displacement between 10 o'clock and 11. Why? This is the part where you take notes, folks, okay? In the hour of 10 o'clock and 11 o'clock in the morning, New York local time, what has happened already? The market opens at 9:30. The opening bell, I mean, we've been trading all night long, but the opening bell happens. Ding, ding, ding. Everybody's now paying attention. Everybody's clapping their hands. I never understood what the fuck they're clapping for. But the bottom line is that markets open. 9:30, bells ring. Now everybody's rushing out there to buy and sell stocks. Great. Retail trader John Q. Public is watching the ticker tape and he's saying, okay, my stock opened up $2 more where it closed yesterday. This is amazing. I'm making money. Well, that gap's going to close likely, and then it drops down. Then after that gap fills, if it fills at all, then there's new sentiment that shifts. Okay, it either overlaps that gap and breaks down, then it treats the low of the gap as resistance and keeps going lower, or it fills the gap, rallies up, treats the high of the gap as support, and then continuously moves higher. There's your gap theory right there. Use that with new week opening gap, new day opening gap, any fair value gap, any real liquidity void. That's how you treat it. Now, What separates the support behind that gap is the consequent encroachment, the midpoint, how we trade there at time of day. At 10 o'clock, we have 30 minutes behind us, which is why I tell you the 30-minute opening range, that's important. Every algorithm uses that first 30 minutes. Every one of them. They use that to refine a very specific range to look for inefficiencies and allow sometimes liquidity to form below or above it, and they'll do another pass, go back below it, take stops out, and then run through. Or don't return back into it at all, but just half of it. And then it runs higher or lower in deference to whatever the bias would be for that day. But the main takeaway is at 10 o'clock, you have 30 minutes of trading after the opening bell. So that initial flurry of rush to do something, John Q. Public is doing their trading then. And they're usually apt to be wrong. So we allow for that to take place. We don't have any bias ahead of time. We don't care. And we wait and see where price delivers from 9:30 to 10 o'clock. Now at 10 o'clock, we refer to where we think price is going to go anyway, where we've been calling price for NASDAQ. I'm going to use the continuous contract just to get a higher time frame perspective. Okay. Buy side liquidity here. There. And we have a order block there. Why this one, Michael? This one stretches down. It's relatively equal lows also. I'm using that as a reference point. You wouldn't be wrong by saying this one. Okay, I'm just using it because it's lower. So it's a lower hanging fruit objective. Doesn't mean it's going to go there. It just means that's how I would look at it like that. Excuse me. So if we have this buy side liquidity here as a potential draw on liquidity, and then drop down into, I forgot what time frame we were on, 5 or was it 15 minutes, right? Yeah, it's 15 minutes, right? We have this as a buy side liquidity, and go back into, well, we're looking for higher prices nonetheless. Lower dollar, risk on euro dollar higher, pound dollar higher, and equities are permitted to trade higher. Our focus was on ES. That's the one I've been teaching through. There was an unfilled or retraded to weekly imbalance or volume imbalance on the E-mini S&P. NASDAQ has been the upside performer. So even though NASDAQ has already moved up, you could take trades in ES. But if you're trying to take a trade, it's like if you want to use relative strength analysis and you want to do longs, the one you want to be trading is the one that's showing the outperformance on the upside, which has been clearly the leader in tech. So NASDAQ has been the upside leader. ES will follow in suit by sympathy. Okay, so it's a sympathetic price rally. It's moving in concert with what has been shown in NASDAQ, and it has to catch up to what NASDAQ has done. For the purposes of making it clear, I'm going to use the June contract because you will remember these inefficiencies. Okay, so here's the NASDAQ. Remember I told you there's the inefficiency. We already worked inside that one. If we look at it from the perspective of the ES, we only went to this high and we have yet to trade up into this inefficiency. So in my opinion, we have much more room to go up on the upside. Now, if you take that insight and you add it to the new front month based on the volume, we have this here. Okay, so this is the month that we're trading in for ES, and then we add it to NQ again. We can't pull that up because of the data is not being there. So I'm referring back to the previous month that will be expiring, knowing that we're likely to continue. But I fall away from the analysis from NASDAQ and rely more so on the ES, because ES should move sympathetically higher to try to catch up. That's the theory of Six Sisters. Six Sisters, we have the leadership in NASDAQ, but in ES will try to move in concert with. So we may see in the future a consolidation or a lack of leadership on NASDAQ, and then more upside offered on a bigger day move on like ES. It might not happen, but that's how I treat the Six Sisters. So as long as the leadership issue goes higher, which is NASDAQ, that should pull up. Like, for instance, all boats rise in high tide. That's the moniker I'm using here. Everything goes up when the tide goes up. So, but if you contrast that with what the Dow is doing, this thing's lethargic. It just doesn't want to join the party at all. But we were able to see it do our run to our high here. On NASDAQ, I told you I was waiting for CPI on the June 13th live stream. I was aware that the CPI number could potentially cause a big dive lower for the purpose of the sell side, but it would just be the purpose of taking out stops and then resume. That was the whole premise when I talked about NASDAQ. You can go and watch the live stream that's there in the commentary. And it was a similar idea with ES, so it was kind of like wait and see. The only thing I was definitive on stock indices at the time of that live stream, at the 18-minute and 49-second time period, I pulled up this chart here, and I said that 39,628 would be the draw on liquidity, which is the May 1st high. And that's where we saw it draw up into, and it stopped pretty much right after that. Retraced lower, and now we're piercing it again. I don't trade the Dow. I use it as a barometer like I use the dollar index. So I'm looking at the relationships between the three averages. So this is typically understood as Dow theory, which I think in obviously using stock indices, it works. It's a proven method, and it's comparing the averages. They should confirm one another, and I'll show you what I mean by that. Let's pull up the ES chart, and we'll pull it up on a. So this is what I'm thinking we're going to reach up to, so that way we know in case I lose track of what I'm saying. I think ES is going to pull up into 4,500 or just below it. So there you go. You have an expectation of what I think we're reaching for. I know someone's reached out and told me that Larry Williams is calling for, a retracement or moving lower. I don't see that happening until we get up to here for at least for ES. And I'm happy to be wrong against his analysis, but I'm sharing what I think. All right, here's a 60-minute chart. Let's do a 15-minute chart. I failed to mention earlier, a 15-minute chart is a bellwether chart. Like, it's, to me, like if I was forced to do anything less than a daily chart, and I couldn't do anything below a daily chart and just use one time frame, it would be the 15-minute chart. Like, it gives you the best of the best in terms of short-term entries and targets, because everything you can find on the daily, you'll see it on this if you compress enough. You'll have better refinement of those levels too. You can get short-term trades, you can day trade, you can scalp, you can enter into long-term position trades. It's the time frame that does all. I'm not limited or satisfied with that, because that's why I go into lower time frames, even sub 1 minute, like into the seconds charts. I don't advise the new people to do that, because you can read into 15 and 5 and 10 and 30-second charts thinking you see something there that on an hourly chart is like rocket fuel, and boom, these things can move like 40 handles on something on a higher time frame basis on a news driver, and you're thinking you're seeing a fair value gap on a 30-second, 15-second chart, and you get roasted. All right, so anyway, ES here on a 15-minute basis. You click on this little thing up here for compare, and you're going to type in or find it in here. But I'm going to show you how to do it, because assuming you don't have it on your chart yet. NQU2023. If you do it like that, it's going to plot it right over top of your chart. I don't like that. Okay, what I do is I go over here and I set it to, and I know some of you are going to say, well, if you do this, you do. I know. I know. candlesticks. You can do it on a line basis, but I'm going to show you the candlestick version, okay? I did this wrong, didn't I? Yeah, I did it wrong. I have it set up as a template. I've been spoiling myself with it. You can create little templates over here. And we'll set this on new pane. New pane puts it down below the price. And you want to do it with a Dow also. And I don't see the Dow here, so. Now, if you're going to use it as a line chart, since we're looking at lows, okay, this is how you back test, you study it and get your screenshots of it. If we're bullish and you're expecting it to see a rotation higher and some divergence, which would be SMT divergence, you're plotting on the low. So that way you're comparing the relationship of the low of ES or whatever one you're using. This would be my trading instrument. And then for NASDAQ, I'm plotting this line chart on the basis of the close. I'm sorry, on the low rather. And the same thing with the Dow. You're going to do it on the low. And then squeeze it up a little bit. And you want to compare the low. Do we see a lower low here? On the NASDAQ we do. And it looks like we see a lower low on the Dow. So there's no SMT divergence there. Same thing here. Lower low, respectively. Lower low, respectively. So if we see a time when there's a lower low in your trading instrument, whether say you're trading ES or you're trading NASDAQ, when you compare the other averages against it, if you're long or wanting to go long, you want to plot this, and if it gives you a divergence, it acts as a qualifier. You can take and you will take trades without SMT. But when SMT forms or a divergence against the averages, or if you're using it against the dollar against the euro, or the pound versus the euro, which is a correlated pair SMT divergence, when you're looking at two closely correlated, which is essentially what we're doing here. This is a correlated pair SMT, but with index futures, if they were considered pairs. A correlated pair SMT divergence would be euro dollar making a lower low while pound dollar makes a higher low when dollar is bearish. That would mean dollar goes lower, and the one that makes the failed lower low, that's the relative strength leader. That was the one you would be going long in either euro or pound, whichever one makes the failed lower low. So there's a lot of measuring that goes on when I'm watching price actions. If you heard me many times mention, I have a lot of monitors. Okay, you don't need a lot of monitors, but you need to be able to have at least two charts open. And that could be done on a laptop, like I was showing you here earlier, or it could be a secondary monitor, in your system. It's very, very difficult to trade on your cell phone. Okay, it's not impossible. I mean, I've done it, but you are literally looking through a very small window of what is going on, and it's very easy to get fixated on whatever you're seeing in that small little 4-inch universe, or whatever big your instrument is, or tablet or phone is. You're missing out on a lot of information. And the way I trade is I look at all these other things I'm showing you here today. Each monitor has its own real estate, what it's responsible for, what markets to follow, what time frames I have on there. All of those things I'm monitoring, I'm constantly getting a new refreshed view of everything from the higher time frame down across a lot of markets that are closely correlated. So I'm using intermarket relationships and intra-market relationships. So that way there's a relationship between how markets are either positively correlated or inversely correlated. And they should agree on the most part. I'm allowing for this discrepancy or crack in correlation where it's expected to form. I do not look at charts. Okay, this is very important. I never look at charts for the purposes of finding an SMT divergence. Look at the lows here. We have a higher low here. We have a higher low here, but we have the lower low on Dow. See that right here? That's a divergence, that's an SMT divergence. I used to, when I was younger, when I was first dabbling into this, I would only look for it to form and trade based on that. And I had not handed to me. It's only when you know where the market's likely to draw to, it creates a real measure of accumulation and distribution. Larry Williams has a accumulation distribution formula, which when I first learned about it, I fell in love with it. And for commodities in higher time frame price moves, 4-hour and daily, I found that it was really good. But eventually, it's just didn't work as well as I wanted it to, and didn't form enough. But I was using it as a means of getting into some of my trades when I would look for something to go long. The qualifying thing was the 50-day moving average would be bullish. In other words, it's sloping up. And then I would look for an oversold condition on an hourly chart with a stochastic and the Williams per being oversold. Then the very next day, I would look at the opening, and as long as it dropped from the opening price down, I would chase that going into longs. So I would be going there and buying it. I would never want to go short. I was afraid to short. I didn't understand how to short. So everything I did was primarily going long. So my model would be supercharged if I saw a accumulation distribution bullish divergence. So I don't want you thinking that it's a magic bullet, okay, where all you have to do is look for a divergence and that's your entry. Because divergences, as you saw earlier when I was showing you the euro dollar events against the dollar index, there was a SMT divergence at the time. That would have been a qualifying thing for me to say I'm done and I wouldn't hold for the trade anymore. But you watch the dollar rotate go lower and the euro dollar make an even higher high. So I would have missed whatever that move is, and if it's even going higher, I don't know. I haven't seen it since we talked about it. But just for the purposes of SMT alone, that divergence does not mean anything. Coupled with profit taking when it meets the time of day where you should be trying to close up shop, or at least try to get the majority of your trade in real profit and not open profit, where you actually take partials and now you're booking that profit. That to me is more meaningful in the sense of using it. Or if it does form an entry with a SMT divergence at the time of day and it fits the criteria and your draw on liquidity hasn't been reached or target has been reached for yet, then it's more meaningful to use it. But being in of itself, it's useless. Okay, it has to be used at the proper context. And I see a lot of new folks that have just recently gone through some of my stuff. They're like, I don't hear you or see you talking about SMT. It's not required. It's really not. It's just one of those things that if it's there, wonderful. I don't look at COT every single day I take a trade. You don't need it. It's just a qualifying thing that just adds more support to it. If you're a long-term position trader and you want to trade that way, commitment of traders and seasonal tendencies coupled together with what I'm showing you here, that's a winning recipe. Like that is a really good model. And just use the entry models that I've taught, like with the 2022 model or even the silver bullet trades. And you thought I wasn't going to answer the thing. You started to talk about why silver bullets form and how they form and why is it there. They're always going to be there because of the first 30 minutes of price delivery. You have 30 minutes now in the marketplace. The rush, the mad dash to get in there and do something, to buy and sell, that's already in the marketplace now. The initial surge of institutional orders being thrown out there for their clients or their own, that's in the market now too. So now we have 30 minutes behind us. The initial impulsiveness that usually comes into the marketplace is now behind us, and now we're in the first full hour of trading after the bell. The first 30 minutes is done. That's like the Asian range, okay? Now we have the real move, London. Think about it in the 24-hour cycle. Kind of, I'm probably confusing some of you, but the long-term students know what I'm talking about. I'm looking at that range of the intraday movement on the morning session as the same impulsiveness that comes into London, where there's a lot of volume that comes in Forex. That same thing occurs in that first full hour of 10 to 11. They all want to make a mad dash to find profitability. And a lot of the algorithms wait for that first impulsiveness to run higher or lower, and that inefficiency that you find on the time frames and the models I'm showing you, they all dogpile on it. They all dogpile in on that one there. So it's not a measure of the selling or buying pressure that's pushing it. It's the algorithm itself is offering it to them. It's going to move from that fair value gap to wherever it's going to go, regardless of how many people buy or sell into that gap. It doesn't make a difference. Everything in price is scripted. It's completely manipulated. It's absolutely controlled. And the only thing you're trying to do is look for that small little inefficiency when you know where you're aiming for. You're aiming for some higher time frame target, like we outlined for Eurodollar and the dollar index. If you have a higher time frame bias, and we know that that's a directional bias that's looking for a reason to go higher, it would make sense for us to expect some kind of run higher from 9:30 going into 10 o'clock and looking backwards and seeing in that price run higher, was there any inefficiency or fair value gap? If there is, then we can use that as an entry that has to happen at 10 o'clock till 11 o'clock. The fair value gap doesn't have to form in itself inside of that 1 hour period. It can refer back to some fair value gap that formed, in the run up, if it's bullish, between 9:30 and 10 o'clock. And if you're bearish and you're expecting it to move lower, the fair value gap could form in the move from 9:30's opening down to 10 o'clock's low. So that price leg, wherever the fair value gap would reside there, it can return up into that. Many times you're going to see a lot of the trades that I've taken in the past. If you go, I was one of the things I want to ask you as a community. I know some of you out here save everything I do, and I love you for that. Has anybody got a full collection of every single execution I've ever made public? Because I don't know where they're at. Once I put them out on Twitter, like I don't know how to find them. There's a lot of them. I just don't know where they're all at. If somebody could like create I don't know, maybe a thread and throw them on that, that'd be awesome. I'll retweet it if you do it. But I would like to see them all. And you can see a lot of things I'm teaching you will make much more sense to you now that I'm teaching you like this. You'll go back and say, oh shit, there it is. I can see he just talked about that. There it is. He's doing it. But in the early stages, I wasn't trying to teach a lot of that because, I even told my private mentorship groups, I said, look, I'm going to demonstrate it, but I'm not going to go into the detail about what it all is until some jackasses want us to go out there and start selling my videos. So now I killed that whole show and put the core content videos up on my YouTube channel. That's another reason why it's not coming down when I leave in November. So anyway, we talked about gold too. I'm going to do gold, and I'll teach you the FMC setups, and then we're done for today. Let's go into gold. Let's go to a daily chart. And I always use Forex.com. I don't have an account with them. That's just the feed I go with, and I trust that one. I don't look at Oanda or Pepperstone, or I don't use any of those other ones. It helps provide a consistent medium for everyone, because especially if we're using Forex, if you look at different brokers, they're going to have a different opinion about what the high and low was, right? All right, so anyway, gold. At first, when I opened it up, I said, I wouldn't touch it. I don't know. But like I always do, I said, gun to my head, I said, I think we're going to go below the sell side here, these relative equal lows. So again, you can find that at the 20-minute and 5-second marker of the June 13th, 2023 video with analysis. Okay, so let's go into this and we'll segue into the Forex, not the Forex, but the FOMC, how to trade it. And it's the same premise that I'm going to teach you, that it's the same application, whether you're trading non-farm payroll or FOMC. They're treated the same way. FOMC generally is a much more larger magnitude of a move, but they're using the same macro. They use the same thing. It always happens the same way. It's just a much more muted event when it's non-farm payroll. So anyway, I took your attention into these relative equal lows. I said, okay, I think it's going to go there. So that's what I thought was going to be the draw. That's what I thought we would reach for. And I didn't say anything beyond that. Okay, I didn't say anything lower. I didn't say anything higher. I said, this is where we're going to reach for. So that was said to you on the 13th of June. So let's go into a 15-minute chart. We'll get through this one pretty quick. Then we'll take a 10-minute break, and then I'll come back and teach you how to trade FOMC and non-farm payroll, and then we'll bid each other farewell. Okay. All right, so this line is that level from the daily chart, which is the relative equal lows. It's the 1938.20 level. Okay, and we would be looking for a drop down, going lower. And I should have dropped into a 60-minute chart. Why did I drop into a 15? Okay, so there's those relative equal lows from the daily, but now seen on an hourly chart. And you can see on the 13th, we created another low here. So resting below here was a large pool of what kind of stops? Sell stops. Why would they be sell stops down here? Because look at the movement from here up. Traders are going to chase that. It goes down, they see it doesn't go here, and it rips one more time. So what are they trying to sell the idea of? When I say they, it's the real market makers. It's the folks that are controlling price. And yes, gold is one of the highest manipulated instruments there is. It's literally a joke, and that's why I don't like trading it. I know a lot of you like to ask about it all the time, but this one is extremely manipulated. It's like the Japanese yen. Like, I can't stand it. Okay, it's so absolutely ridiculous how controlled it is. I choose not to touch it. And just like the Swiss franc too. Good grief, he's naming everything. Below this low and this low, there's sell stops. Below this low is sell stops. So they were selling the idea that this is a trading range and buy it. Think about it. There's so many people out there on YouTube. They're still making videos like this today. I have a range here. Every time we get to the low end of the range, you got to buy it, and you can make money every time. And all of a sudden, I did that kind of stuff. At 20 years old, I did all that. The indicators and the oscillators will tell you every single one of these lows at the perfect oversold condition, and that's what tricks you. So when I stopped looking at the market like that and looked at it from liquidity or inefficiency, then I didn't rely on the overbought oversold. I could see overbought oversold relative to the range that we're trading in, which is really what mathematically is being done and tortured in indicators. Like you're defining a look back period, generally 14 period, 10 period, 9 period, and then you're basing that range as high and lowest low and where you're at in relationship to that. So you need an oscillator to tell you that. Like this right here, we're above 50% of this high to that low. Below these lows is sell side liquidity. Gun to my head, I told you that's where I think we're going to trade to. So is it higher after the 13th when I told you that? No. It only went up to go to a short-term premium. That short-term premium is relative to this high down to that low. At equilibrium or higher is a premium. We're definitely in a premium. Okay, so we don't need to see an oscillator tell you it's overbought or oversold. It's defined by that. If you pulled up a Williams percent R 10 period or a stochastic, it's going to show you overbought right there. I don't need to see that. I already know it's there. Once you understand how to read price and read what range you're in presently, it's easy to identify what is an overbought or oversold. And you don't need any indicator to tell you that. You don't need to see a moving average crossover or a MACD to tell you where market flow or market momentum is pointing. Look at what it's doing. It's building a narrative that this is supposed to be trusted as support. And that's building and engineering sell-side liquidity. So when that occurs, and I'm sure some of you watched it rally up here and thought, on the 14th, ICT's got it wrong. And the only thing it did is trade up into a premium and then wipe out. They ran right for those sell stops. What was the reaction after it did that? Look where we're at now. Now, I'm not suggesting that there isn't opportunity in this market or there wasn't an opportunity, because there clearly was. I don't want to trade in these market environments. There was a time as a young man in my 20s, I wanted to capture these moves from here to here and here to here and here to here. I wanted to be in everything. And I discerned that while it's possible, I didn't have the aptitude to be able to do that yet. And I lost money and blew accounts trying to do that, trying to learn how to do it with real money. It does not work. You have to know what you're doing and be bored with the things that you're doing in that process over and over and over again before you even think about putting real money in there. So anyway, let's take a closer look with it at the 15-minute time frame. Now we have that context. At 2 o'clock yesterday, there was an event that took place. And what event was that? FOMC, right? So at 2 o'clock, whenever there's an FOMC event, it's to be treated in 2 stages. Okay? This is going to be a general rule of thumb. It will serve you more times than not. You will lose money on it eventually if you push it every single time. I promise you that. But if you go back and study old moves, you'll be quickly convinced of what I'm about to tell you. My long-term students know this, and we expect it all the time. I had 2 folks tweet to me yesterday who I can't deal with people. If you're going to come in and you show me this type of perspective or mindset, you are not ready to learn from me. So I just block them. It's not because I don't want to take heat from people, because my biggest trolls are not blocked by me. So it's not a thin-skinned type thing. I don't have time or energy to deal with people that are closed-minded. And if you're brand new and you come to me on Twitter and I share an example of me executing, I hate seeing, after the fact again, or someone supporting that idea. Immediately, you're showing me that you are not there to learn, or you're not in the proper mindset. So I broom you quick. I get rid of you. If you think you know everything, or if you think I owe you an execution to put you into a trade that you can copy me, you don't know who I am. I'm not promising you that. And that's one of the biggest things, a pet peeve. I don't want anybody being able to copy me. I got people constantly asking me, what's the color of your candles? I know why. Because they want to take the videos like this one that doesn't have a watermark on it. And anytime I do an execution, unless I have my watermark in it, they invariably find their way onto TikTok, they're on Instagram, they're on Facebook, they're on YouTube under somebody else's thing saying they took the trade. So I don't like that. Okay, I know my own trades. I don't need to, like, you can block out everything. I know who's trading that. If I'm looking at it, I know it's me, and everybody else can recognize when I'm trading, because it is what it is. But I don't want people copying me. So if you're new and like this is the first time you listen to me, I call things before it happens, and people will tell you it's easy to do that. Anybody can do that. But these same people are all day long saying, "Oh, we got to watch to see if it's going up here. Oh, it could go down there. You got to be careful. Oh, it's getting tight in here." And all of a sudden, after the fact, they'll say, "Didn't I call all this stuff?" No, I say, gun to my head, this is what the fuck's going to happen, and there it is. Even if I'm not certain, I will tell you what side I'm on, and I'm comfortable being wrong in those instances. But when I don't say gun to my head and I say this is where I think it's going to happen, bet your fucking ass is going there. Okay, that's what's happening. So I'm not in this business to try to have an opportunity for all of you to copycat me. I am in this business to tell you how to do this. I don't need to be doing this, but I want you to succeed. But you will not succeed by copying me or trying to get money right now because you're short on change, and that'll inspire you to do it. If you don't want to learn how to do this by what I've already shown or taught or see my students doing, nothing's going to convince you. So that's why I distinguish the grade of student that comes to me, the people that just simply want to listen, learn, and practice and put the time into it. They're not going to complain, and they're not going to ask for more than I'm already giving them. And that's the people I'm teaching. That's the people that keeps me coming back here. I broom entitlement. I get rid of that bullshit. I don't have any tolerance for it. And you can have the opinion of me whatever you want. I don't care. But I'm the only motherfucker out here that's telling you where it's going to go precisely every single week, and I'm asking nothing for it. Nothing. I'm here all day today. So just know that you're not obligated to be here, and I sure as fucking obligated to teach you any of this. I love doing it, but if you come to me on social media and you talk that nonsense to me with an entitlement mindset, or, oh, it's after the fact, and you didn't go through the process of hearing me explain how all these things happen, I've already taught how this works. And the reason why I'm saying this is because I'm about to teach you how to trade FOMC. And it's the same thing with non-farm payroll. The same macro that's being utilized, okay, it's a two-stage macro. That means it's a first run and then reversal, okay? It doesn't happen every single 100% of the time, but most of the time, unless they intervene, that's what the macro will do. It will go to levels as you watch me call out on the CPI. I told you where the fair value gap was. I told you where the two pools of liquidity. The very specific elements that led to that delivery at CPI, it happened. You can't trade it. It's happening too fast, and the broker will not let you get filled. Anybody that shows you them getting filled, that is a bullshit, white label, fake MT4 horseshit. It's fake. It's fake. It's fake. I don't give a fuck who you are. It's fake. You are not getting filled on those things. It's not happening. Period. But if you wait until these reports come out, and that first initial surge, and they put the availability to trade back in place, all brokers pull their shit. They don't want to be getting caught on the wrong side of some goober that got lucky. That's the reason why it happens, folks. It's not because nobody wants to trade it or they're scared. The broker doesn't want to have that incurred risk. That's the reality. That's it. That's what's going on. Okay? But they call it something else because think about when you look at it that perspective. It's like, you assholes. I could be making money right here and you're preventing me. Yeah, that's exactly what they're doing. They're saving their own ass. They're protecting themselves. And guess what? I'd be doing the same thing. Because you can get lucky. I got lucky. I got lucky for months early on. I did. And then found out I didn't know shit. So would it make sense for someone that has millions of dollars available in customer deposits and they are over leveraging that 30 to 1 and they get right on an over leveraged position on a big fast runner, 100 handles in NQ, 50 handles in ES? Come on, man. Like, you wouldn't take that risk on either. So you can't fault them, but it's just the reality of this business. It is what it is. But you don't need that first initial surge. It's better for you to wait. And they paint all these scenarios with the first initial run. Oh, it's going to keep going lower, or it's going to keep going higher. So think about it like this. At 2 o'clock, we see gold do this run here. Rips lower. Remember, this is the low I told you it was going to go to. Did it go to it at 2 o'clock? It's a 15-minute candlestick, by the way. It drops down, but falls short of the objective and then leaves this low and this low as relative equal lows. And then it rips up higher. What's happening here? What's occurring? It's setting the stage for traders to suspect that this is support. We can go long. It's going to rally. That's not what we want to see. Go into the expectation I teach you where the fair value gap or the imbalance, it drops, leaves this inefficiency right here. When it drops, It comes back up into it there to offer an opportunity to go short. And then it delivers where I said on the 13th, which is that relative equal lows on the daily chart. It digs into it here, lower, lower, one more good time, and then rips higher today. All of this price action in here, I'm telling you, I would not be in any of that. Not in it at all. If I was looking at gold real time, I would have told you that it's possibly going to go here, but I wouldn't touch it. And that's the honest God truth. Ask any of my long-term students. I say this all the time about gold. I don't know what it is, this fascination with trading gold, but there are better markets to trade than this bullshit. But that two-stage or second stage of delivery after 2:30. See, the first move is like a red herring. Hey, pay attention over here. Look at all this. Okay. And then at 2:30, that's the real move. That's the real one. Okay. So it can come in two forms. It can go rally up, suck everybody in, thinking it's going to go lower, and then it wipes them completely out and goes lower a lot. Or it can drop lower, get everybody thinking at 2 o'clock that it's going lower, and then at 2:30 it rips and takes out the high that was formed prior to the drop. Okay, that's the buy or sell in that way. The other thing is where it drops down a lot, leaves a fair value gap, and at 2:30 it'll go back to the fair value gap, and then the real run comes. Most times it does not do this. Usually it creates a run, one direction, and that direction is a complete Judas swing, where it runs, creates a high, it doesn't come back to that high, and just makes a lower low in the day. ES. Two o'clock. I know I've got people sending me messages saying that the title's wrong. I know it'll be changed. I mislabeled my notes Friday and everything since then. I mentioned it earlier in the recording. But the 2 o'clock is the initial leg of FOMC. We dropped, rallied higher, fair value gap, drops down, rips up higher, and then one more time drops lower. If you look at the first move going into 2 o'clock, what is the first move? It's dropping down. So it's setting what's the expectation? What's retail going to think it's going to keep doing? Lower. This fair value gap is utilized twice. 2 times. Trades into here, rallies. They dig into it again today, one more time, and then they send it higher. On NQ, this will be much more impactful because I actually executed on it. It's all hindsight. All right, so we have ES. We started where I showed ES, so this is the NQ, and I want to take everything off this, strip it down to nothing. All right, so here we have NQ. NASDAQ delivery contract month is September 2023. Inside this drop, okay, think about what I've talked about here. Think about what I've been talking about for weeks in relationship to ES, E-mini S&P, and the NASDAQ futures contract. Which of those two has been the leadership on the upside? Which one has the strongest price delivery for being bullish? NQ, NASDAQ. So if we consider trading the FOMC, doesn't it make more sense if we want to go long? Why would we want to go long? What was the move that took place on the drop down into 2 o'clock? It's dropping at 2 o'clock. So there's your fake move. So this drop down here, and then they hold it here. Holding it, holding it. And And at 2:30, the macro begins. So when you're trading FOMC, if you're not writing this down, you're completely wasting your time. You have to know which of the indices that you're going to trade because of relative strength. Which one's stronger? There's always going to be a leadership issue, whether it be NASDAQ or ES, Dow. Okay. If it's Dow, I just go to ES. If it's NASDAQ, I will trade NASDAQ over ES. If it's anything leading to the weaker or the stronger for the Dow, I always elect to use the ES as a deferment. I defer myself to trading only ES, not the Dow. So if it's a matter of picking which indice I'm trading, it's either a decision of whether trading the NASDAQ, and it has to be the leadership on the upside. That means it's been going up longer, harder, faster than ES. If ES is going up longer, harder, faster than NASDAQ, if it was reversed in its role, I would have taken this trade in ES and not NASDAQ. So the first delivery at 2 o'clock was seeing price do what? Drop down. I'm going to go into a 5-minute chart. When this market dropped here, where was the most energetic price leg beginning from? Here. At this big move here. I'm not saying that you can't see this one as a high, or this is a high, or this is a high, but this is the most energetic. So all of this starts the run going into FOMC. So anyone that's in this move, where's their stop loss? Right above that short-term high. I'm aware, but remember, I'm listening to this guy tell me how to run my pool, and I'm not really paying attention to him. And I'm trying to get an example on FOMC, and I'm doing it with my phone, which is what you see on my Twitter feed. Okay, tools playing in the background. It's what it is. Okay, so I think it's going to go up here, but I can't pretend to be listening to this guy and watch all this stuff happen as it's going on. So I picked a very easy target, low-hanging fruit objective, which is going to be the buy stops resting above this short-term high. Why was I going long in here? What was I looking at? This move here. I'm sorry, this move. Good grief. This down close candle here. All of this movement in here back and forth, I'm treating that as like a very small little balanced price range. It's doing back and forth, back and forth. So I'm trusting that there shouldn't be any more meaningful run below that if we take out that candle's high. We have it here. So we take it out high. That low now becomes, that's it. There's no more need for any more risk going lower. The stage is set because what time is it? 2:25. The first stage of that delivery in the strongest of all the indices, which is the NASDAQ. I'm not looking at or caring about ES. I'm not looking or caring about the Dow. I'm not looking at relationships between the SMT. I don't care about that. It's time. The macro will run on time. It's going to favor this market because it's been outperforming on the upside. So its sponsorship is heavily on this one going up versus the ES, like it's been doing for weeks. And the Dow has already proven it's lethargic. It's not interested in performing like the ES and or not even close to the NASDAQ. So all focus would be on NASDAQ. So buying, going long, right here, what am I keying off of? Look at the arrow where I entered and what I've already told you. This body of this candle, the last down close candle, I'm using it as Bella, by the way. This movement down into here, I'm buying that right there. Right there. Bought that. Then I'm using this right here, this opening price, and inside this little area here, I want to use that as a means of wanting to go long on a pyramid. So I went long with 5 contracts, which is not a lot, and I added another one, which is I'm pillaring. What am I aiming for here? Just before we get to this high, because during FOMC it could do this wild whipsaw still and then deliver up. I want to get in, or I'm sorry, I want to get out of my trade as it approaches this high. Low hanging fruit. I don't need it to go to the high or higher to get a fill. There's my exit on this candle here. All of this rundown is completely wiped out. Ultimately taking out that high here, over here. 2 stages. Non-farm payroll is the same way. It either gives you a drop, come back to a fair value gap and continue, or it gives you a drop and completely reverse and rip higher. Everything reversed. The difference in knowing which one it is how it trades at the time, which is why I have to wait. I have to see what it's doing, how it delivers, and compare it to the other averages. That's what I'm looking for. I'm looking for that relationship between the other. It's not SMT. I'm looking at who's been leading the pack, higher or lower, whenever these reports come out. And then I'm looking for where the liquidity is. Traders that were trying to chase this, they're trapped down here. They're hoping it's going to go lower. Back up it goes. Go back and look at your calendar. And every time there was a FOMC rate announcement and non-farm payroll, study how that liquidity is taken. Study that. It's always a 2-stage macro. It always does something initially that gets people thinking it's going to do something specific, and then it rips their face off. CPI is that macro on steroids, on crack, on meth. Okay, it's literally like cocained up, the same macro, and you can't trade that. You can't. Okay, you can't. So all of these high impact news drivers and or medium impact news drivers, if you're afraid of those, just wait 30 minutes minimum. Wait 30 minutes after they form, and then see what liquidity resides in the marketplace still, and any inefficiency. And if it offers you a range that presents potential to see 10 handles, then you probably have a good chance of making 5 out of it, or maybe even more. So there's a lot of waiting around to see what happens on these big impact news drivers, because you don't know, and I don't know before it happens, how they're going to use that information to manipulate it, because they want people chasing this idea at the moment. And they know that brokers are pulling liquidity. Not that there's an absence of trading or interest. It just means that all the brokers are collectively saying, the hell with this. We are not getting caught on the wrong side. Because if they get a client or a large base of their clients that are over leveraging, and everybody predominantly over leverages, you do it too. What happens if they're right on a big move day? The brokers are out. They're not trying to do that. So wait for that initial shock, and trust the fact that you don't need that first move to make money. You don't need it. Wait for the first move in 2 o'clock in FOMC, and in 225, 230, then it's going to rip the other direction. That's what it is. That's exactly what happens. It's kind of like, well, I don't want to say it in a live stream because my channel might get flagged, but I've said the analogy before on Twitter and stuff, and I'll talk about it this weekend in a Shotgun Saturday. I'm sure you're all wondering what it is. It's not a big deal. It's an analogy I use that has something to do with making individuals run to a specific area and then attacking that once they get there for a larger impactful event. That's what I mean by 2-stage. So it's designed to corral traders into one big area make them think it's going to do a specific thing, so that way there is a pool of liquidity that's being sacrificed, and then that liquidity is being used for a counterparty. So it's tricking traders to go in the wrong direction and then raking them across the coals the other direction. So I think that is going to be it for today. We went through my entire hit list of everything, and I was a little bit short on my time. 2 o'clock. That's pretty good, isn't it? You got some value today. I talked about a lot of things that hopefully will amplify some of the misunderstandings or shortcomings in terms of your learning, and I amplified on things that I know I get a lot of requests for, breakaway gaps, and introduced more insight about a balanced price range, and preached that we focus on understanding which one is the leadership and when does it matter. When does it really matter to be in the one that's a leadership? Because you see ICT trading that, yes, even though I told you NASDAQ weeks ago was a strong one. So why aren't you trading that one? Because I'm teaching you how you can still find profitability if you did it wrong. If you found something as a setup and you didn't confer with the relationships between the averages, okay? Or if you're a Forex trader, you didn't do the relationships between which is stronger, the British pound versus the US dollar or the euro versus the US dollar. You want to be in the stronger one if you're going long. You want to be in the weaker one if you're going short. Well, when it matters most is when we have these high impact news drivers, because they're going to really capitalize and wind these markets out when they are the leadership issue. Look at the relationship between the NASDAQ here and ES. Whoops, no extra zero there. You see it right away, don't you? It was not able to climb as high. Look at here to here. Okay, I'm going to take you back to the NASDAQ. See that? Higher. That's why ICT was buying this one and not ES. And funded account traders that have found their way into, I guess, the part where they can make money and then take the money that people pay in and call themselves paid out, whatever. That is a trade right here that they could do. It's not the maximum number of contracts available that they can trade. It's less than. And that run right there is equivalent to $23,000. So you tell me, is it worth the gamble of trying to guess before the fact, or waiting for the initial impact crater to form, and then you go over there and find the people that you can pick the pockets of that they're dead already, they don't know it, and you go there and you take their money from their accounts and get out and walk away. I'll leave you with the idea of that being a good analogy or not, but I'm usually the action guy that sees things from a Rambo perspective. It's just the way I look at things. But if you want to look at it as ballerinas dancing around, whatever suits you, it helps you understand what the market's doing. It's wonderful. But my audience predominantly is male, so, and I'm a guy, so I kind of like lean to that. But one more time, you can see the difference between the two. Much weaker on ES. Okay, so it's 2 o'clock and my stomach is growling. So the only thing I had today was bone broth. So I'm somewhat hungry. I'm trying to think if there's anything else I want to add before we close it, and I don't believe I do have anything else in addition to what we've done here. Real quick, I just want to show you the Dow. Okay, so we have a drop. The fair value gap it trades into here, and they reclaim it there today, and then they sent it higher. So there's a little bit of a delay to take out the relative equal highs. We mentioned this high on the 13th of June, and that's where it hit it and just retraced lower, and now we're climbing above it here. I'm not really excited about the Dow still. If even I was willing to trade it, I still wouldn't be interested in trading where it's at. And you might be thinking, well, wouldn't Six Sister apply to that because it has a lot of ground to gain to try to catch up with NASDAQ or even ES? Maybe. I just don't trade Dow. It's a real spotty index, and it's only 30 stocks that make it up, so it's very easily manipulated. Okay, I don't want to say it in the same way like I mentioned with gold because it's nowhere near the degree of manipulation in Dow that is in gold. But Dow is very thin, okay, meaning there isn't a lot of trading that takes place in it versus the ES and the NASDAQ. And NASDAQ is a fast market because it's thinner too. So that's really what makes the ES a little bit slower. But sometimes there's a little bit of an inversion where ES will outperform the NASDAQ. But most of the time, the NASDAQ acts like the British pound versus the euro. Okay, ES will be equivalent to like a euro, and NASDAQ is equivalent to how British pound trades. British pound always exaggerates the move that would be seen in euro, which is why I always predominantly like to trade the cable, which is pound dollar. But there are times when euro dollar will outperform cable, and you have to know the things I'm teaching you here, the relationships of measuring when to look at it and when not to consider it. And you can't learn that in just one video. You have to see it, experience it, see analysis, see things called in advance, watch how it performs, also back test. All those things should be included when you're looking at price moves. Like when you're looking at Forex price runs and you're logging them for your journal, you want to be looking at other closely correlated pairs, not just the one that you see the setup in. So that way you're getting a real clear depiction of what everything else around that pair was doing at the same time. So that way it's not this in and of itself, an island of itself, saying I'm doing whatever I want to do. No, it's being subordinate to the macro that's underway in all the markets. So anyway, I think I've given you enough today to give myself a day off and a 3-day weekend. And I understand, yes, it's not Friday, so I'll be changing the title of this. And I will catch up with you, I'm sure, somewhere on Twitter. I don't know. But if I don't talk to you tomorrow on Twitter, I will talk to you Saturday morning at 9 o'clock for a Saturday shotgun with ICT. So I'll talk to you next time. Be safe.